to reorganise your local government right across the country. Every council, every two-tier council in the country is being abolished. So all those people who work for those councils, including the planning officers, will have to reapply for their jobs. It's not a recipe for acceleration in planning consents, which are fundamental to what's happening in terms of the housing market. So I'm sure they'll miss those targets, but we want them to succeed because that's good in terms of people's choice to be able to get on housing ladder and be able to rent a house that they want to rent.
Are you pleased to see a Keir Starmer in Kyiv this morning?
Yes, about time. I mean, 6 months, he's not been there yet. But there's this 100-year partnership.
He would say he's too busy fixing the mess that you left behind.
Well, he would say that, wouldn't he? But the reality is, I say, we're the fastest growing economy in G7. Now we're the slowest.
Go back to
and that's all because of the
before
prices made down the street. But yeah, listen, I welcome Keir Starmer going to Ukraine. We started this 100-year partnership, which is both an economic and a security partnership to make sure what happened in Ukraine can't happen again.
Jim, you've been saying for quite a while that populism is by default inflationary, and I think we're about to get we've already had some great examples. I think we're going to get an opportunity to see quite a few more in the coming months and years as a new administration takes over and we see different things.
And how do you feel about the new
place.
president taking
So that'll be
office
fun
on
to
Monday in the
observe.
US?
I think want to take an opportunity to ask kind of a fun question here before we sign off real fast.
As a president,
and
what
with all sorts of
is
tariffs,
your
though,
favorite
Well, it's very important that we make the right decisions in terms of we should look to the West. We should look to
I'm an old fogey, so I love trading places.
Biggest trading partner, biggest single trading nation. I'm very worried that what the government's currently doing is looking east, looking at China.
It's a commentary on society as well as markets.
I think it's very difficult to do that with President Trump's position.
There's so many.
There's
so many.
The US is our biggest trading partner.
I grew up working on
you've seen
my
Keir
great
Starmer,
uncle's
you've seen
corn
David
and
Lammy,
soybean
you've seen
farms.
Rachel
I saw him
Reeves
calling in a
kind of
trade
going
one day
cap
to
in
his
hand
futures
to China
broker in Chicago,
trying to bridge
asked him
that
what he was
relationship
doing.
with
He said,
I think the most important
you know, go watch
didn't
Trading
work on it,
Places
did you,
with
when
your
you were in
dad. So I
power?
went
there
home.
are
I was like
concerns around
13,
China. There are
sat
concerns
down
about
and watched
security.
it, and
There are also real concerns
ever since seeing
about
that movie,
I think I've seen it 30 times.
rigs the game
Never
in
gets
terms
old.
of its trading relationship. It's subsidised business.
Said Trump's just about to rig the game.
Well, I don't think he'll rig the game with us if we have the right trading
Puts tariffs in place.
relationship. Well, let's see if they do.
I would say
Certainly,
trading
that
places
kind of
as
very
well.
close relationship with China
Margin call
is not likely to make President Trump less likely to impose tariffs.
second option to
I think
make
we
sure.
treat them with real caution, I think, is what we should do. We've got to make sure that the UK businesses work on a fair and level playing field. That's not always the case with China, but it is the case, I think, if we can strike a trade deal with the US, and I think we can do that if we make the right approaches. But I think running off to China, cap in hand, after a very small deal in terms of some trade with China, Rachel Reeves has come back trumpeting. I think it's quite embarrassing.
It's about 600 million quid. It's not a lot of money, is it? It's good to see you. Thanks,
Thank you.
Thank you. Let's show you a new frontier in the space race. Here we go.
Thank you for joining us. High volatility and Shane Skinner. Thanks for listening. Be sure to subscribe.
Jeff Bezos' Blue Origin rocket has lifted off from Cape Canaveral in Florida. It's the first test flight for the ship called New Glenn after a planned launch was called off on Monday. The 98-meter rocket has been long in the making with heavy funding from the Amazon founder. Why is it called New Glenn? Stay tuned and we'll tell you.
I'm Stuart Ram, and I'm Sky's chief correspondent. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab
Can even manage it for you.
Not to mention Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl,
Schwab.
Schwab, a modern approach to wealth management.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome to Gamma On, Episode 5. I'm Oliver Rennick, and we're going to have a great conversation today as we continue to probe minds of smart traders and those who have had a lot of different experience working with options. And, of course, we're still taking that second derivative focus. We've talked about how to calculate gamma exposure. We talked with Jem Carson about the different forms of second derivatives and when to apply each. Today, we're going to be thinking about how to survive and how to thrive and how to get a lunch in a market that, of course, has no free lunch and has gotten progressively more difficult, arguably, as tech improves and gets more advanced. And we're just here with our basics, but trying to pump up our knowledge. Kevin Green with me here in studio, in the podcast room. KG, you the man. Great to see you.
Glad to be here. I mean, what a journey already when it comes to Gamma On, right? I mean, we've gone through so much, and we've gotten a lot of great feedback here, Oliver. Now, you're kind of right. I mean, we are in markets right now where volatility now has become a little bit compressed. And so where do we go to look for alpha? How can we actually manage these markets? And what tools are actually in place in order for us to do so here? So I'm actually very excited about what we're going to be talking about here today and the guests that we're going to have on.
Yeah, today we've got Noel Smith joining us from Convex Asset Management. He's done hit with us on the network. He's got a really good Twitter. He thinks a lot about dispersion, correlation. So we're definitely going to talk about some of that, but we're also going to kind of just speak as traders who have evolved. Noel has done a lot more evolution than I think either of us in his career, but he started here in Chicago, or maybe not started, but early on was in the floor of the SIBO. He's with us here from Convex Asset Management. Noel, thanks so much for joining Gamma On, sir.
Thanks for having me.
Okay, so you did build your career basically in Chicago, so I feel like, we were just talking. We've got some friends, some acquaintances that overlap, some folks that are going to be here talking options with us, and I feel like that's kind of the starting ground for knowing someone knows their way around derivatives and options if they built their career basically here in Chicago.
Yeah, I'm a Chicago guy, born and bred.
Amen. What year were you on the SIBO? What were you trading?
So I started on the floor of the SIBO in 1996. And I started trading in the Sears crowd back when Sears was a thing. And then I also moved to, each pit has a name that's like one of the marquee stocks, and there's a bunch of names in that individual pit. But I traded, I don't know, really everything on the floor at some point or another. But some of the more interesting names were AOL, US Robotics, some of the wacky names from back in the day.
Am I correct, or should I already kind of correct myself in the statement that things have gotten harder as technology has gotten more powerful? I mean, when I kind of think about the floor trading days, it seemed like there was an element of it. Obviously, that doesn't exist anymore. There's a physical element of it. There is a be there, be seen, be fast. Obviously, the machines have arbed away a lot of that, but I find your career particularly interesting because you seem to have thrived and evolved with kind of each new iteration of tech.
So the funny thing about the business is the golden era was always 5 years ago. You can shift that in time wherever you want. So when I first started on the floor, guys were like, oh man, 5 years ago, we used to make so much money. And then, 5 years after that, people used to say that when I started 5 years ago, it was amazing. So the reality is that, it's just changed. So, you used to be able to trade 10 options for 50-cent wide spreads, and then you'd be lucky if you got 12 here and there. Now you can trade 1,000 options for a penny. So it's not necessarily all better or all worse. It's different. In some areas it's worse, in some areas it's better.
How would you characterize today when, as KG just mentioned, obviously we've had a pretty big vol compression post-election, but also just kind of thinking more broadly through COVID and after this big explosion of options volume, of trading, of it being kind of the baseline for everyday investors, for retail folks. And I think a lot of folks considered the notion that it would fade post-COVID, and it hasn't. All of the data tell us that the options market is still booming. Does that bring some more discoverable alpha into it in your mind? Does it help improve some of those spreads, some of those margins when there's more folks doing it?
Absolutely. It's simultaneously harder and easier. I'll use music as an analogy. If you used to want to be able to record a song, say you were a guitar player or a bass player, you had to go out and buy studio time. You had to spend, $1,000 an hour to do that. Now you can do it on your iPhone. But because everybody can do it on their iPhone, you have to be more unique in that regard. So you have to come up with a little bit more clever ideas, and you have to use different technology. You still have to be different. But the things that were really clever in-house IP 10, 15, 20 years ago, you can buy off the rack now.
Okay, we'll come back to that point. I like that. Tell me a little bit about sort of your process. Give me like the rundown, like from when you drink your orange juice to when you're putting on your first trade, getting filled. What does that setup look like? Kind of what's the process for the tools, the kind of preparation that you do? Got a lot of screens back there.
Yeah, I used to use Blue Velvet, but I didn't trade as well off of Blue Velvet. So the process, I get up around 4:30, 5 o'clock in the morning. 4:30, and first thing I do is just take a survey. Like, what happened overnight? What did I miss? What are the futures doing? Probably the exact same thing that everybody else is doing. And I look at what has changed since I last put eyes on the marketplace. And then we have, screens that kind of just give me the most relevant information. And then I do probably what everybody else does. I read some of the news, see, why is the market moving? Why isn't the market moving? What happened in, Europe? What happened in Asia? Things like that. And, the options market doesn't really give you information until after the market's open. So a lot of the stuff that I consume from in the morning pre-market is really looking at day in arrears and just sense checking stuff and seeing how do I want my risk proportion today relative to where it was yesterday, and is that still a good trade? And that's part of my morning process. But a lot of that is just, again, reading some of the macro stuff, seeing what happened in the news.
Okay. I was introduced to your account, Noel, through KG. So Kevin, kind of marry these worlds for me, obviously, because I think the first time that we hung out, really like drinking beers and talking markets, at maybe that the first Impact that we were at.
Yeah.
I think you early on also were telling me about the way you were thinking about second derivative functionality as well. How do you kind of figure out who you want to follow? Tell me about how you kind of sift through this information flow of people who think about options.
Yeah, I mean, obviously it's still networking, right? And so actually I met Noel at the Options Pit conference out here in Chicago. I believe it was in June of this year. And actually we were talking about Gamma. Well, my presentation was on Gamma. Noel had a presentation, I believe, the day before. And at the end of the conference, they did like a panel. And what was funny, we had a couple of people on that panel. Everybody was great on that panel, but Noel and I were kind of going back and forth, maybe had a little bit of different perspectives, got to the same point, right? But a little bit different perspectives there. And we were kind of just kicking ideas back and forth and ended up making the contact. And I think he's probably one of the greater minds within the markets right now that I in my opinion, and Noel, this is attributed to you. I think you're under followed, my man. Like, you got to get people to follow you a little bit more, because his thoughts on how to trade just in general, and then how to look at certain aspects of the markets, and not only just from a technical standpoint, but also from a fundamental standpoint, is actually very key. And once again, you get people that come and you're like-minded, right? One day, I'm going to disclose a conversation here. No, one day I'm reaching out to him on LinkedIn. I'm like, hey, you got a second? I got a question for you.
Yeah.
And it was a really quick question about these new dispersion contracts that are coming out on the SIBO, right? From my trading career, I can talk about, vol products. I can talk about gamma, theta, whatever you want to get. I can get into the weeds with a lot of them, but dispersion is not really something that's on the front of minds for a lot of retail traders, but it does give you an edge when you're kind of utilizing that market, right? Or that concept, especially when you're a hedge fund or or high frequency trader. So he's like, yeah, call me up, man. And so I call him up, and we ended up having like an hour and a half conversation about like everything under the sun when it comes to the markets. And so like you got to follow really good people like that, and there's always good knowledge out there. I think that's a good key takeaway outside of what we talk about from the technicals.
For sure.
Right? Continue to branch out.
Got to continue to learn.
Yeah, I want to kind of reach out though, and for Noel, you and I had this conversation offline, and I want to kind of bring it to you to the forefront. Ollie's talking about options trading. Now it continues to expand. I'm of the mind that as we continue to get more products, the daily expirations for the index options, little rumors being floated around about maybe having equity options on a daily basis. Let's see if that actually comes to fruition in the next year or what have you. But I'm of the mind that the more options series that we have,
yes,
I believe that is actually a vol dampener over time. So Noel, I want to kick that back over, or even kick it to you.
Totally.
What do you guys think?
A great question. I think we talked a little bit about that with Jem, which is a great thing to follow up on, because it seems like the smoother your surface gets, right? Like the smoother the surface gets, the more utility we should be able to drive from it. And you would think, price would be discovered more accurately. Thoughts on that, Noel?
I think that the more choices you have, the more specificity you can add to your choice. So if you own a house in Florida and you need hurricane insurance for the year, well, maybe you don't want it for the whole year because you don't want to pay those premiums. Maybe you only want it for hurricane season, or maybe you only want it for the week of the hurricane that's headed for your house. So it does bring down the overall pricing because you can add specificity. What that also does is it will add volatility to the event. So if you're looking at like an election, right, the volatility was quite high. I'll call it 2% or so. But if you go 30 days hence, or 45 days hence, or 100 days hence, it's so much more unknown, and you don't need to know, which is another important way to think about it, because you can do what you want to do in the here and now, and you're not compelled to make longer range decisions.
One of the ways in which this shows up is a lot of these options-driven funds that now are utilizing dailies. Like, for example, we talked with iSpy, which is a ProShares fund that uses daily call options that they sell. So you get the income, but to the point about having different time exposures, when they do it on a daily, it becomes a different product than a lot of existing like call writing options funds, because you're losing a little bit, right, if you're doing a monthly. So you have a different kind of set of risks, which just kind of brings me to this question, Noel, of when you think about the different ways to use options, do you think most people should be kind of thinking about it from an options standpoint, or do you think that some of these funds, some of these options-driven pseudo-passive funds will capture some of that market?
So consider what the reaction function is for each one of those players. If you have a fund that is mechanically selling options into the marketplace, who are they selling them to? Well, they're selling them to the marketplace, the market makers. So the market makers, what they're going to do is they're going to lower the gamma that they're buying, or the price of the volatility that they're buying, so that they think that they can make money. So they're not really interested in if it's a 40 vol or a 20 vol or a 10 vol. What they have to do is they have to buy it for a number lower than what it's going to realize. And so if they know that there's going to be 50,000 options for sale in the next hour or two, what do you think they're going to do? What do you think any wholesaler is going to do when a bunch of inventory is coming online? They're going to lower their price because they know that seller is going to sell something like irrespective of price. And there's a competition, there's a marketplace for this, so you can't just lower your price to whatever. But the market makers will lower their volatility so that they can buy it at a price where they think they can make money. But the crucial thing to understand is that the market makers will hedge. And the ETFs or overwriting or buy writing community, they don't hedge. So they're going to be out there selling their daily or their weekly or their monthly, 5% out of the money call or a 5 delta call, whatever, it doesn't matter. But they're not doing anything else with it. They're simply holding it until it dies or it goes in the money. But the market makers will hedge. And if they're buying vol for less than they think that it's fair value at, which is why they would buy vol to make money, and then they're hedging around it, it can be reflexive, which can be a vol compressor net overall.
Mm-hmm. Love that point.
What I find very interesting, Noel, we try to highlight some of these events around options expiration that could actually create a little bit of intraday volatility, right? They're not, especially when you have these rolls, they're not going to be the headline catalyst for why the market moves. But it's funny to see some of the intraday action. And there's a lot of traders, retail traders and speculators out there that try to follow fund flows. And sometimes we see aggressive buy. Yeah,
right.
I mean, it's actually
you follow pretty closely.
Yeah, I mean, it's what we do, literally follow every single day. QYLD is actually a very interesting one, right? Well, that's on the NDX side, but NDX options don't get the volume flows like SPX. And so sometimes on a monthly basis, you can see those rolls kind of cause a little bit of intraday volatility. And maybe that also does spook the equity markets. And then we have the quarterly options too, where we have the JP Morgan collar, that equity fund that everybody kind of talks about too, and how they're going to be layering on new positions. At some point though, Noel, this seems like this ETF world on the passive side, these cover call strategies, in my opinion, it's going to get way too saturated. And do you think that also could be something that, once again, dampens volatility? I mean, if everybody's kind of doing it, it seems like it's. Yeah, it seems like we're at the.
Are we going like the
all
short
the way to
VIX,
zero?
The short vol fund repeat just through a more complicated way.
Right. Yeah, that's basically. Are we going going down to zero? I mean,
are we recreating 2017 by doing this just in a more advanced manner?
Playing devil's advocate, what's the problem with that? So what do you care? So if they sell a bunch of volatility and you're able to buy a straddle for zero, I'm being funny, but say you can buy a straddle for 1 vol, 2 vols. So as long as it realizes for more than that, it creates an opportunity for the marketplace.
Sure.
So if somebody is squishing vol to a level that doesn't make sense on a realized standpoint, that just creates opportunity for the marketplace. So they're sowing the seeds of their own destruction within their strategy. If they just keep selling vol, irrespective of what the realized vol is going to be, they just start losing money. And then if they start losing money, then they start losing business. So the shift that's going to happen in that is really a function of, if they just keep doing something mechanically, they're going to compress vol. And if they compress vol too much, it's going to be easy to buy volatility. I mean, the best trade you can really do is buy a straddle, go to sleep, and wake up with more money in your account. Who doesn't want to do that? So if they're pressing vol down to such a point where straddles or strangles are cheap and you can make money by scalping around it, that sounds like a really good opportunity to me.
Could it possibly get to a point where the funds run out of that kind of marginal value for vol compression any further? I mean, does any of this have potential to replicate some of the fund issues that we had in 2018? Noel, is there any way to get into that type of situation again?
Those are two separate questions. So, like for instance, right now, the VIX 1D is like 7 and change or something like that. And it's not even going up right now. As we get closer to tomorrow, it's not even going up, which implies that nobody's expecting anything to happen tomorrow. So if these funds keep selling vol lower and lower and lower, eventually what just happens is they just start losing money, or they underperform their benchmark by such a wide margin, they just don't have any more customers. The event in February of 2018 was pretty different. We're coming off of a low vol regime the previous fall, and then market did go down in January of 2018. But the difference is that the marketplace knew how many futures were needed to front run some of these products. So if you knew that they had 5,000 futures to cover the next few minutes, again, the market makers, they're not dumb. They know exactly who's doing and what they're doing and why they're doing it. So they just change the prices. They change the prices so that they can't lose money, or they make a ton. So those two things to me are pretty separate.
Yeah, I kind of want to go and expand on that, because that is the misconception out for Volmageddon, right? I mean, that was more, that was an ETN that had the exposure, right? And that was more mechanical in nature. And we kind of throw that term out there every once in a while. We got to know what the actual underlying is and how the structure is of these funds. So that ETN, if you kind of read the prospectus, and they did have it, which no one does, but it's always important to read them because it's the best efforts for them to cover the exposure for their shareholders. And so they got to a point where it was either we're done, or we're going to basically blow up the vol curve in general, right? And that would be a little bit probably more of a systemic issue for them to be able to cover. And also those were kind of futures contracts to be able to cover those positions. So it's always a misconception of like something bad actually happened there, where it was more, they were the only player in town that actually could cover that position, and then that domino effect would have pretty much blown up the whole curve. And I think that would have been a bigger issue. I do want to follow up on that though, Noel. How were you guys trading it when you had Volmageddon out there? I think that's actually kind of very interesting, because we don't have market makers that really come on, or those that actually have a lot of experience that says, how in a vol type of environment like that, what do you do, or what did you do in order to be able to protect the portfolio and try to stay, let's say, even delta neutral if possible, if that's where you wanted to skew?
I always say delta neutral in that situation, and when something moves that much. Think about if if you are in a situation that's a pickle for you. So say, for instance, you're Mike Tyson and you're in a fight, right? You're in the ring, you have your gloves on, you're ready for a fight. That is totally different than if you're walking down the street and someone comes up behind you and smacks you in the back of the head. What I mean by that is that if you look at what was happening in the vol surface prior to February 5th, 2018, you knew that there was a problem there already. But if you just weren't paying attention at all, and you really shouldn't consider yourself to be a vol trader if you didn't know that, then you were surprised by it. The tell that I talk about that I've never heard anybody else talk about is the reversal was being shopped around prior to February 5th. What that means is that the borrow rate was in question. So you can presume from that the ability for people to go out and lend shares was getting more profitable and to borrow them was getting more expensive, which means the stock was getting harder to borrow, which you could reasonably think that XIV and SVXY were going to be a problem. And that was like the most obvious tell to me. And then again, going into that week, the vols were already elevated. So there's no real reason you should have been short vol going into that event unless you're just, oblivious to what was going on in the marketplace.
Noel, is a lot of folks that I think are considered kind of everyday traders, retail traders, if you will. The education, the understanding, sophistication has obviously improved over the last 5 to, obviously further than that. It's kind of always improving, but I feel like substantially over the last 5 years in particular because of how much education was consumed. Obviously, we can see from interest the way folks are trading, not just options, looking at, say, like what they used to use as a market maker move, an implied move for a stock ahead of earnings, kind of used to be a lot of people's, I think, entryway into thinking about options trading. Then you get to this next level, the second derivative, where people look at these things not just as outputs of how they're calculated, but as inputs for their own trading. I'm kind of curious, philosophy-wise, do you see Gamma and its second derivative peers as being useful inputs to your process, or do you mostly just look at them as kind of outputs from, the volatility surface, basically?
There is no magic bullet. If you think about each one of these data points or these data sets, they are useful on the margin. And I wish that just one of them was like this magic bullet and you could go out there and print money. Right. But unfortunately, it's not like that. So when you're looking at second order derivatives, or of course we look at Gamma, we look at all of them. Are they inputs into what we're looking at? Completely yes. Are they determining factors as for the strategy? No, they are not. They will inform a trade. Think of it like technical analysis, right? I don't really use technical analysis, which is to say I don't use technical analysis. But if you know that the 200 moving day average is right there at 1,000 and everybody's looking at it, you just kind of pay attention, right? Maybe it's going to bounce, maybe it's going to break through. But I look at it as being maybe a little bit more useful than that, but not wildly more.
Okay, understood. Are there particular moments like volatility bouts or particular environments in which you pay more attention to it? Is it like it becomes more useful when things are actually moving a lot?
Yeah. So unfortunately, for our talk, this should require a good amount of study. But say for instance, right now in the SPX, you have the 6,000 strike that's really standing out. So invert that. As the trader listening to this, you're thinking to yourself, well, what do I want to do with this? But as the market maker, you're like, oh man, I've got all these options sitting at 6,000. And if I don't hedge around them, they're going to die. So now every time, the index goes a little bit above, you sell, and the index goes a little bit below, you buy to try to make money around it so you don't wear the entire theta decay of that position. So I think an instructive way to honestly approach a lot of things in life is to just invert the scenario or invert the roles so that you can think about it from the market maker standpoint. And what is the market maker most afraid of if they own, 600,000 SPX, SPY 600 and SPX 6,000? You don't want your options to go to zero, right? You want your options to make you money, or you want to scalp around them so that you can make money on that position. So that's probably a little bit more intelligent way to think about it. So if they are scalping each time, and you've got the market maker, say you have Citadel, Susquehanna, Virtu, whomever else, and they're each getting narrower and narrower and narrower, that's what causes the pin, because each little iteration of a scalping event is slightly less profitable. So they try to front run each other so that they can get in.
I love that. KG, we're nodding our heads because it's basically what we talk about every day. And I guess the last point I would say on that is that the reliability of what they do is what makes it useful. Their size obviously can be daunting if you're on the. That's the whole point. Yeah, to a point. Right, but it's also their size that makes them kind of slower moving and largely predictable, where you kind of know what's going to happen.
Yeah, to a point, right? And I think Noel was kind of hitting on a very important part of this whole equation. Time frame matters too.
Oh yeah.
Right. If I'm a swing trader and I'm looking at 2 weeks, 3 weeks out, yeah, I'm gonna keep levels on my mind because it's just how I am. But I also do know that news flow pushes markets higher or lower, right? Or you can have earnings pushing markets higher or lower. You have passive funds literally every day that's juicing up market caps across the board. So I think if you're kind of looking at those scalps or those intradays, and we're looking at those positive gamma levels, negative gamma levels, where we talk about that pen risk as Noel was kind of talking about, there's ways to be able to try to capitalize that on the options front, especially if you're a premium seller, right? And that's usually what a lot of individuals try to do. They try to sell out on the wings, or they might have a pen at 6,000 and they might sell the fly, a butterfly at that 6,000 level, just to be able to try to capitalize on it. But it's very important to know that every single day, the position for a market maker changes.
Right.
The position in the market changes. The narrative also changes. And so some of the longer term technical analysis, fundamental analysis, or trying to find flows, I think is still going to be key there to be able to try to capitalize on that.
You do see a lot of times how they overlap too, the technicals and the gamma levels.
Yeah,
It's not
definitely.
coincidence.
It's not coincidence at all. No, look, I got to ask you about dispersion. Can you give us a high level of what dispersion is, and then kind of, do you find it to be like really useful for the retail trader, or is that more for individuals that are trading like larger sizes or maybe have larger portfolios and books, institutions like yours?
So putting the trade on is probably a little bit more institutional because it's expensive and it's difficult to do. But knowing why it goes on or levels where it can go off can be very useful for a retail trader. So, if you have a $10,000, Schwab account, do I think you can trade dispersion? I do not. But to know that, Millennium has 500 million notional short Vega on, it's pretty useful. So if you get some idea as to like who are the players and why are they doing things, then you can use that as an opportunity. To answer the first part of your question, what is dispersion? Dispersion is taking the single names of an index and trading them against the index. So consider stock A and stock B. You buy options in stock A and stock B, and then you sell the index of AB. So the idea, the dream scenario is stock A goes crazy because you're long premium. Stock B goes crazy, up or down, doesn't matter, and you're long premium. But the index, won't necessarily do anything. So say stock A goes up 50%, stock B goes down 50%, but the index of AB goes nowhere, and you're short premium in index AB. So you make money on your short premium, you make money on A, and you make money on B.
Is the general thing that you watch kind of low vol, high dispersion, right? That's what we're talking about generally, kind of compressed vol, but high dispersion?
Yes. So we typically trade it so that we're short volatility on the index and long single names.
Right.
That's the normal way to do things. You can invert that, and there's nothing saying that you can't. That's a separate question. But that is the typical trade. But what contributes to that trade?
Yeah.
It's not any one thing. Like all of this stuff, it's never one thing.
Right.
Consider the Mag 7 prior to the election, then relative to the election. So if Harris would have won, you assume that certain stocks in certain sectors would have benefited, and other stocks would have been decremented because of that. And the exact same thing in a Trump case. So whatever, they're not necessarily opposites, but you could say something like solar stocks would do better under Harris than Trump, whatever. So there is a dispersion between, say, traditional oil stocks and solar stocks, depending on what candidate carried the day. And that, to me, is a simple way of just saying this is going to go this way, that's going to go the other way. They are dispersed. They're going in different directions. But net, where does the index go? Well, the index has really just gone up and volatility has gone down. So that's another example where A has gone up, B has gone down, but index AB has gone nowhere. So you can make money all around. Dispersion is a cool trade because it's a unique way to make alpha. It is a bit complicated. And dispersion is also like saying medicine. What are you, a heart surgeon? Are you a brain surgeon? Are you a toe surgeon? What does that even mean? There are a lot of different ways to do dispersion.
Totally.
Where are you on the curve? Are you doing it in the S&P 500? Do you have certain leans? Are your sector weightings? Are you doing variance futures? Are you doing variance OTC swaps? I mean, there's a lot of different ways to do this. So you can't just say, I trade dispersion.
Right.
What does that mean? What do you do? But there are a lot of different factors that do contribute to a compression of volatility. But the same side of that is if there is a risk-off event where things become correlated, where you have to make difficult decisions all at once. If you have to sell your house and you've got a year, the price is different than if you have to sell your house and you've got 10 minutes.
Absolutely.
So those two things are very different. And that doesn't mean your house is any different or any more or less valuable overall, but your ability to make, or you being forced to make those decisions in haste really does change the price of things.
Hey, Noel, thanks for the chat. Thanks for being here.
Thanks for having me.
Fun discussion. Appreciate it very much. Noel Smith, Convex Asset Management, and Schwab Network's own Kevin Green. I'm Oliver Rennick. Thanks for tuning in to Gamma On. Be sure to subscribe to our YouTube and Spotify channels. You can find all of our past episodes there or on schwabnetwork.com. Thanks for tuning in. Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Welcome to Gamma On, episode 6. I'm Oliver Rennick, lead anchor for the Schwab Network, and we've got a great show coming up here. Brent Kochuba, the founder of Spot Gamma, is joining me, and we're going to talk about everything from the ground up to how it's impacting real live action and micro strategy in the S&P 500. Brent's with me here for episode 6. Brent, it's great to have you on the show. Thanks for joining us.
Absolutely. Pleasure to be here and excited to talk to you.
Absolutely. I've followed you for a long time. A lot of the folks that we've talked to on the show are familiar with your work. I think a lot of viewers are definitely going to be familiar. So introduce us, though, for those who don't know you, what exactly you do at Spot Gamma.
Sure. So I have about 20 years of institutional derivative experience. I worked for a few banks and then an options market maker. I was a broker there and a family office. And so through that, I learned all about, and I came to see how the options market could really have a major impact on the underlying, specifically S&P 500. And so in January of 2020, I took all these models I had built for the family office and through my experience at various brokers and put those models up online and started to talk about Gamma on a daily basis. And, in January of 2020, it was about convincing people that the options market impacted stocks. And then, you fast forward to meme mania in January of 2021, and now it's a kind of a common topic of conversation.
Yeah, that's definitely something I kind of want to revisit a little bit for those who do have that as their reference point, the meme trading, the GameStop stuff. I also kind of want to take it back to square one a little bit. We're in episode 6 of this show, and some of the feedback I've gotten is that we started off with this kind of baseline, this grounding, and the definitions, the simple stuff, and we kind of then extrapolated on how to use that, how to calculate things like gamma exposure, and then kind of got into some of the philosophy of the broad second derivative. So to kind of help us bring it home here, when you talk with folks, like I joke that before every podcast, I go on and make sure I've got my definitions right. Delta, price moving according to how much the underlying moves. Gamma is the derivative of that. It's like I'm the guy who hosts the show that double checks his definitions. When you talk to folks and they're like, hey, what is gamma? Do you refer to the derivative definition, or do you refer to gamma as like a tool that can be used from a utility perspective?
Yeah, you bring up an interesting point because there's like two types of lingo. There's the flows perspective, which is, what is the impact of this to the overall market? And then there's, when you start to talk about structuring trades and things like that, you're more talking about the derivative calculation itself, meaning, what is the gamma of the specific contract and what does that mean for me as an options trader? And so I think that as the, gamma analysis, the sector of study known as gamma analysis has grown, we sort of normalize this conversation of like, the GEX index or these different numbers, which kind of mean more to the market in terms of volatility as opposed to what may happen with an underlying option, for example.
The other thing that I've seen you talk about, some of the kind of disclaimers that we always try to mention as well, is what do we know is actually happening when trade exchanges hands? What the motive behind that is certainly not obvious. There's also ways that we kind of paint with the broad brush in terms of dealers versus market makers. How much do you think this is like science? How much of it do you think is art?
It's getting better in terms of the science because the data we're able to start getting now is better. It's immensely more expensive to obtain a lot of this new data that's coming out, but we're really able to glean a lot more insights that are much more constructive to understanding how people are positioned. And in the past we could sort of understand what open interest is and where people are positioned, then we could look at the volatility surface and start to understand, okay, if call skew is the highest it's ever been for GameStop, then we know people are along these calls, and we can look at the options chain and start to figure out where that is, right? But now we're starting to able to track positions. That's one of the things we started doing at Spot Gamma, tracking positions. We've been doing that since January to understand, okay, this is where we think market makers are short or long various calls and puts. We can wed that with a look at the volatility surface and monitoring volatility to start to understand exactly how people are positioned. And then you can, the value of that is that you can start to put together an understanding of how the underlying stock is going to react or may react to different catalysts, right? And that's what really the holy grail is if you start to believe or can start to understand that the market is pricing, that your price for or understanding of how much the market is going to move, in other words, my price for volatility is different what the market is, then I really have some edge, right? And that's really what ultimately it is we're trying to chase here.
I mean, I guess you would probably argue then, I mean, you got a service that is based on this, and you've done some really good analysis too about the relationship between movement in the S&P relative to gamma exposures, the notion that there is a correlation that is scientific in nature, that is kind of a pressure point for markets that kind of tells you when things might be starting to get more convex. I mean, I guess you would argue that this is a necessary tool in the belt to be able to deliver alpha, to discover alpha as a trader.
I totally think so. And the trick with the options analysis is that there's options trading in every single name. Basically, it's like 5,000 different U.S. listed instruments, right? And so the options impact is not there for every name all day long, right? But there's a certain subset of names where it is like the S&P 500, day in, day out, what these positions are. They're systematic positions. They're very large positions. And, in there, you can see the impact of options, I think, on a daily basis, right? And then there's a kind of a second sector where there's rolling impact, right? It'll become the meme of the day, and there'll be a lot of options volumes and things. But you can look at in the S&P 500, which is certainly the largest options complex, there's a lot of robust statistical evidence. You don't have to overfit curves and things like that to find something, right? It's robust. You can see that the bigger these positions are, right, call selling positive gamma positions are, the less volatility we have in the S&P. You can see it with things like the JP Morgan collar trade. You can look at a chart of the S&P into the end of September and know exactly where the JP Morgan collar trade was positioned, right? Because we pinned that level. And if you're not aware of those options positions, then I think it messes with your understanding of how the market works, right? You're kind of flying blind in a lot of ways.
Do you have a favorite analog to use for folks who haven't thought about it from the sort of mathematical, quantitative way you do? For example, we talk a lot about guardrails sort of on a highway where you sort of understand, okay, here is the certain kind of, and I also kind of think about it from maybe to start from a trader's perspective is when I first started thinking about options trading, the implied move ahead of like an earnings report or something. And that was kind of the way you'd start to get a baseline. Okay, what is kind of the market expecting in terms of the magnitude of the swing here around some event? Whereas gamma's kind of that literally to the second derivative, where you seemingly kind of know, all right, here's the highway we're traveling down. Here's where some of the kind of expected guardrails are. They can bend, they can absolutely break. They usually don't break, but knowing how kind of the structure is breaking down or firming, is that a good analog? Do you have other ones that you like to use?
Yeah, I tend to think of it as like a hug, right? It's like, how hard are you squeezing me? You can squeeze me so tight that, I can't move my arms, or, it's kind of like a little bro hug where it's like, how you doing? And I'm free to go about my day, right?
Right, so there's convexity in hugging. You can go from comfort to death.
Yeah, that's exactly what it is. Like, and so when you look at some of these markets, the embrace is strong and it's long, right? It's there, it's solid, and when oftentimes that hug is going to stop, right? Because there's an options expiration, there's an event that's going to remove positions that free the market, to move. And to your point, I think the biggest, most consistent flow in the world is this options hedging flows, right, in the equity space. You can have a moment in time where, maybe a big pension fund comes in and they got to sell a bunch of spiders or futures or something for some reason, right? And that in the short term, let's say over the course of half a day, can move the market. But then this positive gamma flow, if it's in place for dealers, that eventually is going to come back in and kind of like right the ship, right? And so I think that's the other thing that is key here, is that the hedging flow persists day in and day out all day long. And so you can have these short-term, exogenous flows that are a fund comes in, they got to sell $2, $3, $4 billion in a short time frame. They move the market, and then the options flows kind of bring it back into place, right? And so there's a kind of a timing and a path dependency, I guess I'd put it, to the way a lot of these flows operate.
A couple of really good points there. I also like the ship being righted as the dealers and the market makers adjust accordingly, because I do kind of think about as a retail trader, as an individual, you're kind of trying to keep your balance basically on the ship that's being driven by these much bigger players. And if it starts to tilt one way, you want to make sure that you're either, ready for that big move, because you will get thrown off. How much do you think I guess maybe from a size perspective or from an individual kind of versus institutional side, how much kind of ability do you think people have to maintain that balance given the size discrepancy versus huge dealers and market makers?
Yeah, I think the interesting thing is, as traders, we're all looking for an edge and trying to identify, what is my edge as a trader. And there are a lot of short-term movements. For example, if a big fund comes in and pushes around a certain name, and you believe that, or pushes around the S&P, and you believe that positive gamma will come in and lift the market back up, right? As retail traders, we can express those ideas a lot more efficiently than a bigger entity, right? Because we don't have to buy 1,000 futures or something, right?
Sure.
We can buy one lot and monetize something. So I think that when you look at the underlying edge here, it's easier to capture that edge oftentimes, particularly with the use of zero DT options and short dated trading, and you can sort of operate in this interesting zone where it's like one of those little fish, I don't know what you call them, that's on the back of like a whale, right?
Yeah.
You can sort of
symbiotic.
Like live off the byproduct of these flows.
Totally.
And I think that there's a lot of interesting edge in that, for traders, because if you believe it's the hedging flows that are exacerbating a move, when those hedging flows stop, then moves should mean revert, for example.
Okay, and that's exactly kind of where I was going. I'm glad you go there, because thinking about the volatility surface and the way we've now chopped it up with so many different durations and the 0-day stuff, the kind of two-part question there was, one is how much does the 0-day and the short-term options give us that dexterity, a word that I've heard you use before, I think that people have to have. And then kind of the second part, because you already kind of addressed some of these, but the second part too is, do you find yourself in certain types of trades more than others, like structures of trades?
Yeah, that's a great question. So there's a cycle to volatility, I believe, and there's a lot of evidence for this. And so what I do tends to cycle with volatility. There are times where I think volatility is too cheap, and so I generally want to frame my trades under that guise of being long options. And then there's times, and it's between individual names too, but like if you just think of out of the election, right, and everyone knew that if Trump got elected, or believed that if Trump got elected, the market was going to go up, right? And people are even like, hey, this should be really bullish for Tesla, for example. But what people didn't appreciate is the potential impact of short-dated options flows into Tesla and leveraged ETFs and all these things that make Tesla go up a lot more than what the general market expects. And I think that it's hedging flows that exacerbate that moves. But what the sum of that is that calls were underpriced. And this is something we wrote articles about, so I'm not really saying this with hindsight, but it's about the price distribution, right? The market was pricing in, let's say a 50% chance of a 1% move. And I say, no, it's a 75% chance of a 1% move. So I want to be long options in that environment. What's interesting now, if you turn to the S&P 500, today's 0 DTE straddle. So if you look at the price of a call and put at where the S&P opened, which is around 60.80, the price of that straddle was $17. So we'll generally quote that in basis points. You take $17, you divide that by 60.80, you get 28 basis points. So the 0 DTE straddle was 28 basis points, meaning that the market was pricing in only 28 bips of movement today, right? That is the lowest price since the COVID crash in 2020. So what that's telling you is the market is now pricing in no market movement. So the point of that is that now volatility, traders' expectations of volatility have gotten so condensed that I, as an options trader, can't go, I'm not going to sell that. Like, why would I want to sell the lowest volatility in the last 5 years, right? So, do I think that I want to get long options in this scenario? Do I think there's a catalyst to switch us from this kind of short volatility or low volatility regime to a high volatility regime? And so, these are the differences in price distribution. I can give you another example, very shortly. At 1:45 yesterday, Powell was speaking, 1:45 p.m. Eastern time, and the 0 DT straddle at that moment was only $10, right? And Powell's a catalyst for the market. And so, you end up with this situation where the market immediately jumps when Powell speaks, and the result is that the S&P gets squeezed, and we close at all-time highs. And the end of day move there was $20. And so what I think happens there is people who are short volatility, right? If I'm short the $10 straddle and the market starts to move $15, $20, I got to cover that position, and that flips hedging flows such that they go from volatility suppressing hedging flows to kind of volatility expanding, right? Because these cover trades induce volatility, if that makes sense.
Absolutely.
So so you got to navigate those waters.
Okay, so that's a really great example. By the way, we're doing this on Dec 5th, so for context for those following along, because I love the use of the numbers here in some examples. And do you believe in these kind of windows of weakness, like Jem Carson oftentimes talks about windows of weakness? Do you feel that that's the way the market kind of operates now in between expiries?
Yeah, so I've done studies on this before and recently, and I think that was something that you could kind of set your watch to up until really this year. And I think what happens is anytime people become broadly aware of a construct, it doesn't work anymore, right? And so you start to see the market move oftentimes before options expiration, right? So before we would say, well, I'm going to play a pin into Friday expiration, right? But then the market starts to kind of shift on Wednesdays. And you could also see there's a correlation or there's an impact of whether the VIX expiration occurs before or after. And so I do think broadly that is a turning point, and it's kind of a window of weakness. But, the kind of window assumes that there's like this, you arrive at the window and we go through it. And now it's sort of like, almost like you're wading into a pool that gradually rises, right? You start to get used to before. And kind of what's happened, I'll give you an example, is like I wouldn't buy, so let's say I think that volatility is going to expand, which I do, and I'm like, well, I want to buy puts here because I think the market may correct, so I'm going to wait until Friday. But then the move starts on Wednesday, and I'm like, man, I was going to buy 2-month puts or something. So like I got too cute, and I missed the start of the move because I waited those extra 2 days. Does that make sense? So now it's like, okay, I know this is the big event, and I'm not going to be cute about the exact timing of it. I just know that around this time is when I believe things are going to start to shift.
Hard edges have softened, basically, the more folks try and preempt them or act on them. So I guess then, do we take that to the extreme, to the infinite, and say eventually the whole thing will get arbitrated away and it'll just become kind of one long diffusal? Or does the market structure will kind of always have that now hyper seasonality around it? Can you fully arb away the gamma edge? I mean, how do you think about that?
The the call selling funds and the derivative ETFs are only growing in size, and it doesn't seem to matter that from a total return perspective that those products are not good, like JPI. I mean, the return's not bad, but when you compare it to the S&P 500, you're objectively performing worse, right? And so, these funds have, JEPI alone, I think, is $35 or $40 billion, and they sell every month. They sell essentially what amounts to 1 month 20 delta puts, right? They just do that every single day. Basically, they're selling these puts, right? And you see these funds also coming in some names like MSTR and things like that. And so my point here is that there are these systematic flows that come into the market that are only growing in size, and I think as long as that is there, then you're going to end up with a lot of these same dynamics. Like a lot of the flow has been pulled forward to the next expiration. I think that's true, but I think that the zero DTE mechanics operate inside of this larger cycle, which is tied to monthly options expirations, right? And these systematic flows are the same.
What about the potential to really exploit like the GameStop type stuff, or maybe Tesla to an extent? How often do you think, like, what's the sample size or the occurrence rate kind of those big moments? Like, are those once in a lifetime, once in annual? How do you view that?
They seem to be occurring with greater frequency now, and I think that GameStop changed, 2021, it changed the paradigm, right? Like I think it caught a lot of the market makers off guard, and you could just, we had congressional hearings about this stuff, right? And now people are smarter, there's more access to information, like you mentioned at the start, I was maybe one of two people talking about gamma flows outside of a couple of banks, right, in January 2020, and now it's kind of ubiquitous in some ways. And so people understand now the mechanics, and I think that people have better access to the tools and they're smarter. And so what that means is that when you get a FOMO, it's faster and it's bigger than they historically have been. And so you just look at what's happened after the Trump election, right? We've seen these cascading chases into different products like Tesla and MicroStrategy and things like that. And so I think what used to be kind of once in a year events are now like once a month events that you can find, kind of across the spectrum. And what I think are the best trades, or what I oftentimes think are the best trades, is when I can find that there are these call flows that are creating excessive demand. And what I think happens in those situations is market makers are now kind of hip to the game, right? It's like, okay, everyone on Wall Street Bets or Twitter is suddenly chasing this name.
Right.
And so what they do is they react by jacking the implied vols up. It's like call skew jumps really fast, right?
And how do they do that?
Jump,
What's their mechanism
in a
for
major
that?
way. Yeah, and the reaction function seems to me to be a lot faster now. And so I love those situations because I can see call positions coming in. I can see people are buying calls. I understand why vol is going up. And it's a lot of time just a function of demand, right? Ever since there's been tulips for sale, right? People chase this stuff, prices get crazy, and then things tend to mean revert. And so I think that in the option space, we're able to express an idea that vol will come in a way that you really can't in stock, right? Like you don't want to short MicroStrategy, but do you want to, maybe a put isn't good, but you can buy a put for fixed risk, right? As an example, and you can you could trade ratios to bet vol comes in. You could do all these interesting things on price distribution that I think are really great risk reward scenarios. And I think my best edge is when I know it's just excessive demand and froth. I love betting against that kind of every time, right? There's situations where like in biotech there's some drug coming out or whatever, and so vol's jacked up. I'm like, I have no idea what's about to happen with that. And I don't need to, right?
You just know demand is outstripping the supply at the moment.
Yeah, and I think sometimes it's that way with earnings too. It's like, I don't know if NVIDIA's gonna have good or bad earnings, but let me see if there's an unusual move like we just had with Salesforce, right? And then after that unusual move, I can step in, and now that the event is out of the way, and structure a lot of interesting trades based around what vols are doing and the positioning that I see in the market. And I think that oftentimes people want to step in front and be like the hero, like I called the the big jump right, And I think a lot of times it's like, just wait to see.
Yeah, come in after the battle and pick your spot.
That's right.
When folks are ailing a bit. To that point, a kind of specific one on the earnings side, then I think you just answered it, but do you find yourself trading after earnings? Does the vol that comes out after earnings increase your odds of success when the vol generally is cheaper?
I think it does. Salesforce we're talking about yesterday, where the vol immediately comes down after the event has passed. Like there's absolutely that component, but that does not mean that there's not volatility to extract, particularly in the morning after. So with the short dated options in particular, I think you can get in there and be very efficient. And you don't have to delta hedge or do anything fancy. You can just trade straddles and strangles oftentimes, and that can work out. At the same time, there are occasions where you go into an earnings event and the call skew is incredibly, high, or the put skew is incredibly high because the market is anticipating. Like we saw this in NVIDIA, right, over in like February and April, where everybody and their brother thinks, knows the earnings are going to be amazing. And so what happens is people start to skew the distribution to the upside too much. So even if the earnings are the best earnings you've ever seen, they can't possibly meet, the expectations that people have, right?
Yeah.
So that might be a situation go, okay, I'll actually trade in front of earnings because people have bid up the price of these options to just such an extreme, and there's this obvious skew.
I mean, it sounds like you trade single stock. You see more opportunities maybe in single stocks than at the index level, and I guess that would make sense because you have more opportunities for outsized moves, which is when the gamma stuff works best.
Yeah, and I think a lot of times S&P is my bread and butter because the options market's so large there. It's the biggest options complex far and away. But if you look at this current environment, right, like the vol is very, very low. There's not a whole lot to do. We're kind of just pinning, or kind of this kind of a time where I think vol is going to start to shift, and so it's a little bit of a waiting game. So then I'll start to look around and see, okay, is there a situation where I know the options flows are large, I know the vol is really shifting a lot, and those are the names that I like to go and play in, right? So like we talked 20 times about MicroStrategy today. I don't know anything about the Bitcoin. Trying to think of what the term that he used for it. What Michael Saylor's doing and all that sort of stuff.
Oh yeah, there's a Bitcoin treasury that he's making.
Bitcoin treasury.
Or his beehive or whatever, the hornet swarm. Yeah, it's a Bitcoin treasury. Yeah.
Yeah, it's very emotional, and there's so much talk about it and all that, and it's an interesting scenario because it's stock up, vol up, right? And so the scenario is, well, if the stock starts to come down, then vol should start to contract. And so, there's these interesting trades like 1x2s and things like that you can start to structure to set up those positions. And because things are so volatile now in this moment, it makes it, there's a lot more action there, and so there's a lot more trades to be done versus like you're going to trade the S&P right now with IVs at 10% and my catalyst isn't for another week, i.e. options expiration. There's just a lot less to kind of be done in that space. So
yeah, it's lower stakes. Where it's your buy-in can be big, but that's the only way you're going to get a lot of big return nominally, whereas you go to somewhere where there's wild action, MSTR and others, then you're going to there's more juice to be squeezed. Do you think I don't know how much this is options related, but because of the options power, in addition to the financial leverage of MicroStrategy to the underlying, is there an analog here for Gamma itself that like MicroStrategy could start moving Bitcoin?
Yeah, there's this interesting thing that really showed itself in NVIDIA over the summer. And you saw it in Tesla a little bit, and now you see it in MicroStrategy, where there's this financialization of everything. And what I mean by that is, a name gets a lot of attention, so what do? We're like, well, the options complex is really big. You can see that in daily options volumes. But then these guys roll out ETFs, and they roll them out like hotcakes, right? And so if you looked at NVIDIA, for example, I know this because I recently did a big study on it, there's 523 ETFs that have NVIDIA in it. And so when NVIDIA was really moving, you get the 2x NVIDIA ETF, the 3x NVIDIA ETF, right? And what I think happens is these derivatives oftentimes have to hedge with shares, right? But the amount of tradable float, like the amount of shares that are actually available to trade, starts to shrink because there's all this kind of systematic demand from options hedging flows and these other ETFs that I think you end up with a situation where there's just not much liquidity in the stock, and then that makes volatility go up a lot faster, right? And so you see that in Tesla, and I think that's what we see in MicroStrategy now, where you have 2x, 3x MicroStrategy ETFs. There's the call overriding MicroStrategy ETF, and that's not a big cap stock, right? But you look at what the biggest volume is on any given day lately, and it's MicroStrategy, right?
It's
so
it's huge. It's
it's
punching
massive.
way above its weight.
Yeah, you got these these convertible bonds, which I have a pretty limited understanding of how those work, but I know enough to know that there's hedging demand associated with that, right? And so the point is that these things are very financialized, and a lot of times people want to say, well, retail is the one doing this or that, the other thing. Like this morning, Friday call sellers came in and slammed MicroStrategy, $50 to $100 million worth of premium sold there in the matter of like 20, 30 minutes. Those are massive dollars for a small cap stock. And I think almost all of that is just systematic, a systematic function of these ETFs and these leveraged products that come out. And so to your point, that is all in a way just gamma trading, right? Because if you have a convertible bond and those big convertible bonds out there, well, they're just hedging, they're trading gamma around that, right? These leveraged ETFs, there's gamma around that, and so I think it can really exacerbate volatility in some of these stocks, and I think that only gets more extreme as we get more ETFs and more productization, I guess, of markets.
Hey Brent, great stuff. Thank you very much for your time. Thanks for being here. An excellent addition to our discussion, and we'll definitely do it again.
Love to. Appreciate the time.
Absolutely. Really smart stuff. Great way to explain the situation in a real-time impact for MicroStrategy, and also the backdrop here of what we're actually talking about with this stuff. Really good color from Brent Kochuba, founder of Spot Gamma. Thanks a lot, Brent, for joining, and thank you for joining me for Gamma On. Tune in every week for new episodes, and make sure you subscribe on our YouTube page for the full series. I'm Oliver Rennick. Thanks for joining.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Welcome to Gamma On, Episode 7. I'm Oliver Rennick, lead anchor of the Schwab Network. Thanks for joining us throughout this very fun journey. We are more than halfway through using second derivative analysis to amp up our knowledge and ability as traders. Today, given that we are based in Chicago, we have another special guest. Henry Schwartz joins me from the SIBO. He's a VP of Global Client Engagement. And of course, he in some ways represents the home of much of what we've been discussing throughout this podcast. Henry, great to see you in person.
You too, Oliver. It's great to be here.
We've been talking for a while. You've been doing hits on my show for a better part of several years. And of course, during that period, the proliferation, the beginning of the zero-day options market is something we've spent a lot of time talking about. That's going to be driving force for our conversation today. But I also kind of want to just sort of start with your experience and background. We've got a lot of data that you bring to the table all the time from SIBO, so you guys have so much good stuff there. We're going to kind of get your thoughts on some of these gamma principles and how much they really matter and how much you guys think about them at the SIBO. But first, kind of tell me about your background and how you got into the SIBO and here in Chicago.
Sure. So I've been in the business for over 30 years. I actually started as a runner on the SIBO floor in the 90s.
Beautiful.
And so it's been kind of like a big circle. But I traded for a market maker for about 5 years, worked for 3 different banks in New York City. And then about 15 years ago, I started a market data company focused on option flow analysis. And then SIBO actually acquired us during COVID, and so in 2020. And so I've now been with SIBO for about 4 years. And, it's an amazing company. We were the first options exchange, and I spend most of my time digging into options data and different ways to use it. And, the way that this market has evolved, that we've been talking about, it's just kind of incredible, the amount of activity, the amount of data to dig through, and then the zero DTE phenomena really has been one of the biggest growth drivers we've seen in decades.
I think what gives us some kind of overlap in the 0-day conversation and the gamma conversation, there's a lot in that Venn diagram that meets in the middle. They are like the way 0-day is kind of smoothing the vol surface with more ways to chop up exposure in markets. Where do you kind of view that overlap of 0-day and some of the gamma stuff that people talk about?
Well, it's interesting. Like positioning, right, which is really what we're talking about, has always been an important factor. And then, as this market has, evolved, and now you do have daily expirations, and we spend a lot of time, reminding people zero DTE options are nothing new. But the fact that you do have a daily expiration cycle available, that's new. And paying attention to positioning has always mattered. But when I worked at banks, you would know, a certain client was long a certain block of options, right? And on top of that, you might even know kind of what kind of account it was, right? If it's a fast money hedge fund, you may kind of treat that information a little differently, right? You may be very wary of that kind of position. Versus maybe somebody's overwriting, right? And it means they like the stock, they just kind of want to pull in a little income. So that kind of a position doesn't have the same information in it. And so,
that's a great point.
So where we've gotten to now, especially, there is kind of a whole specialty. In fact, there's people that trade zero DT options exclusively, right? And there's strategies that really, that are, specifically, they may be just a few hours in length. So. Looking at the data, right, we see how much activity is trading. We see, SPX was the first product to have daily expiration cycles. We had Fridays for almost 12 or 13 years, and then we filled in Monday, Wednesdays about 6 years ago, and then in 2022, the Tuesday, Thursdays were filled in. And there was a weird tipping point. I think even SIBA was surprised by the fact that the option volume had always been heavier on Mondays, Wednesdays, and Fridays. So when we decided to add in Tuesday, Thursday, it was like, well, there seems to be a lot of activity going on those days, so let's fill it in. Mm-hmm. But the fact is that made some strategies possible, like daily strategies that just really people weren't even doing when there was Monday, Wednesday, Friday. So now you have almost half of the activity in SPX, which is the biggest index product, 1.5 million contracts a day trading in the 0-day. That's half the activity. But you also have an enormous amount of 0-day flow in comparable products, SPY, the NDX index, Qs, even Russell.
You mentioned something I want to come back to for a second, which is about how would you kind of generally characterize, you think, sort of the transparency of the data for those who are trying to now take these data points and use them as part of their trading strategy. People who look at gamma exposure, people who look at open interest levels, flows, stuff like that. How much do you think that really tells us, and what information don't we have when we're just looking at the screen for those numbers?
Right. Well, so the 0-day options really are very interesting because of the fact that most of the activity in the dailies takes place on the final trading day. And the way that options are cleared through OCC, open interest is only distributed once a day, meaning that if most of the activity is going to happen on the final day of trading, you actually never get any open interest figures from the clearing corporation. So what you have to kind of use a couple of different approaches. And one is, as you said, you can see the activity, right? You look at volume, or you look at time and sales, and you can see, okay, the 6,200 puts that expire today, we see the activity, right? We see 80,000 of these contracts have traded. But what you need to do, what participants do is employ a bunch of different approaches to really try to figure out if there's an imbalance. And that's, the concept of gamma, is about an imbalance. It's about, is one side hedging the trade dynamically, which may have some market impact, and then if so, which side, right? Because, if you think about it, and there's a lot of discussion about this, especially with the ETFs that sell optionality.
Right.
If there's a lot of supply of options into the market, and the people that, the groups that tend to do the dynamic hedging are going to be the market makers and the liquidity providers. And so if there's a whole bunch of options being sold, then they're long a bunch of options. That gives them positive gamma. And so if the market starts to go up, they have some futures to sell or stock baskets to sell or whatever. And the market comes back down and they have futures to buy. And that tends to be a stabilizing force. And there is academic research on this. People really, it's all pretty new, but people are trying very hard to figure out what's the impact here. So, if you kind of take that concept down, and then, the vice versa, if the order flow is buying options, especially if it's buying a lot of options, then the dealers are going to be short gamma. And so if the market goes up, they actually have to start buying futures or S&P 500 baskets or something. And that's kind of destabilizing because the higher it goes, the more they have to buy until that strike's kind of in the money. So
that second scenario is seldom compared to the first scenario, right? For the most part, it's a stabilizing force. Is that fair to say?
That's what we've seen. The new customer base that's been kind of pulled in, and also these new structured products, the yield ETF universe, which is, kind of a gold rush of its own, are premium sellers generally. So because they're coming in and selling options, now usually they're doing it in some sort of capped fashion, right? Maybe they're selling a vertical put spread and vertical call spread, the condor selling community. We see in the data there's in the first half hour in SPX at least, there's about 50,000 contracts that are sold in the form of condors. Okay, so if the market's at 6,000, they're basically selling a put spread that's slightly out of the money and a call spread that's slightly out of the money. So the liquidity side of that is long options that are slightly out of the money. And then if the market moves a lot further, then you start to hit the caps on those. Now, the truth is the market, we really haven't seen too many big moves.
Right.
So in general, it has been a stabilizing kind of net flow.
Sure.
I think it's a good idea to pay attention to kind of what people are doing and try to get the best possible read on okay, market's at 6,000. We can see in the data that there's a lot of activity, say at the 5,900 and the 5,800, and then you have to go in and try to figure out, okay, are they selling the 5,900 and buying the 5,800?
That's where it gets trickier.
It's where it gets trickier, but the data can really be helpful. So there's a data source that Cboe has called the Open Close data set, which actually is a dissemination of customer side for every contract in 10-minute intervals. And you can actually just basically you can net that out. Say, okay, we see customers bought 6,000, 7,000, 8,000 of these contracts, but they also sold 5,000, 6,000 of these contracts. So there's the net that the dealer is potentially hedging is just that remainder. And so what's interesting is, and I've looked at this data, even on days where there's 110, 120,000 contracts trading in a single contract of 0-day, if you do customer long minus customer short, we rarely see positions that are very big.
Okay.
I'm talking like 5,000, 6,000, 7,000 contracts. And now it does get a little bit more complicated because you actually, to kind of get the best view you possibly can, you want to look at other products, right? You want to say, well, okay, fine. So to the downside in SPX, I can see there's 6,000 contracts net. But you do have to realize there's comparable products. The liquidity community is very sophisticated in how they're laying off their risk. So it's hard to get a perfect read, but you can get a pretty good estimate. And then and then as we were talking before, you're also trying to kind of anticipate how are other people looking at this information, right? And if there becomes a big focus on wow, let's say the market's down 2 or 3%, hasn't happened in a while. But if the market's down sharply and there's a large position and people are starting to pay attention to it, it's almost like game theory.
Yeah,
people are like,
it's self-fulfilling kind of reality.
Exactly. And then okay, well, what are people going to do around that information? And so people are kind of trying to stay one step ahead of the competition.
You sound a lot like what we heard from Devin Anderson from Convexitas, also a local Chicago shop, and his experience at banks as well, which comes back to your point about the multiple products with which a big market participant can choose to lay off risk. We might look at the notional exposure from the gamma perspective on a position, but we don't know what else they have on their books. To his point, what other customers or clients may be open to take on that risk, which would then lessen the degree to which they have to kind of chase their tail, which is what we're kind of hoping for as traders, that maybe these big levels or these big participants get kind of pinched, and if I'm in the right place, I can ride that push. But to your point, a lot of times the actual meaningful exposure is probably lower than what we see, and compared to the rest of the market volume is largely going to be something that's not a major impact, I don't think.
Yeah, and we also, I mean, in the U.S. we have kind of an advantage in that most of the activity taking place in derivatives is listed, right? It's not a big OTC market in the States to begin with. And on top of that, when you look at the 0-day, because it is a very heavily retail and market maker kind of usage, there's actually not a lot of firm activity or even really big hedge fund activity in the short-term 0-day stuff. There's some, but so because the data is kind of what it looks like, you're able to see most of what's going on. And so, exactly like you're saying, there is like, if somebody buys some 0-day options in SPX, the liquidity provider who sells them, okay, they're managing their risk. This is what they do for a living. So, they're not likely to panic, right? They're doing things very methodically. Right. And on top of that, I've talked to some of these liquidity providers. They tend to run a 0-day desk. That's all these, a team trades. They have very strict risk limits. And so we actually see it in the data. If you look at one of the data sets I like to look at is the clearing volume by account type. So it's customer volume, firm volume, and market maker volume. And generally, it's kind of like, 40 or 50% customer, 10% firm, and 40 or 50% market maker, because in general they're kind of offsetting each other. In the 0-day, which you can look at it individually, we actually see more market maker flow in 0 days like 60%, which means the market makers are actually trading with each other. That's for basically because they're laying off risk. They're being very kind of strict about how they're, you can't have more than 800 contracts of strike risk at the 6,200 line. So they just go buy it from each other.
Which is why it's generally more a stabilizing force for the most part, which kind of then brings me back to something else he said, which is that if enough people are looking at something, though, and then sort of exogenous events happen that start to push the market in a direction maybe that those big dealers were not prepared for, it does start to get them in sort of a negative gamma situation, or it then brings up those opportunities, those moments where maybe this does add some convexity onto the market, where you can get faster moves that can turn cheap, low probability contracts into suddenly expensive, higher probability fun swing trades, which is why I think people look at this, but that ultimately is kind of just a different version of what people are trying to do already, which is figure out what levels matter, where we might be going. There's a lot of overlap, I feel like, in the way people think about technicals. If somebody's looking at, all right, there's this big call wall or put wall somewhere, it's similar to the way I think technicians would feel about like a moving average or something, or maybe that's a little bit older, but if you think about like how people pitch stuff in the 80s, 90s, when like people were really getting in day trading for kind of the first time, there are all these levels and technicals, and if enough people are looking at them, and the hot technical measure is, that can create a real force.
Well, it's true. I mean, the concept of kind of like a crowded trade, right? Even in the institutional world, like, people look at a trade, they're like, wow, if there's, if the trade starts to kind of outsize the market, that's where there's kind of an element of danger, right? It's
sure.
That's where we were talking a little bit about dislocations and kind of, what we saw during COVID. Like every once in a while, markets break. Usually it's temporarily. But so, a crowded trade where, there's basically just too much capital allocated to a single strategy. That's where things can get kind of weird. Now, I mean, in the S&P complex, I think we see about $2 trillion a day in notional value trading. It's an incredibly liquid product. I do think that it's important to keep an eye on. I mean, even at the simplest level, right? There's some people, there's some groups that trade with pretty simple rules, right? They're going to sell, like I said, maybe a condor. One of the reasons that we see the positions never get very big is because it's when anybody's trading a rules-based strategy, you can kind of anticipate what they're going to do, right? They sold this option for 70 cents, and if their rule is to basically take profits at a dime or stop themselves out at $2, if that option starts to approach $2, you actually can kind of anticipate some activity, and that is where that's where kind of the gamma concept kicks in. Is
it's fun.
Gamma lets you quantify how much dollar value of rehedging is going to be necessary at a certain market level, and then kind of having an understanding of what trading strategies are being used. Gives you a good chance to anticipate activity. But I do have to say that we don't see just one kind of flow. One of the reasons this zero-day activity is so massive is there are certain types. There's premium harvesters, right? People that do just what I was saying.
They want income.
Yeah, they want income. They have a rule-based approach. They back test it. They like the way that it works, and then they literally might just program it up and automatically execute it on some sort of a schedule. But then you also have kind of the other side. People are coming into these products because they love the kind of the ability to kind of tactically get in, and they're so liquid and efficient that and that's one of the most important things is they're kind of overcoming the bid offer is you're talking about, at least in SPX, a $6,200 index. These options are a nickel wide, and literally they're trading like water. So people can get in and out of trades, and they don't have to get over this big hurdle of slippage or bid offer. So the fact that you do have buyers and sellers really on a continuous basis is kind of why we see, almost without fail, 1.5 million contracts in SPX that are zero-day trading. We see 3 or 4 or 5 million in SPY. But the other thing that's important in the zero-day is if you think about like August 5th, right? That morning when the Nikkei was down 12% and there was some panic going on. The zero-day activity that day was actually really light.
Interesting.
And we actually talked to some participants, and they said, we're not going to trade on a day like that.
Okay.
And that's what's so interesting, and that's actually one of the reasons. Yeah, it's like, no, we're just going to sit it out. And they do, and so that's a really fun, interesting dynamic because, people talk about the dangers of selling puts, right? There's, people certainly can get hurt being short options, but if you kind of get to decide, I'm going to trade today or I'm not going to trade today, nobody can really predict the future, but you can look at market conditions. You can look at, there's a Fed meeting, the Fed announcement at 2 o'clock today. I'm not going to put a position on through 2 o'clock. I may put something on in the morning and close it at 1 o'clock. But the thing is the ability to kind of limit your activity, that kind of trading has really attracted a whole new community, and that's why we see so much activity.
That point there is important too, because one, the idea that when there's a big market event, there's sort of like an adverse event or a negative event, it kind of makes sense that people might then actually think about longer term contracts, because then it changes, it gives you a clear sort of expected return then, because things usually don't go down. Things usually are not volatile. So you're probably more comfortable taking a little bit more duration risk, if you will, on some of those reset days, kind of like a buy the dip notion in a way. But the other thing too is that I kind of described it earlier as the vol surface being smoothed a little bit, and I still kind of have trouble pinpointing the description of what I'm trying to say with that. But the idea is that the more liquid a market is, the better. Generally, the more price is discovered, the more literal options there are, then the more likely you are to find the correct outcome for something, a very specific outcome. It's kind of analogous to like if you were an active manager versus somebody that can only rebalance once a quarter, once a year. Like that's probably not going to be the most efficient way to get exposure to things and pick up on the opportunities in markets that go by very quickly. So I feel like the tool in the belt for the 0 day is very much in that realm. But then it also kind of begs the question then, well, like, how much more could we chop this up if we wanted to? Like, is there a way to go intra-daily?
There was some discussion about doing options that expired at noon. I doubt that we're going to see that, just because there's a little give and take in terms of creating products that people want to trade that really do meet some sort of need, but not fragmenting liquidity and the activity too much.
Okay, yeah.
And so, like, I absolutely agree with what you were saying in terms of the transparency that you get by having.
But you can't fragment down to infinitum. Or else, what are we doing?
I think that, and on top of that, I think that the settlement process would start to get really challenging. Right, so I think that the industry has kind of hit this sweet spot where people are using 0DTE for different approaches. People understand them. there's some discussion about short-dated contracts in some of the single stocks, but right now it's indexes and ETFs, and really just the super liquid ETFs. But the fact that, what was interesting going into the election, right? You can use the volatilities of each daily expiration and isolate the forward vol, which basically let somebody, actually I use ChatGPT to help me with the calculation. But if you say, okay, I have these implied volatilities of the next 2 weeks, and I want to know what the implied volatility for this one date is. And so for election day, we could see that the implied move was almost 2%. The market was pricing in a 2% move. And you had that perfect information in terms of what the market expectations were because you had an expiration day, each day before the election, and then the day following the election, and you could basically isolate it. And it's the same thing we see with stock into earnings, right?
Yeah.
But into earnings, sometimes you're like, well, earnings are Tuesday and the straddle expires Friday. So you can still imply a move. It's not as accurate, right? You start to have to make some more assumptions to kind of reflect the information. And the truth is, like, having this I spent decades kind of fitting volatility surfaces.
Yeah.
And if you had a June expiration and a SEP expiration, and somebody said, well, I want a July contract. Like, well, there's no options trading in July.
How do you price that?
I'll do some sort of interpolation to get the best possible estimate. But now you have the market, basically coming in with that kind of collective information. If it turns out there's an event in July, it's not going to just be some smooth interpolation. It actually has to reflect the other information. Maybe there's maybe there's an election.
Yeah.
So
it's a great point. I love that.
The fact that this, that we're now at a I think there's 90 expirations, between now and the longest dated, and that you get a smooth liquid volatility surface, kind of across that whole spectrum, really does that gives you the market expectations for what to look for.
Fantastic description, and also kind of the utility of that becomes very clear. You've got some good stats, some numbers that I want to point out here. It also harkens back to what you said earlier about how most people are using these. Customers, according to your data, generally entering limited risk positions. And this is for zero DTEs or just general?
For zero DTEs specifically.
95% are either buying or selling limited risk spreads or buying calls and puts outright, of course, where your risk is defined as well.
Right. Yeah, I mean, that's that's a side effect of the fact that, your margin is pretty high if you're going to sell uncovered or cash secured options. But also that that you have so many strikes available that it's easy enough to cap your risk. And in many people or traders are kind of looking at these as what's funny is you can take all the option math and the binomial and all these funky approaches, but with a zero DTE contract, it's pretty simple, right? It's here's the price it's trading at. Basically, where do you think the underline is going to be in 6 hours or 3 hours or 2 hours? So the math actually becomes much simpler. And so a lot of people are looking at these as like, look, this is my bet. Is this options trading for 40 cents? Do I think that the chance of the underlying, of that contract being 40 cents in the money or more is a good risk-reward trade-off for me? And so that's the people just buying, using premium to buy and effectively take advantage of the leverage that's built into an option, right? I did some rough calculations on kind of leverage after hearing some people talk about it. And if you basically just take the straddle price divided by the delta, that's a good estimate, right?
Okay.
And so the leverage in a zero-day option, it starts out, you're paying for this leverage in decay. Starts out around 300 to 1 in the morning, gets as high as 1,500 to 1 towards the end of the day. It actually kind of gets infinite by the end, right?
Sure, yeah.
A 20-cent option could be 100 delta.
Vertically.
Exactly. So, but that there's kind of a it's a double-edged sword.
That's why people like them.
Exactly. It's why people like them.
Yep. Especially like the day traders really like them, and sort of the individual traders, because that's where you can put in a small amount and potentially get a lot.
Yeah.
But your probability is pretty low to get that trade in. Whereas the other 95% of the people you're seeing in your data are doing basically opposite.
They're saying, especially if you're gonna be trying to attempt to harvest premium, then you're to say, here's my my reward is the premium collected, and my risk is the distance between strikes on a vertical. And it's actually, that's one place where index options really have an advantage over physically settled. Is that, index options are really simple. You got the settlement price, and then, it cash settles. There's no question about things moving after the close, or things pinning to strike, right? Which can happen in an ETF. And so that can make a vertical spread a little bit gnarly in terms of like, well, it's 30 cents in the money, so one side's going to get exercised, but then after hours an ETF moves, the market keeps trading after 4. And maybe it means you have to pay very close attention to kind of what the market's doing after the close. So in the index world, it's almost like a binary event. Like I sold this thing for 50 cents. I know my risk is $3 or whatever the strike distance is, and there's not really any way that can be very different, right? So that's kind of the way we see people coming in with capped risk strategies. They sell an option, they buy something further out of the money. And then they have rules or some approach to kind of take things off that are profitable. They may leg out of it. So we actually see more spread trading in the morning and then more outright trading towards the end of the day, which can be people taking profits, basically closing the short leg.
By then, some of it has been closed out.
Exactly. And then it's also, we see people stopping themselves out if something does go against them. But the one thing is the strategy is very consistent. They come back day after day and do it. In general, it's a very fairly priced kind of, the market does reflect the risk. So if you kind of, bought an at-the-money straddle every morning, there's days you make money, there's days you lose money, but really on the long term, it's almost zero. So, which is kind of what you'd expect if it's fairly priced. There's periods where that's a losing trade for, 15, 20 days in a row.
Right, but that's a rare streak.
Exactly. And same thing on the other end. But really, the market's pretty good at kind of reflecting the risk.
You don't often get a lot of 15 coin flips landing one way in a row.
Exactly, but it's possible. Cards,
and you see it a lot. You see it way too much. We're going to definitely continue our conversations on the show because we love having you on and always appreciate the insight and the data you guys bring from SIBO.
All right, anytime.
Absolutely. Thank you very much. Henry, great conversation. Henry Schwartz, fantastic stuff. A big thanks to Henry Schwartz from SIBO. Really great commentary, great data, and a great understanding of the subject matter. Really enjoyed that conversation. Feel like we could keep going. By the way, Devin Anderson from Convexitas will be on in the next episode. I hope you enjoyed the teaser for a bit of a contrarian take we're going to hear from him on the subject. Don't miss the full conversation right here on Schwab Network's YouTube and Spotify channels. And be sure to subscribe. You can find all episodes on schwabnetwork.com. Thank you for tuning in. I'm Oliver Rennick. See you next time. Welcome to Gamma On, episode 8. We are in the thick of it. I'm Oliver Rennick. I'm the lead anchor at the Schwab Network. And today we've got a really fun conversation as we're going to take a little bit of a pause, assess what we've learned so far, try and figure out where lines need to be blurred and which ones need to be carved out a little bit more distinctly. In writing, the way I learned it at Bloomberg, you always have a to be sure graph when you're writing a story. And in that to be sure paragraph, you're basically taking the main theme that you've had and offering the counterpoint. So today we're going to do something like that. I'm going to be joined by Kevin Green alongside with me, our contributor on the Schwab Network. And our guest today is Devin Anderson, co-founder and CEO at Convexitas, a Chicago-based firm that specializes in volatility strategies. And Devin, it's great to see you here. You're the other half of Convexitas. We've got Zeb Francis on our show a lot. It's great to have you.
Yes, sir. Thanks for having me.
Pleasure. And you've got a really fascinating background that is very relevant to kind of understanding what happens on the ground, what happens on the decision-making tree of a big bank that is potentially being a major options market maker, dealer. Tell me about your background and kind of weave that into how you guys started Convexitas. Let's set the stage there.
Sure. So I worked at Deutsche Bank for 15 years in a variety of roles. Most of that time was in the flow facilitation business. Well, I should say about half of that time was in the flow facilitation business. So the business of taking large block orders, committing a price, you may or may not have certain market risks, which is exactly what we're going to talk about. The ways that you mitigate those, the ways that you lay it off. Those, that was my life for that period of time. Then I actually moved on to the more structured part of the derivatives marketplace in the institutional world. But coming out of that, Zed and I just see this huge opportunity in wealth to bring the quality of strategies and the discretion and really the strategies and professionalism that you would only really find in institutions and bring that into the wealth channel with really world-class option strategies. So that took some really significant investments in operations and being able to take what you might do as an institution and bring it into wealth with that level of sophistication. But we've done it, and that was really the foundation of Convexitas. We looked around and said, there's a real space here to bring up the sophistication a couple clicks.
The word, I want to make sure that I understand it, facilitation. Break down that kind of Wall Street lingo for me. What does that mean when you're facilitating flows?
So the displayed liquidity, on your terminal, okay, it's no different for retail folks than it is for institutions. You look at some option and there's, 20 on the bid and 20 at the offer, right? If you're a big institution, you have 10 or 20,000 options to trade. It's not like the guy sits there and picks at it 20 at a time, right? He picks up the phone, he calls a bank, calls a market maker, and they make a market on the whole size. And now the client's done, right? That asset manager who's got 20,000 options trade, his trade's done at a fixed price. And now it's just a question of what does the market maker do with this block of risk? And what happens after that point is it directly impacts everything you've been talking about on this series. So I've been able to watch the first 4 episodes.
Nice, we appreciate that.
So
love that. An educated man.
Yeah,
always welcome here.
So I'm in a position to react kind of to my experience, what actually goes on in the process, and then kind of contextualize some of these tools like the GEX index and some of the levels. But I also want to talk about, impact, right? It kind of has 3 dimensions. There's the amount you have to trade, there's the liquidity that you have available to trade it, and then there's the amount of time that you do it in, right? So it's 3 dimensions. On those first 3 or 4 episodes, I heard a lot about the size, right? Nothing about the available liquidity, and a little bit about the time, right? So I think we kind of need to round that picture out.
Okay.
And then we also need to talk about the difference between what happens when a trade initially happens, what happens when that market maker makes a firm price for some asset managers or some investors' total size, and then how does that show up as market impact? And then how does the second half of the conversation is what is the market impact of the ongoing risk management, right? And those 2 things get a little muddled together sometimes, so I want to cleanly separate those.
Sure.
And we can kind of take down each half of the discussion.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Give me some historical context first. And as I mentioned, my colleague Kevin Green's on the line with us. He's joining us, so we'll bring him in, and he's going to be chiming in along the way. The background from your time at Deutsche Bank and the progress within the options market since, the big volumes, kind of the COVID, I should say, I was going to say bomb that hit. That's not a good one. The kind of COVID revelation of staying at home and options trading that kind of brought this to the forefront of the world in some sense. Has that meaningfully changed what happens on the ground from your time, or were all these concepts under discussion?
Yeah, so
then
it's complicated, but the as you say, the big change of the market microstructure in the time that I came into this world in 2005 to now has been the part that matters to this audience has been this revolution in retail trading, particularly in very short-dated options, right? So that's for sure is the big trade. Now, let's say that would have happened right after the financial crisis instead of during COVID. Would it have changed our job? I mean, a little bit, but not much, right? What really has changed a lot is that since the financial crisis happened, we've had a big change in regulation. It means that banks take less risk, and you've had market-making firms, so the Susquehannas, Virtus, Wolverines, Citadel Securities of the world, right? The independent, less regulated market makers and broker dealers are now playing a far more significant role in providing liquidity when it was just really upstairs banks in that role previously. And those folks are interacting with that short-dated retail flow through internalizers and a bunch of different means, but they're interacting with that flow electronically. So that wouldn't really have changed the pieces that we're going to talk about. I think it's an interesting discussion about when it comes to the 0DT and the short-dated options trading. Does that show up in a meaningful way in terms of the total amount of derivative exposure out there that could possibly push the market around? That's an interesting conversation. It goes in the ongoing risk management bucket rather than the initial facilitation bucket.
Which then is a little bit more live and more kind of, I guess, a little bit of game of ping pong that can happen. I mean, part of the reason we talk about this stuff is because it happened in a few specific examples, think like GameStop and meme stuff, where people realize like, okay, there are these forces out there where if pressured right, maybe we can kind of ride that wave with some of these big players. Do you believe there is an ability kind of for the average person to at least use this as a tool in their belt to better understand what's happening or better kind of tell the weather of the market?
Well, we'll just be clear on what this is.
And there I'm kind of talking about just like what we've talked about before, kind of the gamma exposure generally. Like,
so, I mean, most of what I'm going to say today is that it matters far less than I think people are representing it.
Okay,
and I'm going
that's the to be sure
element. And I'm going to give you some data to kind of to support that, but also more importantly, some theory as to why. Right, some of it's market structure and just some of it's some basic option stuff.
Okay,
but can it matter? Yes. I'll tell you where it has always mattered, and it's just not debatable. Is in single stocks, actually. So particularly mid-cap and small-cap single stocks where there's a lot of overwriting activity, a lot of people selling calls, okay? So you don't see – we used to call this pinning, okay? I mean, people still use the word pinning, but you can see it in single stocks and you get this dampening like sine wave going into the close on the intraday chart, right? So like the stock will literally go, through a big round number, back down, and then in this kind of dampening wave, and then pin right on the strike.
Right.
So we used to see it a lot. When I was on the sales desk, I saw it a lot in things like, thinly traded REITs. Some guy's got a portfolio of REITs. He also wants to sell some calls for a little bit more income, but the size he's doing is probably a little too big, and every once in a while you get a pin. Right? So it matters in single stocks. In my opinion, and I think the data that I'm going to share with you supports, very rarely matters in index. It's not impossible.
Okay.
But this isn't something that, I think needs to be part of your daily process until the numbers get very, very extreme.
Okay.
And we'll talk about why that is.
And when you say extreme, are you talking about in terms of just notional exposure? Are you talking about a way in which they change, a rate of change?
Yeah, I'm talking about
when liquidity is low, perhaps.
I'm talking about the total exposure of GEX needs to be kind of at its extreme maximums before we even really need to start worrying about this.
Okay.
So in terms of time, we'll talk a little bit. I did a little analysis on the history of GEX and its levels, but GEX over the last 5 years at 24 billion of GAM exposure is its maximum, right? I mean, you're talking about an S&P futures market that averages 370 billion a day, right? So I don't want to get all the way there. I mean, it's more nuanced than that, but I definitely want to talk about kind of these, liquidity. It comes back to this thing I said first. It's total to trade, available liquidity, and time you have to do it in. And as you pull on those three things, the answer can change. But if you push the exposure fast enough, far enough, right?
Right.
You can have a situation where it could matter potentially.
Does it depend on whether?
But we're talking about maybe once a year. Okay. Right. Like this shouldn't be something you're staring at every day.
Right. Well, a lot of people are thinking about it like on expiry by expiry. KG's got a question, but one real quick for you is moments when it does matter. Are those essentially? Are you thinking about matter in terms of like having big effect? Because we also kind of have talked about how more often than not, these forces actually generally kind of compress and are something that are more setting kind of guardrails for the market rather than these big off ramps.
So to that point, just to give you a little preview here, when I looked at the GEX numbers, I was actually surprised at how often it's positive. It's a positive number. Something like 90% of the time.
Sure, yeah.
And in the last, when I looked at the kind of tried to compare it to the intraday liquidity, in the last 2 months, it's been negative only a handful of times. And we're talking about extremely trivial sizes, less than a billion, right? So you're right. I think I have quibbles with the methodology that we'll talk about that they use to calculate GEX. But if I just took it on its face as truth for GAM exposure, it's more often than not, maybe 9 times more often than not, dampening volatility rather than contributing it.
Sure.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more. with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. And I think that's generally the way we've mostly thought about it. KG, chime in. Where are you at right now?
Yeah, I'm right there with him in some respects. I would say on an intraday basis, I think these the levels that we do highlight here, I think they do actually matter if you're doing some intraday trading, and you could see areas of support and resistance that's there. It's not so much the mechanics of it, but also the fact that there's obviously a little bit more of a following to these different levels. And there's definitely more than just gamma exposure, or GEX, as he's kind of talking about, right? You have Vanna exposure, looking at vol exposure. You have Charm, which is time exposure. You have all these other different factors that are kind of in place here. But I think when we're talking about do they matter or when they matter, and the fact that we usually are in like a positive gamma territory, right? Market net is going to be long melt up. We rarely have a scenario where we're in these negative gamma environments where it could actually induce aggressive selling over a very long period of time. It could actually be a couple of days here, but everybody has their own different methodologies and what works for them. But I think there's definitely another piece there that Devin's kind of highlighting, that it's not only just these where the exposure is on an open interest standpoint or from a volume standpoint, but also the time that it actually does take and the amount of force that it takes to really create a reaction here. So Devin, kind of going back to what we have been kind of highlighting, and I know you have a couple of things on your notes here. When you are looking at vol structure, what are some of the vol inputs that you actually look at, or the structure inputs that you look at from an option standpoint to be able to help facilitate trades for either your clients or to structure positive trades to the upside or negative trades to the downside if you're looking at downside?
Well, I mean, I have to kind of separate facilitation from what we do now. I mean,
Sure, yeah.
Convexitas is an investment manager where we run a set of long vol strategies, basically tools for advisors that they can put in their portfolios, helps with liquidity. It's kind of smart on taxes. That's a buy side thing, right? In the facilitation seat, okay, which is kind of the context of what we're talking about here. What I should separate. When I say it matters, it doesn't matter. I'm talking about impact to the underlying market. Okay, it's like, is it impacting the S&P itself? Is it impacting some single stock, right? And I'm going to tell you that overwhelmingly the answer to that is no.
Right.
Okay? And like I said, we'll get there, but that's not the answer for volatilities in option prices themselves, right? So things like the $80 billion of derivative income product out there now are absolutely having an effect on option prices, on the surface itself, the price of options. So we're up at the level of option prices, not down at the level of the underlying. So there are having effects there, right? And kind of one of the fundamental precepts about what we do at Convexitas is that in order to qualify, if you're paying fees to a manager, what they should be doing is high quality options trading, which is about taking the biases that result in those options market and turning it into a strategy, right? So, KG, to answer your question, for sure, there are impacts in options prices. What I'm here to tell you is, I don't believe that there are meaningful impacts on certainly a daily resolution on the underlying at the index level, right? So that's the difference. But I think kind of to tell the story, you've really got to talk about, I hear impact questions kind of they come in two forms. The first is someone has a big trade to do and it's going to impact the market now because they're doing a big trade, right? And then it's this stuff. It's is the ongoing open interest having an effect, right? And that when it comes to that initial execution, when you do this GEX-like calculation on volume, that's essentially what you're trying to get at, right? You're saying, well, based on what's traded today, what effects might be out there, okay? So I think it's worthwhile because in all of these conversations, not just yours. I mean, there's a lot of this is gamma affecting the market stuff out there.
It's become sort of the popularized way to think about options.
I never, or is the big asset manager or mutual fund trade affecting the market? I never, ever, ever hear the stuff I'm about to talk about.
Okay.
And it's kind of perplexing to me as someone who sat in a facilitation role that you never hear about this stuff. Okay. So
what are those main pillars?
Yeah. So when someone, if big asset manager who has a mutual fund, okay, and there's several of them, turns or defined outcome ETF provider, right, turns up to trade, let's say they had a caller on and the market's now gone up and the call's in the money by a lot, okay? And so they've got like, a really big number, 12 billion of delta that's got to trade. Okay. So to roll their caller from their old one that has an in the money call to roll that to a new caller that is centered around spot again, all right, there's going to be 12 billion delta to trade. Okay, that's not debate. You can just calculate it. Like, that's a number. So it's not as if they just call up some dealer and they're like, hey, I got 12 billion delta to trade. What's your price? Right? Like, it doesn't work like that.
Okay.
When you have a couple $100 million of delta to trade, or maybe even $2 billion of delta to trade, the dealer will just make an outright market for you. And they'll say, we'll exchange the options with each other, and I'll just take that delta risk, and I'm going to price your option trade based off of where I can complete my hedge. Okay?
Okay.
So does that much make sense so far?
Let me ask it this way, because this is kind of what I was thinking earlier. Is the point here that this exchange, that this trade then, if you will, this delta cover basically, is happening at a level at which the market maker is not price insensitive? Because I think there's this point where the gamma stuff really starts to happen if the big player is price insensitive to where they're having to do something that maybe they were either
they're not price insensitive for
exactly
sure. Because you come to me with your call spread swap that I'm talking about. I'm going to be at risk on some amount of delta. I have to price the trade at the level where I can complete my hedge. Now, you got to remember, option markets are competitive, right? And the asset manager has a fiduciary duty to get the best possible price. So he's going to put a couple dealers in competition.
Sure.
Right? So you'd be amazed at how tight some of this stuff trades, actually, right? So, but they don't, when you get to the really big orders, the ones that get people's attention, the 12, 15 billion of delta on somebody's roll to trade, that's not what's going on. Okay.
They're not clamoring.
Yeah. They're not. No one's at risk on 12 billion delta outright that they have to trade in 5 minutes. Like it's just not how it works. There is a set of tools out there that they can use. There's a number of techniques that they can use to mitigate that. Okay. So one of which is this thing called the tied hedge exemption. So this is an exchange rule that says if you were the asset manager, Oliver, and I was the dealer, you and I can trade outright between each other. Okay, but you're going to give me the order. I'm going to notify the floor. I'm then going to go trade my hedge. Okay, and then as long as the options are still inside the bid ask, I'm going to present the hedge and the options to the floor before it goes on the tape.
Okay.
So you're still going to get your outright fill. Okay. But I'm going to be able to trade my delta, the thing that I'm at risk on, before it's presented to the floor, right? So before I potentially get run over on my execution of the hedge. So that's one rule.
Okay.
Never before have I heard anyone in this conversation talk about the tied hedge exemption. Now, this is one of the less popular ways to mitigate this risk, but it's out there. Another one is,
why is that? Is that just because it's so kind of inside?
It's a little risky to pull off because if your option, if you still have to print the options inside the current NBBO, that's the exchange roll.
Okay.
Which cannot happen, right? So you're taking some risk here that you would potentially have to further improve the price in order to actually get the trade on the tape. So this is like exchange mechanic stuff.
Okay.
So the tied hedge exemption is just, but you never, like, again, my point is that I just never hear about it.
Sure.
It may not be the most popular thing, but it's certainly a tool that gets used. Another thing is you can trade over the counter first. Okay. So you can just call me and we can do a bilateral trade of my call or swap. Now I can go trade my delta in the market over a whole day if I wanted to. And then I'll adjust my option prices to where I get my hedge done. And now we've got an over the counter trade. Well, then there's a process called an exchange for physical, or actually I think in this context we'd call it an exchange for risk, but an exchange process that allows me to swap my over-the-counter contracts for listed contracts. So boom, my trade would just appear on the tape and it would look like an outright trade and people's hair would be on fire because they go, oh, look at all this huge risk that just hit the tape. But no one's trading anything. It was already traded before it ever went on the tape.
Will it still appear as the notional gamma exposure, like when we're looking at it?
Of course. Yeah, you'll see it in the volume. It'll look just like any other trade.
Okay.
If you were just looking at the tape, it'll look just like any other trade.
Yeah.
But actually, the whole thing is already traded.
It's already, right, I see. So we're thinking about it as this kind of big block of like money that's got to move around or be
The reality is it could have already all traded.
Okay.
If we went down the EFP road, right?
Okay.
And then the SIBO quite smartly in 2020 launched this thing called the DAC, the Delta at Close Order. Okay. So now all the defined outcome products actually use this. In this case, you and I agree to a trade. We agree on our whatever our role is. We agree on a delta to adjust our prices at an initial reference of where the market was when we agreed on our trade. And then we just delta adjust the prices to whatever the close happens to be. So I get my hedge done on the close, and then we adjust the option prices by however the market moves between the time that we agreed to, wherever we agreed to, and where the close happened to be. Now, the advantage to that is that the close is hyper liquid, and in the case of the X&P, you have this 500 stock closing auction process, right? So, and if there's imbalances, they get published, people come in and provide liquidity. Like, you get lots and lots of liquidity out of the close. So the DAC actually solves this problem too.
Okay.
But it's a little funny to me that I'm always hearing about such and such has X to trade on their roll. But the reality is they aren't considering how this market, how the actual underlying delta hedge actually is going to get executed. It may well be executed with one of these techniques or one of these exchange rules that largely or completely mitigates the impact that it would have had.
Okay.
All right.
It seems like that then is something that would be easily missed from the outsider perspective who's just looking at this and assuming that they're going to have to kind of go and do all this on the open market for the same prices that we see on all the screens. But basically, there's a lot of different ways and arrangements for.
Now, if you buy market data, you get like flags and you get richer information.
Right. You can get more insight on actually the motive behind certain.
Yeah. Well, you can tell like if an exemption was used, for example.
Yeah.
But to someone just like watching the volume intraday, through their like custodial interface, you're getting none of this.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
KG, I know, wanted to follow up on those 3 points you gave, Kevin.
Yeah, and I think that's actually a really good point that Devin's kind of pointing out here. But I'll go on the other side of that, Devin, and say, does the flows on the tape have enough impact to encourage other traders to follow, right? And I think that's one of the key areas that I kind of focus on. I think you're kind of alluding to the JP Morgan equity collar that's put on, right, on a quarterly basis, or even your QILD on the NDX side of it. But do you think just the volume hitting the tape itself is enough to wake up options traders, equity traders, what have you, but wake up those traders, and that's where you could see?
Yes, you're asking is there some like George Soros like reflexivity
Exactly.
that just because there's this information here,
too, like price, we're all watching the same moving average.
Look, we don't see it. I don't see it. Like there's been plenty of times where we know that one of these rolls is out there and we're watching it kind of in the last few hours of the day, and like we just don't see it, right? And I think it's because I don't know how they execute. I know all those guys from when I was at Deutsche Bank. It's been a long time since I covered them, but those products were fractions of what they were now at that time. I don't know what they're doing to execute it, but they're clearly managing it well because they're not moving the market when they have a big roll to trade.
Okay,
or they're not moving the underlying S&P.
When we see ticks up here and there intraday, are we projecting? You think as traders?
I think so. I mean, look, we're talking when we actually get into some of these impact estimates. I mean, we're talking about sub 1% basis point kind of moves, like things measured in basis points, not things measured in hundreds of basis points. So I think it's easy to ascribe a narrative to this stuff that you can't really quantitatively back up.
The other thing too, I would say, is that the way I think about it a lot, and kind of since we have even started this, to be honest, is that I view it as there is just exposure, gamma exposure, as an output like anything else, where there's all these trades happening and we can calculate these numbers, and that is simply an output basically of what's happening. When it becomes an input, is when it gets a lot more murky, which is on those very limited occasions, basically what you're describing.
Yes.
Whereas mostly I kind of see them as the guardrails like we talked about, positive gamma, generally compression, generally the same things that cause stocks to generally go up over time already, to where it seems like this stuff becomes an input sometimes if the market's really going off those rails, which are oftentimes a product of exogenous forces, outside things happening.
Right. Well, that's the whole thing. There can be other things.
Maybe, how it's happening, or one way in which there are people under pressure.
There could be a small hedge fund liquidating that you don't know about. There could be there can be a myriad of things. There could be a big blind program order on somebody's desk that they're out hedging in the futures because it was a blind block. There could be a mutual fund that had a big redemption that day. It can be all this stuff. I think when you spend time on an upstairs trading floor like at a bank, and you look around this essentially marketplace of different desks and different products, and you begin to understand what the ETF guys are doing all day, what the program guys are doing all day, what the cash guys are doing all day, what the synthetic equity and swap guys are doing all day. And you begin to see how things can bubble up in one place and not the other. You're a little more reticent to kind of point at something like this to say that's what's moving the market. And by the way, I haven't even mentioned the fact that when you get one of these big block orders, you may just instantly lay part of it off. Okay, when we had a big block order on the desk, particularly in listed options, you have a handful of they're more customers than they are market makers, but a handful of people that you call and say, hey, I'm committed.
Share this risk.
I'm committed at this price. You just want some.
Sure.
And they take outright fills. So if I had 10,000,
that really hits the price insensitive point hard,
right?
Because that distributes that risk quite a bit in a way that doesn't cause people to rush to suddenly.
And for the most
part,
you're distributing it to people who want it. Right?
Okay.
So they're definitely not in a hurry to go out and hedge something in the market, right? So
that seems like what a lot of it boils down to. What are the situations in which they have to become an price insensitive buyer and do it in a hurry, which is very few. I want to make sure that you mentioned some impact estimates.
Yes, for sure.
Kind of what are we talking here?
So look, I mean, let's just talk about GEX a little bit and kind of what it is. So stuff like this has been around for 20 plus years. That's another thing I think you just got to get your mind around, right? It's not that often that something that's 20 years old has a lot of information in it.
Okay.
Let's just be honest. Okay. So the initial impact of gamma-like models was I'm just going to assume all the calls. Well, I'm going to assume everything was traded with a delta hedger on one side, which is not the case. Okay. It's just de facto not the case for the reason that I just described. Somebody calls up with a big block order. I'm on the flow facilitation desk. Maybe the complex book needs to buy some tech calls for one of his complex products. He gets some. You lay off some to other broker dealer like customers. So what was a 10,000 lot order, now you're really only facilitating 6.
Will still show up on the bank's books.
Oh yeah.
So it'll okay, right.
Well, it'll show up in the open interest, right?
In the open interest.
So first of all, not everything is traded by a delta hedger for sure.
Okay.
Right. It assumes that call options are always sold by investors. Now, that was a reasonable assumption 20 years ago. Okay, it's not the case anymore. I mean, the entirety of the zero DTE flow that's not the case, right? I mean, the zero DTE flow is really only 2 things: it's people buying calls in single stocks and selling put spreads for income in the index, right? I mean, that's all of that flow from a retail side. And then that's the other thing. It assumes that 100% of puts are bought by people who aren't delta hedging. I mean, that's just flat out not true anymore.
Fair.
There's 80 billion of derivative income product out there, right?
That's something we have talked about with you obviously don't know the motive behind a lot of what you see on the screen.
Right. And then finally, the dealers precisely hedge to their delta, which is also not true. And we're going to talk about that with kind of the Vanna charm impact. I think most people would be surprised to know that in a professional risk management system, you not only have your delta, but you have end of day delta and then probably 4 more deltas that make different assumptions. And depending on the book that you run and the risk that you have, almost no one is blindly hedging to a Black-Scholes delta. It just doesn't. That's not what happens.
Okay.
So kind of all 4 of these things are flawed.
Sure.
Now,
because a lot of what we're talking about is kind of theory, right? And in reality, these are where the holes kind of get filled in.
So then what comes along next is the next generation of these models was, I'm going to assume that actually only percentages of the calls are actually people selling them, right? So I'm going to go from 100% down down to 60% or something
Right,
like that.
yep.
And then on the put side, I'm going to do the same thing, right? So this in the second generation of this stuff, people started not assuming 100%.
Okay.
Then in the third generation of these models,
Which is progress.
right? Then in the third generation of these models, people were actually taking where the prints went up and ascribing, if it printed closer to the offer, they'd say, oh, well, that option was bought, right? And if it was printing closer to the bid, they'd say that option was sold, right? So now you're actually dissecting the tape trade for trade and trying to put it in the right bucket of which direction it is, right? And then then where we are now with this stuff is that you're doing that plus getting some of this meta information about order type off the tape and trying to incorporate that so you can make smarter guesses about who's delta hedging and who isn't.
Okay.
So I guess my point with all this stuff is, this GEX calculation and technology, it's fine for like a very rough idea.
Sure.
But it's 20 years old and 4 generations past.
Okay.
What the people you claim to be trading against, right? They've got 4 generations better than you. Right.
Sure.
And in very high-speed market access and very sophisticated models. So,
Yeah.
again, like I'm just kind of chipping away at this idea that there's information in here until the numbers become so big that you can't ignore them, right?
I get that. That's compelling. I would say the only thing that I do kind of sympathize a little bit with KG's point, because it's theory and it's kind of impossible to prove, but it does make sense to me logically, is that the explosion of activity among traders aware of this back and forth now is similar to like watching a line, basically, where it sounds like simple like ape math or logic, but it does ring true to me, which is that enough people can build that kind of reflexivity if now they start using it as an input, but still probably limited to those moments that are already like tail risk for the market on their own.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Welcome to Market Overtime on the Schwab Network.
Quality Focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. The other second derivatives you mentioned, Vanacharm, real quick. Thoughts on whether or not these are more useful in terms of kind of assessing what market makers have to do? Do you prefer to look at the time element? Do we need to shift then?
Yeah, so I mean, I probably feel the strongest about this stuff. It's just not a thing.
Okay.
Sorry.
In terms of what?
Okay.
Well, we know it exists, right?
Okay.
We know what.
So,
but as an input, you're saying it's
even if we could agree on the amount of delta that has to hedge out there, okay,
which you've argued is very hard to actually
even if we could agree that there's a number out there, and we haven't even talked about impact yet. I want to get into those, but even if we could agree, we all know that tomorrow will be a new day. We know it's coming. It's not
tomorrow.
Like
The sun will rise.
Like
Tom Hanks, Castaway.
I promise you, the guys at Citadel are smart enough to know that their delta is going to change tomorrow, right? So, like I told you, in any sophisticated risk system, there's delta. Then they've got a second column, end of day delta. Promise you that delta is different than the one that they're looking at intraday.
Okay.
Because one, their positions are changing, and you need to know what's happening.
So we've already kind of got stale
but like
a little bit.
It's a different delta too.
Okay.
So it's not like you get to the end of the day and you hedged your Black-Scholes delta. Then you come in the next morning, and because a day has passed, now you've just got a new delta you install.
Right.
Like
sure.
It's nowhere near that simple.
Yeah. It's a spectrum. It's all blending together, right? Like
right. And in terms of vol changes, okay, with changing your deltas, this concept, so that's a concept that has also been around forever. You know, in the professional community, we call it shadow delta and not charm. But
that's going to be in the title for the shadow delta.
But people have been adjusting their deltas for that stuff for 15 years. Like, I promise you that anyone that has a book big enough that where this matters is using not a Black-Scholes delta, but a delta that is adjusted for this stuff. So it's not as if there's going to be a lot of institutional flow from these things. Now, I'll tell you where those Greeks are not, these types of cross Greeks. I say they're cross Greeks because delta is the how an option changes with respect to the underlying. Gamma is the rate at which the delta changes. Vega is how much the option price changes with respect to vol. Volga is the rate at which that changes. Right? Those are first and second order Greeks. These types of cross Greeks really matter in complex books. Okay. So if I had a derivative where spot would move and then the maturity changed, now we care about cross Greeks. Okay. So for example, the single most popular structured product in the entire world is the auto-callable, which we're not going to talk about. But when spot goes down, the auto-callable can essentially redeem early. Just accept that for me on face. I just want to do an example. Okay. When the spot goes down, the life of the auto-callable gets longer. Well, now I care about time a lot. Okay. So these higher order Greeks and these cross Greeks, these things matter, but not for plain vanilla options. Sure. Right. I mean, like it just. I'm sure there's people that would like to argue with me, but I'm telling you, you sit in the seat, you're not hedging to a Black-Scholes delta. So the impact of these things, I don't even really know how to quantify it. Yeah. Right.
To that point, though, because we got a short amount of time, though, the impact, you got a number, got a couple numbers
so I mean,
on us?
Here's the numbers for S&P. Okay. Because I don't think, you got to get your mind around this.
Yeah.
Over the last 5 years, average, mean, 370 billion a day. Okay. That's just the mean.
Yep.
Okay. On the slowest day of the last 5 years, 40 billion. On the busiest day of the last 5 years, 972 billion. Almost $1 trillion of notional traded. Okay.
S&P.
Right. In the last now here's another number. In the last 3 months, in the last 30 minutes alone. So a lot of times the counter arguments you get about this stuff is, well, but all this happens at the end of the day. I mean, I'm here to tell you that it doesn't. You don't just wait until the end of the day and trade your delta in a rush, right? But but I'll go with it. Okay. Last 30 minutes of the day, mean 50 billion. So on average, 50 billion just in the last 30 minutes, right? And as much as 100 billion. So basically 10% on a relatively reliable basis trades in the last 30 minutes versus all day.
Yep.
Okay. So now then go look at the GEX levels. Okay. a big GEX day is 10. The biggest in the last 3 months was 10. The biggest in the last 5 years was 24. So you're talking, when I went back and looked at the ratios, these GEX levels tend to around 17 to 18% of the traded notional value. And by the way, this is not special math. You literally can just get your Python. Any retail trader can do this. Just get your Python, get the Y Finance add-in, download a history, multiply futures volume times price times 50, which is the multiplier of the E-mini contract. The E-mini contract ticker is ES equals Y, right? And then add in the spiders. So these numbers are spiders plus the E-minis.
Got it. Okay.
Add in the spiders, which gives you about another 10% of liquidity, and you're going to get these same numbers. So like, I have a hard time getting excited about, you guys had in one of the episodes I watched, you guys did a live demonstration, and it basically had, like 1 or 2 billion of it.
Right.
I mean, you can trade 1 or 2 billion at sub 10 basis points of market impact.
Sure.
Right. And that's if you're in a hurry. Right. So again, we kind of come back to this thing: how much to trade, how much liquidity is there to do it, how much time do you have to do it? At these numbers, the sizes that you need to have really meaningful impact. We're talking about hundreds of basis points, which is the types of moves that are relevant to the people watching this. You're not a high-speed trader, most likely, if you're watching the show. You're not there to scalp 10 handles.
Correct. Yep.
We've got to have meaningful,
you need moves.
Meaningful moves. In order for this dynamic to truly be generating, or somebody's big role to truly be generating, we're talking about much bigger numbers than what I see here.
Okay. Case well made. I think that it's basically the conclusion for me is that you have to have already some kind of outside force, basically, that's going to either pinch liquidity, really take people by surprise, kind of get those moments where maybe the exposure can tell you if the ice is going to be particularly slick or not, but
right,
there's
you
gotta
can
be
have things
something
come
there
together,
already.
right? The right macro comes together with a surprise announcement in the last 30 minutes of the day, and people getting caught surprised when the numbers happen to be big. Like you have
to have a lot of things that add up.
You need a lot of things to come together. I just don't believe it's something that is going to matter intraday. But I will also say on the single stock side, a lot of this can happen a lot easier.
Okay.
You can find these, like I said, kind of dampening sine wave-like pins in mid and small cap names because, again, it's all about those three things where in there you had potentially more exposure but far less liquidity. Right? So that's the framework I think you've got to look at the stuff in.
Great stuff. Love the perspective. You man, thanks a lot, Devin.
Happy to help.
Yeah, very cool.
Thanks for having
very
me.
nice to kind of get the to be sure as well, to kind of think about how some of these notions we kind of take for granted a little bit. We kind of we try to read everything that we can from the market. It's natural that we want to have kind of every tool in our belt, but there's a lot of things where you just don't know what's going on behind the scenes. You don't know what who's trading hands and for why and what other literal options they have to. I think the point about laying off risk too is a really big one. Because it suggests it doesn't always have to be some like giant scrambling.
Well, that's right. I mean, 10,000 options hit the tape. If 9,000 of them were laid off to outright holders,
right,
it doesn't look any different on the
much
tape.
More, diversified type of like participant. Then, great stuff, KG. Thanks for the questions. Appreciate you as always. The two of Mr. Kevin Green, Devin Anderson, co-founder and CEO at Convexitas. Kevin Green, markets correspondent on the Schwab Network. Nice, good stuff. Good balance for us here. Always good to have it in a conversation about markets. Thanks for tuning in again on episode 8. Make sure that you subscribe on the YouTube channel, as well as, of course, on Spotify, where you can listen or watch. We will be there. I'm Oliver Rennick. Thanks for tuning in.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Welcome to Gamma On, episode 9 we're on now. I'm Oliver Rennick. I'm the lead anchor at the Schwab Network and your host here for our limited series about options trading. You can't get to 10 episodes of talking about options in a podcast in the year 2024 without having a Nigerian involved. I'm excited to bring in Pete to join us here on the conversation today. Pete Nigerian is a co-founder at Market Rebellion. Of course, many will recognize him if you've traded options, if you've learned about options. And if you've read the book, it's not an option. I love saying that, Pete.
I appreciate it, Oliver. It's a lot of fun. I'll tell you what, this is our 4th book. And my brother, who also co-founder of Market Rebellion, has he's got a great entertainment side to him, and he understands media pretty well. So
he does.
That's something that has really stuck with a lot of people. I had a pilot just last week. I was flying back from Florida. And literally the pilot walked out and he looked at me and he goes, "Hey, it's not an option."
That's great.
And I looked at him and I go, "Yeah, you're right."
We're always setting each other up for jokes here. We go, "Hey, we got Nigerian in the A block. You got to get your movers in on time. It's not an option." Yeah, John was with us. We're recording this in mid-December, and your brother was with us just earlier this week. We've obviously got a lot of fun market stuff going on. Since we're pre-recording, I love your macro, but it'll be a little bit tough to kind of stretch that out because this is not going to be coming out for a couple of weeks. But I really enjoyed talking to you guys over the last year or so, I guess. A lot of folks know you from CNBC. As I mentioned, a lot of folks know you from the books as well. Obviously, you guys have a super interesting background. Your brothers who have been together doing business, it seems amicably for a long time with the brother of my own. That's a big accomplishment. Kind of tell me where you're at in your career and what you want to do, what interests you right now, Pete, and anything maybe people don't know about you that you want to throw in there.
Yeah, sure. Well, I think you pointed it out with John. That's one thing that has been amazing, to be honest with you, because he's the older brother. He's not my twin. Everybody thinks we're twins, which is offensive to me, but very nice for him. But he's 6 years he's 6 years older than I am, and he came to Chicago in 1981. He had a brief stint with the Chicago Bears, and then his agent hooked him up with the CBOE, and it's been a great partnership for him ever since. And I came along a lot later. I was lucky enough to play football for a long period of time and eventually joined John on the trading floors back in 1992. I got there, late 1992. But we have a great relationship together, and it's interesting because you and I were talking just beforehand. We've never had an argument. We really have not. And I've been on every side of this with John on the way because he did the right thing, which is, hey, Pete's not just going to get started and he's going to be on the trading floor trading. I literally started at the very, very bottom at the CBOE.
You're running
I was a runner. I was running from place to place. We had traders all over the floor. We kept getting a little bit bigger and bringing in more traders and groups. So we became a really big franchise down there on the Chicago Board Options Exchange, and it was great. And we were one of the more progressive groups out there too, because we never restricted anything. I mean, if you're a man or a woman, we didn't care. If you were a good trader, we wanted you. And so we probably had more women traders than anybody. Matter of fact, I would say practically more than the rest of the entire trading floor if you added it up. So it was something where, also the other interesting part between John and I is over time, we didn't care if somebody went to an Ivy League school or not. We wanted people that were hungry, that were disciplined, that came from wherever they might have came from. They didn't have to have a college education. We didn't even care about that. If they were disciplined and they were somebody who really wanted to get into this world of options and understand it and have success, that's who we wanted. And so it was amazing looking around at a lot of our traders. Many of them didn't have a college education, maybe didn't even go to college. And we had quite a few former professional athletes as well, because it's almost the perfect mindset going to the trading floor to have somebody who has all of the discipline. They've failed, they've had success, they've done this, they've done that, and they understand how to come back from some of the failures and what did we do wrong and wanting to get better. So I'm really proud to say we had a bunch of guys who used to be in the NBA. We had a few guys from the NHL, had a bunch of guys from the NFL who were part of our group. And
that's awesome.
It made it sort of an interesting group of people, I would say, totally different than many of the traders groups that were on the trading floor that were just hiring Harvard or Yale or whatever they were doing. We didn't care. We just wanted somebody that was hungry, that could do math very quickly.
That's super interesting. And I think it's actually a good place to start for this, because so far we've talked a lot about kind of this second order heady math stuff in the show that a lot of people are using now to try and look at, instead of just the first derivative rates of change, they're looking at the rates of change of the rates of change, the gamma and this stuff. But ultimately, I think what we've heard, especially in the last couple episodes preceding you, is that, there's not some like new science or answer coming from this stuff. You still have to have instinct. You still have to have logic of your own and a lot of different tools in the belt on top of these things. And I guess to kind of come back to Chicago for a second, one thing that I noticed when I moved to Chicago from New York, and again, to give my own brother a shout out, who's a programmer, a market maker for a big bank, I was always kind of associated with sort of some of those kind of like Ivy League quantity guys. And then when I came to Chicago, the first thing you notice is that because this is where the trading floor actually still has trading happening, is there's a lot of guys who are pretty big in size physically, number one, but they're wicked smart and they have a type of intelligence. Like I think about my former boss, JJ Kinahan here is a great example, right? He's a big guy. He can get up there, he can get seen, get his hand out, get the trades, but he was always surprising me too with his wit and his logic and his nose for market. So how do you kind of think today in your career, how do you kind of balance that kind of quantity side that you have to have awareness in the market of these things, but also that instinct?
Yeah, I mean, that is a big factor. You know, things have changed, obviously. I'm not on the trading floor. I haven't been on the trading floor since probably 2004 or 5 or something like that. So, you know, I had to leave because it did become so much more automated. Now, there's still room in some of the trading pits down there in Chicago for traders to be.
Yeah,
and like you just said, size matters. Size does matter. I'll tell you what, one of the little secrets about why John and I look so incredibly different than your average Wall Street person is because of our trading floor. When you're on the trading floor, Oliver, the one thing that stands out is somebody in a crazy coat. That's one. But number two, what do they look like? And you look as ridiculous as I do with this crazy thing and the long hair. And, you know, I never ponytail it up until I'm on with somebody like you. And I kind of try to impress you a little bit. I even have a sport coat on today.
I love that, yeah.
But none of that is really me. I mean, the real me is I don't have a ponytail. I do what I do. And, you know, you have a certain persona on the floor that does intimidate people if you've got a little bit of size. And people knew that I was a linebacker in the NFL all over the trading floor because they'd seen me play, actually. I'd played for the Vikings and the Buccaneers and a couple other teams in the NFL. And that was, you know, sort of the background. And it was the same thing there. You try to intimidate people, right? I mean, that's part of the goal when you're a trader down there is you want to be the biggest, boldest guy on the floor. And when a broker, you were talking about being a broker, when a broker walks into the trading pit, you want to be the first guy screaming like this and putting your arms up in the air and going crazy. They see that. So the long hair was an advantage. And now it's been one of those things. I just got to hold on to it.
It's iconic now. You know, it's iconic. Your brother's got the hat, you got the facial hair, you know, and the ponytail. It's iconic.
I'm the first guy to tell you, I know it looks ridiculous. It's okay. I mean, I'm man enough to know it, but
hey, we can't change it now. It's not an option.
Yeah, it's not an option. That's what I've been told. But you know, it is something that got a little bit different. You talked about getting off the floor. Well, what do you do when you come off the trading floor? You all of a sudden are in a different world because you're no longer somebody who's making markets. Like when you stand on the trading floor, it's the one thing I think people miss out on is when you stand down there, you're making a market. I'm not a broker. I don't have a broker. I do have brokers walking into the pit when I was there, and they would ask, hey, what does it look like, Pete, here in Micron? I want to know the 75 calls. What are they going for? And I go, quarter half. And I immediately either buy it a quarter, sell it at a half. And that was part of the whole game that was down there is who's the fastest and who sticks out for the broker. Then the broker looks at you and says, all right, how many do you want? I got 1,000. Well, if I'm being charitable to the guys, I'll only take half. If they're not standing up for the tougher trades, then maybe I take the whole thing. And that was a big part of that whole world of trading. And then we had to morph into something else. And John and I moved off the trading floor and we came up with a lot of different ideas and we created an algorithm to try to find where is the same kind of option trading that we can see it and see it literally almost to the second that it absolutely occurs. And so we built an algorithm with a group of guys, and John and I put in all the different things that, what do we want? What did we see? What really changed things? What was a trade that looked like it was something that you really wanted or something you might want to back away from? And so we put all that into a group of guys who were a lot smarter than we were, and they built that algorithm for us. So that's something that gives us, I think, a feel for being on the trading floor, even though I sit in a room like this, I can sit on an airplane, I can sit anywhere and still do it because the computer's in front of me.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, Our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Welcome to Schwab Network,
Daily live exclusive content tailored to today's investors.
broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
What kind of give us a little bit of taste of that kind of secret sauce? I think a lot of times when folks think about your trades, it's some people describe it as like smart money, like following flows. I kind of think about people who I know who trade, who look for big whales swimming in the ocean. You're trying to kind of be. We talked with Brent Kochuba about how even he uses this kind of high level gamma stuff to be a remora, a sucker fish, along the whale to pick up whatever gets left behind of the shark.
Yeah. Well, and we like being the shark behind. So anyway, when we're watching the trades that are happening, we're looking for size. Size does matter. It truly matters in the case of options. I'm not going to chase something where a guy walked into a trading pit or did it online and bought 500 of something. They buy 5,000 of something and it has a meaningful number with it. In other words, they paid $1 for it. That kind of gets me more interested. And did they buy it or did they sell it? Which is a very important thing to be able to know. Our algorithms tell us just about everything about any trade that I ever click on. I can see what happened in the trade because that's very meaningful. So we have to diagnose that as fast as we can. And then, like you said, we want to follow a lot of that smart money. It's not an option not to be there, right? I mean, we need to be there. And so whether it was 10 years ago, 15 years ago, 20 years ago, whatever, as I look at all the trades that we see now, we see some incredible stuff, OJ. I mean, I'm not kidding at all. What we see we get in front of things that other people don't see because they're not in the options world. They're still not embracing derivatives. More and more are. I mean, just to give you a great example.
Yeah, since COVID.
I started well, how about this? Yes, we can start with COVID. So 2019, we were averaging 19 million contracts a day. By 2020, it was 29 million contracts a day. Right now, we're averaging about 49 million contracts per day. And as a matter of fact, November was the biggest 1 month ever average, which was well over 53 million contracts per day. Gives you a little bit of an idea. When I started in the business, we traded 750,000 options in a day. So to not be involved in the options world, I think, is very foolish. It's something that I think has morphed into a monstrous part of the markets. And whether or not, and this is something John and I talk about all the time, whether or not you like Warren Buffett, hate Warren Buffett, but Warren Buffett says something all the time, and I love his line because he talks about, options and nobody should really be doing those and all the rest of it. Yet he's the largest option trader in the world. So it's kind of an interesting thing. And the options make it very interesting for a lot of people to get into the markets because when you buy stocks like a Warren Buffett or any of the biggest of the big out there, at some point they have to start letting people know how much they've got in stock because that percentage is something that has to be disclosed. options, it's not there.
Right.
So if you look at what happens with somebody like Warren Buffett or any of the biggest of the big whales that are out there, they can put on calls. They buy 10,000, they 10,000, 10,000, 10,000 over a period of time and start building up a position. That doesn't have to be disclosed until they convert that into stock, if they do. So that's just something else that I think has to be at least considered. And I'll give you a great example with Warren Buffett. Not too many, about a year and a half, 2 years ago, when everybody finally found out he's got a very large position in Occidental. Well, where did he start off with that positioning? Well, it all started off with buying calls.
Right.
And his options traders, I know some of them, they're massive. They have no fear, and they trade as big as anybody. And I see those trades, and it's almost a blueprint sometimes on who's making the trades based upon what kind of stock is it.
Absolutely.
And the size. It all tells you over time, that's a Warren Buffett trade. That one's not. That's a Mark Cuban trade. That's
Sure.
a whatever.
An Ackman
they
trade.
all have their own blueprint.
Yeah, it's funny. One of the jobs that I interviewed for when I was kind of figuring out what I wanted to do, I was still at Bloomberg, but I was kind of figuring out what I wanted to do, and I interviewed with a proxy advisory firm whose job is to basically sleuth through all the stuff you're talking about to try and figure out on behalf of shareholders, who's buying up the company and whether or not they want to be a part of it or not. So there's a lot of options analysis involved in that. How do you think we as individuals can compete with those types of institutions, or just the now more and more kind of like newsletters trying to track the fast money and stuff? How do we keep that edge? Do we just try and stay high probability and logical and smart, or do you kind of have to bring in some of these other elements?
Well, I think the most important thing, and we talk about this all the time, is be educated, number one. I mean, I think it's so important for people to understand the derivative side of the market, right? Because it can be a little bit complex. The calls, puts, selling, what are the ramifications of a trade that you put on if it goes differently than you had wanted to go? I mean, I think the biggest thing that we do at Market Rebellion is we always start with, where are you on this whole thing when we look at it? Are you educated at all? Do you know anything about how options work? Obviously, we have something, and you have this gamma thing that you're talking about, but that's part of the Greeks, right? I mean, all the various Greeks that go into the pricing of an option, theta being time, and all the rest of it, and deltas and gammas and all of that. It's important to have a knowledge of that and have a very deep, good knowledge of that to understand the trades that you might be putting on. So I think it all starts with education. And then as far as we're concerned, one of the more important things that we see out there is this whole thing we talked about with the algorithm is, how do you move the odds to your side? And that's something that I think is very, very important. Trying to move, almost feeling like you're in the trading pit, you're on the trading floor, and you're actually hearing and seeing these trades as they're happening. And that's something that we provide through Market Rebellion, is we have that, what we call unusual option activity. And that, I think it's not perfect. It certainly is not. Does every single trade work? Absolutely not. But many of them do. And a lot of the time you can see a trend happening, Oliver. I mean, where it's something where, boy, they're buying a lot in the AI space. Oh, by the way, they're doing a whole lot over here in nuclear right now. Why is that? I mean, I can honestly tell you, I think that we were in front of nuclear becoming a monstrous piece of what's going on in the markets. We were on top of that last year. And I think that we started to see others start to get attracted to that far later. And, you always want to be one of the first guys there, right?
Sure.
So it's one of those things. And why is nuclear so important? Well, because of the fact that A, it's green, and B, it actually gives you the supply. It gives you the demand that's happening right now before our very eyes because of AI, because of data centers and all the rest of that. What is the best? What is the most efficient? And it's nuclear. And so, it made a lot of sense to us that, hey, look, this is a spot to be. And one of the things that I'd love to push back on for 1 second too,
Sure.
OJ, is this. When I see a lot of folks that are out there saying there's only 7 stocks, hey man, it's the Magnificent Seven. I have found that to be the most annoying, wrong information that I've ever seen. And I'll say this, when you look at that, what about Constellation? How did that do? You start looking at year to date. Yeah. what did a lot of these various names that a lot of people really weren't paying attention to, Vistra is another one of those.
Yep.
When I look at them, I look at the percentage that they've done year to date, and it's staggering. Vistra is about 200%. Constellations, 100%. Constellations, 260%. These are gains that we aren't seeing very much of at all, including the Magnificent Seven. But, they get this name and everybody gets attracted to it and everything else. I think there are so many other names that got pushed to the side. Lennar. How about the big move that we got out of some of the housing names?
Yeah.
I mean, you could go on and on and on with names that are outperforming, but for a lot of people, it was just 7. And for a lot of people, it was just NVIDIA. There's a lot more out there in the world than just NVIDIA. NVIDIA they're great. They've done fantastic. We've had the splits, but that doesn't mean they're the only stock to trade. Yeah, exactly.
I think a lot of people think that way because they talk about it from an index level, or they think about it from an index level. You got so many passive investors.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
One thing I was going to ask you is that, based on our conversations, what I know about you, it seems like you trade specific stocks, single stocks. I would think more than the index level, or am I wrong?
You are 100% right.
Yeah.
And the only reason for that is, when you trade the ETFs and, the various index, it doesn't have the same kind of beta. It doesn't have the same type of movement than if you're in an individual name. I love the XLF. I think it's great, but I'd rather be in Goldman Sachs. I'd rather be in JP Morgan. I'd rather be in Morgan Stanley. And those are the names. It's funny that we got to this spot. When I look at the financials, I look at those investment banks. I continue to pound the table. I think the last time I was on with you, when you're on maybe the trading floor or something, we were talking about this topic, but I look at the financials as the investment banks are not only crushing it, they're continuing to crush it. And I think in the next year, they're going to continue even further. And the reason I think so is all of the different things that are going on behind the scenes, the IPO market and some of the buyouts that are going on. There's just so much that feeds into the investment banking side. And some of those names are probably still trading way too cheap right now, relatively speaking, just because of the fact that they've lost a little bit of momentum. I mean, like maybe it's Bank of America, maybe it's Citi, but I look at some of those and then I look at JP Morgan's done fantastically, along with Morgan Stanley and particularly Goldman Sachs. Huge runs to the upside. I don't think that's over with.
Sure. The banks took a little bit of a breather here too. So if, we're recording this on PAL Day, so if they kind of get what they want from the Fed, then seems like there could be potential because all those regionals kind of came back off pretty hard too. On the tech side, I'm going to make a little bit of a transition since we were talking some of the AI themes, the nuclear power for AI. I thought it'd be kind of fun since we're also talking about kind of like the change of trading and the use of like quant strategies and AI to plug some stuff into the AI on options, and then we can kind of just riff on it. One, I was using, first of all, this stuff is pretty amazing. Like to your point about education, where you can just plug in, like when I just say, hey, give me 5 questions on like Gamma, this thing runs with it. It's really incredible. And I wish it was available for when I started learning about options. Do you worry about any of the AI stuff from like the perspective of an author, from an educator at all? I kind of get a little worried sometimes for me, you know, like.
I do, yeah. Absolutely. You don't want to go anywhere blind looking into something, right? And I think sometimes, it all depends on how well has this feed really gone. And we see it with a lot of the AI that we talk about each and every day and where it's being used by some of the huge companies. I mean, when you look at somebody like an Amazon maybe or whomever, Microsoft, the AI space is something that's just remarkable, and how fast it has come to where it is right now. I mean, the idea that the AI business could be an $80 trillion business by 2030. I think we all have to know as much as we can about what's going on with AI. From a results standpoint, I think you got to be a little bit concerned that are the results really, really accurate in some cases, depending on what AI we're talking about, of course. But it makes for a very interesting thing. And you strap that on along with quantum and everything that's going on there. That's something else that's really starting to perk up. And it's been perking up, especially, I'd say, in the last month, maybe 2 months. We are hearing more about quantum than we had in years, because it's been around a while. But now all of a sudden it's gotten a lot more energy and kind of getting a huge wind behind its back.
A lot of these stocks that have been making these vertical moves or exponential moves, a lot of folks that I think reasonably so attribute at least some of that behavior to options and call buying as a much more popular way to express bullish views now, where you get some of these moves like in a Tesla and some of the quantum or the AI stuff. And that's kind of where some of these second order derivative effects come in, where when I plug in, tell me about how to use Gamma in a trading strategy. The first thing that the AI spits back to me is that it helps you anticipate large price swings. When I type into Gemini, how can Gamma provide trading opportunities in specific stocks? That's the first thing it says. It says anticipating large price swings. Now, we've kind of heard the contrarian case from some of our guests that say most market makers and dealers are using this to basically more compress the range and to collect income. But for us as individuals, to your point on the single stocks, we're looking for the juice. We're looking for the actions. How much do you think that the popularity of options trading and people trying to get into these big moves is exacerbating to some extent the kind of volatility or the exponentiality that we see?
Yeah, it's so complex, but I think that when we see these volumes, these monstrous volumes that come in, and the most recently has been much more either AI or quantum. I mean, those are certainly areas that everybody seems to be diving into. And when we see the huge amounts of options that are being bought ahead of some of the moves that we are seeing, is it the options moving it, or is it chasing of stock? It's all those kinds of things. I think what I like about the derivatives market is it gives you an opportunity to have the leverage. And in a lot of cases, you can be a part of something in a way that gives you the opportunity to be there, something you'd never get that opportunity if it was just in stock. And I think options are a great way to put yourself into these positions that you're looking for, because maybe you do believe in what's going on in the combinations of data centers and what's going on with AI and this whole package that's in front of us each and every day. I see the deltas that they're buying, and you bring up Gamma, and I'll go back to Delta for even just a second. They're really not buying a whole lot that's at the money. In other words, right where the stock is trading, or in the money, very rare. They're looking for these these monstrous moves that are coming, and they're going out in time oftentimes now a little bit further than they were going, but they're also going up. In other words, if it's a $15 stock and here we are sitting in December, what's that looks like? Well, the options that we're seeing that really stand out for us is looking maybe into January, maybe even into February, but they're going a little bit higher. Maybe they're going for the 20 strike rather than going to the 17.5s, or if there's single digit, or if there's the $1 options there, maybe it's the 16s, maybe it's the 17s. No, they're going a little bit further up and out, and they're getting themselves into a spot where if this thing makes a monstrous move, these really can move in a big way to the upside, but you have a lot less risk on the table.
Do you think that people going for those kind of big swings, has any of this type of trading encouraged like lower probability, more speculative type stuff, Pete? Because I feel like for a lot of folks, they'll go, all right, I've got this cheap, to your point, if you're going for a big move, there's a lot of people who don't want to then sell something against it because they don't want to eat into that. They're trying to make a big move, but then you're going to lower your probability, which I feel like then kind of goes against some of the stuff that a lot of us grew up thinking about, watching you guys and thinking about, like, how do I put on a high probability trade? How do I, do something that's not going to totally expose myself? But I guess from their side, they'd argue, well, if I buy it for cheap, then like whatever, I just lose my cheap, my cheap option that didn't pay out.
And what's really interesting, to be honest with you, Oliver, has been the one theme that I've noticed over the last month or more has been buying of options in much less expensive stocks, which, you didn't used to see that. And we're seeing more and more of that. And I would even go all the way down to, say a stock is trading for $1. We got people that are buying the 1s or the 1.5 strike calls in those options because, shoot, when you look at it, they're right there and you got the opportunity to have the leverage. And the amazing part can be, let's say it's a 10-cent option. Well, now all of a sudden the stock's trading too. Well, you did pretty well on your stock, but how'd you do on the option that was trading for 10 cents that's now gone up multiple folds? So I think that's what we're seeing a little bit more of, is these inexpensive options that give people the opportunity to be a part of something, and the return on a percentage basis can be pretty outstanding. And it seems crazy, but it really does give you the opportunity to be there because, not too many people out there have these huge accounts that they can actually throw around the money the way, obviously all these big funds and PE groups and everybody else, investors. This gives the common man the opportunity to be a part of something. And believe it or not, we've seen a lot of amazing moves of late, and it's been pretty incredible. And I would say that it's in all of the right places. It's been in the AI names, and it's been in the quantum names and so forth.
That's what I was just thinking in those categories. We've seen a lot of that.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader
every market day.
The other thing, the analog to some extent, part of the reason a lot of times I do favor playing cards versus market is that you can take a small amount, and if you win a big tournament, then you get a big payout. That's kind of the idea of like tournament poker, but of course the rate at which you win those tournaments is very low. But all you got to do is win a couple, right? And then you can continue to kind of build up that bankroll. So there is, I don't want to go too off track, but I mean, there is this kind of like populist side to it as well, where people will argue, I've heard this argument a lot, where they say, you know, like, hey, the rich are getting richer, the rest of us are getting left behind. You know, the kind of, I don't want to like veer into the political realm, but there is this kind of notion that if you want to keep up, then, you know, you have to speculate. I'm not sure if I believe that necessarily, but what do you think, Pete? I mean, because that is kind of a discussion that people are having. I think it's also what, frankly, you hear a lot from like coiners and crypto people. I mean, the Bitcoin people literally say it to your face. They go, what is it? Have fun staying poor or whatever. Like that's the mindset. Where is this a good mindset or is this a toxic mindset?
Yeah, you know what? I think you've got to know who you are, what your risk tolerance is. And a lot of people go into this without knowing that. And I think that's about as important as anything is what is the risk tolerance of the trading? And do you want to put yourself into a bind, which you should never do, by the way. But I think you've got to know who you are and what you are, what you're looking for, and try to understand it that way. And I think that's, again, you know, I'm not just trying to push options in front of people at all, but I think that the one thing, and it's probably why our volumes are where they are, one thing is it gives us all at least some kind of an opportunity. And I was just talking to somebody the other day, they were asking me about Tesla, and they said, hey, Pete, what do you think of Tesla? How do you trade those, you know, this thing or whatever? And I said, well, I've always only traded it with options. And there also are strategies that you can use that keep it even a little bit, you know, you can put in a position that you limit some of what you can make on the deal, but it gives you that much more opportunity to maybe get into something. And I'm talking about spreads that people who have the knowledge, they can put on spreads, and people forget about stuff like that. They just think about, oh, I got to buy this option. I'm going to buy this one. It's 10% out of the money and I want to be there and that's where I want to be. But you should, you know, especially when you've got volatility as a part of it, and there's still, even though the VIX is very low right now in the markets, I think people have to understand there are a lot of stocks out there where the implied volatilities are very, very high. And so if you're buying a call, it's pretty expensive. You can always try to look around and find out a way to kind of, you cap your gains, but at the same time, you have less money at work. And I think people just have to get educated to understand that and how they can approach things. And I think they're getting there. I think we're doing a good job. We need to do a better job of educating people, but I think we're working really, really hard to make sure people understand how they can actually have the opportunities in the options market to make some pretty nice gains, hopefully. But also it might limit some of the risk that you're putting on, and that's okay.
Totally. And I think that's a good callback to another conversation we had that was important in this series was about the volatility dispersion that's happening. To your point about vol being low for S&Ps and VIX, but a lot of the single stock vol super high. So I think that's why you're getting so much. I mean, if you just look at the stats from SIBO, you cited them earlier, basically we had Henry Schwartz on who had all these stats, and the single stock options obviously are huge, and I think it's growing in a skew that way because of that volatility dispersion, where you're just not getting much right now on in S&P vols. So the stocks present more of those opportunities in a pretty pronounced way. On the subject of risk management, Pete, I want to go into that a little bit more, because the one thing I hear from a lot of people all the time is they'll say, I wish you would have talked more about risk management on a trade. Like, we'll do example trades and stuff, and then they'll say, cool trade, but like, what happens if I'm getting up to my expiry and it's still pretty far out of the money, or let's say I got a calendar on, do I take the whole thing off? Or, what would you say? And also, this is funny because this was question number 3 on the AI that said to ask you, which was about risk management. How are you thinking about that in today's world of options? Are there particular type of trades where you find yourself thinking about risk management from a certain perspective? Do you kind of find yourself in the kind of same, logical places in your trades where you have to go, okay, what do I do here?
Yeah, I think, and I talk about it way too much probably, but the educational side and what you understand, so you know exactly what sort of risk that you've got on. And I think when you've got these high implied volatilities, it is something that I do on a regular basis. If I'm looking at an option, and I'll just use Tesla as an example, and I look at that one, it has pretty high IV on it in implied volatility. It's tough to just go out there and buy a naked call, right? I mean, you're looking at a stock that's trading at a pretty healthy number already, and now you're in the options, but you're still going to have to put out a significant amount of money to put on a trade if you were just to buy one call. So the way that you can kind of put yourself into a better spot, I think, if you understand what you're doing, is putting on these spreads, something I was just talking about. But that gives you that opportunity. And when something has the high implied volatilities, like a Tesla, sometimes like NVIDIA, oftentimes actually has some pretty high IVs as well. I think those are the opportunities where I look at it and go, all right, I don't care if anybody else thinks, well, why wouldn't you just buy the call? They bought 20,000 of these calls. Okay, but I don't want to have all that risk on. So instead, I'm going to follow them. I'm going to buy these calls. Maybe I buy 10, but I'm going to sell a couple of strikes higher to kind of give myself a little bit more comfort in what I'm doing, because I'm already paying a lot of money for this implied volatility. I'd like to sell some implied volatility at these levels as well, because I'm leaning bullish because of the spreads or the calls that I'm seeing, but it gives me an opportunity to be a part of that ride. Now, does it reduce what I can make at the top? 100%. But as it flows, and depending on the time frame, maybe you're in a position where, hey, you know what? A lot of juice has come out of the one that I sold. I might be able to actually buy that back and then roll that up. And there's all kinds of different trades that you can put off of that. But I think that it's the beauty of options. There are so many different strategies that you can put on in any trade, and you just have to have the knowledge to do it.
That is a good point too, about the spread just giving you more optionality, because you've got two parts of it where, it doesn't have to be one, a single buy, sell, etc. You mentioned earlier about how you were seeing folks kind of thinking a little bit further out on the timeline for duration. I'm curious right now, with obviously a potential big shift coming in January, where does that complicate the options traders? How far on the calendar right now are you willing to take risk? When there's a big event like that, do you want to keep your expiries in? Are you willing to kind of take that speculative risk? Tell me how you're thinking about the calendar right now.
That's a great question. It really is, because, obviously with President-elect going in there, and what does that mean? We already know what happened the day after the elections. I mean, the market's absolutely ripped to the upside. And, not to beat a dead horse talking about Tesla all the time, but the last I looked at it, I think it was up over 70% since the election. So an incredible run to the upside for that one. Now, as we're looking forward, what does it really look like? I mean, we've been talking about, the president and the possibilities of what this means for the markets themselves. And we've seen a pretty amazing run to the upside, although we've seen the Dow of late start to pull back a little bit. I think it's something where we are seeing a lot of activity going out into February and into March, and matter of fact, even quite a bit going into June. And so that's something that I think people are starting to flex a little bit, and they're starting to put that much more out there, especially when you look at volatility right now, right? I mean, if you're using the measure of the VIX itself and you're calling it somewhere between 13 and 15, I would say that that's a fairly low level for the VIX, and it gives opportunity to maybe start making some of those moves. The interesting part, however, is the VIX itself. We have seen some massive, and there's a gentleman or a person or a something out there that everybody refers to as 50 Cent. And I'm sure, Oliver, you've heard of it, but 50 Cent he's been out there, or she, or whatever the entity is, buying hundreds of thousands of call spreads out there in volatility. And so that's something that I think I don't think it should be worrisome. It doesn't mean he or she or whatever is always right. But when you see somebody going out there buying, for instance, let's say it's the February 30 calls, and they're selling the 60 calls, and they're buying 180,000 of that spread, that's a massive trade. And we've seen multiple trades in the VIX where we are seeing that, where we are seeing call spreads being bought. So literally looking to cap where it could go. And I can tell you this, it makes total sense because do I see the VIX getting up to 60? Probably not, but that doesn't mean it couldn't get there. But if so, it would not last very long up there either. So somebody's out there putting on these large positions and they're bringing down the cost of that and bringing it all the way down to very close to 50, hence the 50 cent. It's amazing because think about that, $30 spread. And if he's wasting money or he or she is wasting money, maybe they are, but are they hedging? Are they actually expecting to see volatility pop? I think that probably the expectation is, could we see some volatility, a lot more volatile than what we are seeing right now? And right now we've been stuck in this pattern of 13 to 15 for the VIX.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Someone who's making a bet on like a big move like that, it makes me come back to kind of some of the questions about not really risk management, just kind of like trader instinct in a way. Where like I got a guy who comes on my show where he buys in the money calls and he takes the profit. He takes at least part of it off if it doubles. That's like his like thing. And some people have different kind of shorthands. Yeah, that's Alan Nuckman. He loves those trades. Do you have any kind of like, if you buy, let's say you're not in a spread, let's say you're in more of like a lower probability speculative trade. Do you have a threshold where you go, I'm happy? Is there like a shorthand, like Nigerian threshold where you go, you know, I'm happy with that gain? Like if I am the 50 cent trader, you know, and I get a spike in vol, like do I really want to ride it all the way or am I happy with like a 50, 75, 100%?
Well, I'll give you exactly what we've been talking about for a long time. It sounds a lot like your other guest because we've been saying this. I've said this probably for the last 15 or 20 years, which has been this. When I put on a trade, if it doubles, I take 50% off immediately.
Right.
Because I don't need to be a pig. Now, there are times where maybe you're a little bit lax on that exact number, but something very close to that. Because the beauty of it is you buy an option for $1, you sell it for $2, 50% of whatever you bought. You bought 10, you sell 5. Now you still have the other 5 and all the money that you put into the trade is off the table. That's a nice feeling. You have to talk about the negative side too, however. So if you buy an option for $2 and suddenly it's trading for $1, I think it might be time, this is my own gut, I'm gonna sell it because I was wrong, and whatever I followed into it was wrong. And sometimes it recovers, sometimes it doesn't. But I think the reality is you've got to be disciplined in this market. I think the options world, you always have to be disciplined because so many factors can factor into those options themselves and when it's going to move. Maybe the options that you followed that were in January, unfortunately didn't work, but maybe they were going to work in February, you know? So the reality is they were wrong. I was wrong on the timing, but eventually we saw this thing moving the right way. The problem is if we're in January, we've got to get out of that trade. And if I'm down 50%, I'm going to cut it.
I'm curious, how many trades do you at like a week or a day versus other times in your career right now? What's your volume compared to like other times in your career in terms of how many trades you got going at once?
Yeah, that's an outstanding question because the volumes that we were talking about that I talked about earlier, and the fact that this year we're averaging just under 50 million contracts a day every day. I mean, it's absolutely incredible. It opens up a lot of opportunities out there. So I would say, other than being on the trading floor, this is probably one of the busier years that we've had in a really long time. We've had some great ones in the past 5 or 10 years for sure, where you're busy. This is ultra busy, and it's because of all the right reasons, right? You've got all of the news about the Fed, and to your point earlier, everybody was talking about they're going to have however many cuts. Maybe there's 9, maybe there's 10, which, by the way, Oliver, I have always said, how on God's earth can they possibly say that? I don't understand who pulls that number out, and they all agree with each other until
it's always wrong.
Right.
It's always
because
wrong.
The reality, it's crazy.
You can't see
because
beyond
first
a
of all,
month or two.
And if you believe what Powell's saying, and I do, because I think he's been great as far as transparency, but I look at that and I say, well, how can they possibly say that? He says they're data dependent. I absolutely believe him on that. They look at the data, they look at all of the data, and they've gotten it all last week, obviously. So we've got all this data, they put it together and they do what they're going to do. And most of the time we're pretty accurate looking at that CME tool on what they're going to do. And so, there's not a huge mystery there, but the fact that so many people said that we were going to have 8 or 10 or even they were wrong, and I wonder if they actually ever admit to that being wrong on that call. I mean, because
not many.
It was ridiculous.
I don't know too
many. They should. They really should apologize to people, in my opinion, because. But anyway, we have so much news right now that's been obviously the whole thing going through the presidential process. Going back to
people hyped up too.
February, we have all of these different things that are going into the pot, and just the incredible moves out of AI, right? I mean, at the beginning of the year, it wasn't a whole lot about AI. Everything was about cloud. Then all of a sudden we get AI, and then that's the next thing. In the latter part of this year, it's been all about quantum. I mean, wherever you want to turn, we've had huge news stories that are big, that are causing the markets to do a lot of different things. And I think those volumes, so that's why I think, long-winded, but that's where I think this trade comes in.
Sure.
Where this has been a busy year for me on the trade side.
Hey, to kind of bring it full circle, do you think that because of the AI stuff that is actually generating a lot of economic activity right now, that this is a more grounded period of speculation, if you want to call it that, compared to like COVID, when people were just basically taking a check and just parking it into their brokerage?
Yeah. No, I think you're exactly right. It's an incredible thing that we're going through right now because, we're still really, I mean, if you look out into the future with AI, we're still at the infancy of this whole thing, right? I mean, it's been interesting. It's been fun to watch and participate in to some degree if you're on the right side of it. But, I think we have just scratched the surface of this whole world of AI and where it's going to bring us. And I think it's something that we all better be very careful and thoughtful about how we are positioning ourselves and how much risk that you want on. And that's why I'm always trying to tell people, you know what, you got to be disciplined. And whatever that discipline, and you and I just talked about my discipline and a previous trader's discipline will keep you there for a while. But you better stay disciplined on everything that's going on because this is just starting, and I think there's a lot of runway in front of it.
Okay. Hey, the last point on AI, I plugged in what should be my last fun question to Pete Najarian on the podcast. There's a few that are kind of humorous fun. Like, I'll give you a couple options. Tell me which one you want to answer. One is, if you had to teach options to a group of aliens who just landed at Earth, what's the one thing you got to pound through their head? And then the other, well, you actually answered the other one, which is beyond AI. What emerging technology? You're talking about the quantum stuff. I don't know. Maybe that's a pretty good one with the aliens. What's the first thing you got to know? What's page one of? You got to tell them that this is not an option. You guys got to know this.
It's not an option, and if you want to have the ability to leverage and be able to still be a part of something, that's the knowledge that I would start with. Because we all see a stock like, for instance, an NVIDIA for a long period of time before all the splits and everything. how many of us could really trade that? I would say very limited, right? I mean, how many shares can you buy of a stock that's trading $500, $700, $1,000, right? I mean, so the options world allows you to at least maybe be a part of some of these trades. So I think that if you understood that this gives you leverage, I think that everybody would say, well, why wouldn't I do that? And my answer back is, it's a limited time frame. That's the catch. And you better understand that that's a month out trade, that's a 2-day trade, that's a 6-month trade, whatever it might be. But all the way, either way, I like the idea of understanding that you've got the opportunity with leverage. And there's a real reason why, quote unquote, the greatest trader ever uses options every day.
Sure. I like the Buffett callback. Hey, the leverage point is good. I like that. Anything in your career, mistake-wise, in particular, you learned from, or like a hard mistake, that you had to go through at some point?
Oh yeah, there's some painful ones back there, man. Sometimes, it's ego. If you let your ego get in the way, and it was standing on the trading floors in Chicago, every once in a while you get pretty stubborn, your ego gets in the way, and you don't hedge something the right way, or you're gonna ride it just for a little while. Those are the ones that I always look back and go, what was I thinking? Why did I get away from what's always worked for me, which is just be disciplined, understand the risks, and use that to your advantage rather than your disadvantage. So, yeah, there's been some trades over the years where I kicked myself pretty good, where I probably might be retired right now if I would have done them right. but that's okay. I love what I do.
It's the game. Pete, it's a very fun conversation. We could keep it going, so we'll continue it again. Thanks a lot for your time here.
Really appreciate it, Oliver. Thanks.
There it is, folks. Pete Najarian, a legend in the options, education, and trading world, of course. Co-founder Market Rebellion. That was a fun one. Make sure you subscribe to Schwab Network's YouTube and Spotify channels. You can also find all episodes of Gamma On at schwabnetwork.com. I'm Oliver Rennick. Thanks a lot for spending time with us.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome to Gamma On, episode 10. I'm Oliver Rennick, and today I'm wearing my suit because this is a very special guest. A lot of people write books on options, but in my mind, only one guy wrote the book on options. It's Scott Nations. He's a regular guest here on the Schwab Network. He's been with us from the get-go, and he's an options expert, so he's a perfect way to cap our Gamma On series. Scott Nations, founder, CEO of Nations Indexes. Is that the full title?
That's fair, yeah. We founded Nations Indexes a long time ago, but that's what I do now.
But you're an author too. You're a trader too.
I was a trader for a long time. I spent 2.5 decades on the floor of the Chicago Mercantile Exchange, trading options on Treasury futures and on S&P futures, and I did that for a long time. Tremendous fun. That was a lot of fun.
It's interesting to have you here today because I was just discussing, we're filming this as markets are a little volatile.
Yep.
On Jan 7th, we had a services ISIN that came in a little bit warm, which kind of got me excited. And I was out in the newsroom and I was like, I'm going to start trading again because I took a hiatus from trading. And I was like, but, I'm not sure about stocks this time. I'm going to trade what I know best, bonds and the dollar. What did you find is the main differences of trading bonds versus trading stocks?
That's a wonderful question. The interesting thing to me was that bonds were a little mathier. Trading options on bonds were a little mathier. And we can talk about the evolution of option trading. But trading options on the S&P requires a tremendous amount of math if you're doing it in the pit. Trading options on Treasury futures require just a tiny bit more math in the pit. Of course, that's all archaic. The math is done for you now on the computer screen,
right.
which really frees up retail traders to think about strategies, not so much the math.
It frees up guys like you too, who, in my mind, kind of, and maybe we should, put this in the public. We're pretty good friends. We've been hanging out in Chicago.
Known you for a long time. Happy to say that.
And I was reading you. I got your book through my brother's collection, who is a professional options market maker. I won't get into the details.
You couldn't buy a copy yourself?
I was taking a lot from him.
Okay.
And one of those was your book on options.
Yeah.
And I think I read that in my first Bloomberg internship. We've talked about your books over the years, most recently The Anxious Investor. Yeah. The history of the United States and crashes was awesome. And so the kind of point about options evolution, which is why I think you're such a great guest to cap this, is that you were a guy on the pit who embodies that kind of Chicago trader pit. You're a big man.
Right.
But you're a math guy too. You're a poker player. You're a quant at heart, and you're building stuff now for people in options in this computer world, which I think is very cool.
Well, thank you. And trading on the floor, trading options on the floor, was tremendous fun. Just being down on the floor was tremendous fun. So for a long time, I was the guy in the bright red polyester jacket. We've all seen the footage, jumping up and down like crazy. It's very different now, and it's better now. I'm not one of those guys who looks back and says, I wish it was still like that. It is better now.
Right.
Option markets are better. They're more efficient. Everybody can use them. Retail investors who are using options are no longer at the sort of disadvantage they were a long time ago. And so the evolution of the option trading universe is defined by more. In 1973, when listed options were first introduced, there was very little math about them, very little intellectual rigor. Now we have more of both of those. Now we have more volume. We have more strike prices listed. We have more expirations listed. A long time ago, it was just the third Friday of every month. Now we have expirations, all you could hope for. And so the evolution has been described by more. And importantly, right now, there's more opportunity for the retail investor.
Is one way to describe more. And part of this, I want your feedback on things that we've been learning throughout this series, on what you think is kind of big, what's small, what's new, what's useful, what's not. One of the ways I've described the growth of those options, volumes, and different ways to trade, we talked about that with Henry Schwartz in some detail from the SIBO, is that it's a surface that is more covered now. Is that one way to think about it? Is that fair that that volume is kind of happening on a surface of volatility where you had a few things sticking out before and now it's completely smooth?
I think that's a neat analogy. I think that's a neat way to envision it. Yeah, because before, and again, I don't want to go back too far, but in 1973, when listed options were first introduced, 16 stocks and just calls. Back then, it was considered un-American.
And they think passive investing
is un-American, right?
Yeah.
But back then, puts were considered un-American. It was another 4 years before they introduced.
That's hilarious.
Before they introduced put options, yeah.
Right.
But there were huge gaps in the option universe, and now there are very few gaps. If you get to the bottom, say, 200 names in the S&P. Option markets are a little tougher because there's just not that much interest in those.
Right.
But yes, I mean, look at, say, the term structure for SPY options. There's essentially an expiration every day for the next 30 days.
Yeah.
And then a weekly expiration for the next, for the rest of a year.
Do you feel that, because one of the things that I was kind of thinking about again, and I think for retail traders kind of go, you've got institutional mind, and it's an interesting overlap with the retail mind, because you're building products that can be used by institutions, but some sophisticated everyday traders would find utility out of them absolutely as well.
Yeah.
And I do want to talk about those. But a real quick question is, when you get this type of quantification, heavy coded, market makers basically going for flow as a whole, who can afford to take just the real small edge over huge volume. Can a guy like me or our viewers make money trading options?
Retail users, retail option traders can make money. And maybe a better way to look at it, Oliver, is this. If you buy a stock or you short a stock, the payoff profile is a 45-degree line.
Mm-hmm.
That's
linear.
That's the only way it works.
Yep.
On the other hand, if you use options either alone or as spreads or in combinations with the underlying, you can create payoff profiles that are both superior to simply owning or shorting the stock, and they're unique. They're payoff profiles that can only be created using options. I think that's the way retail investors should be thinking about how they might use options. And, covered call is a perfect example. You do the payoff profile, payoff chart for a covered call.
Hard to say no to.
But the payoff profile is generally superior and absolutely unique.
Love the answer to that question. I suspected I knew the answer. My heart also says yes. But just like cards, there's variance, there's bankroll management, and there's capital. Certain trades require capital put in to make, life-changing money, if you will. Cover call doesn't.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Believe me, when it comes to investing, you'll love Carl's way. Take a left here, please.
But there's a...
Carl's way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
I think people became curious about these second order things we talked about in this podcast a lot, the gamma levels and stuff, because you're adding even more convexity on to a degree where you did see some of these instances in a GameStop where people could figure out kind of where market makers were, the big people, and if they slipped, that is a massive tectonic plate of which you could try and surf.
Yeah.
Do you think that that is a viable way to trade? How do you think about it?
I don't particularly want retail users of options to think like that.
Okay.
Because it's a wonderful thing to think about.
Yeah, I'd love to surf the biggest wave.
To dream about, right. It's also a way to end up getting bashed on the coral reef at the bottom of the ocean, and, you know, you get more hurt than anything.
Yeah. What's the point of living if you can't feel alive?
Well, you got at the end of the day, you got to be able to pay the bills.
Correct.
So I prefer, and you know, if people want to use options or option spreads to find risk, to speculate in something like that, okay.
Sure.
But, you know, you were nice enough to mention...
There should still be some defined outcome.
Oh, yeah. Listen, that's why I said...
That's when the rails go off.
Oh, yeah.
If you
that's
don't have
why
that.
I said covered call.
Yeah.
I would never suggest anybody sell naked calls or naked puts unless they were ready to buy the stock, had money segregated. I would never suggest an unlimited risk trade.
What do you think about these people who buy like really far out of the money call options? You know, there's some that like to kind of say, I'm willing to, it's like kind of playing a slot in a way, a little bit, like for a casino analogy where like you could hit really big, but most of the time it's kind of a low probability trade.
It's easy to use a casino as an analogy for option trading. Just because money's involved, you make a bet, there's defined risk there. You can't lose any more than your bet.
Yep.
But the analogy, where it falls apart for me is when people start thinking about option trading as gambling, and it shouldn't be. And you were nice enough to mention my first book. One of the reasons I wrote that was I wanted to explain some of the phenomenon in the option world, which are both persistent and can provide the sort of edge that makes somebody a profitable trader. A perfect example is that over time, options cost more than they're worth. Just like your homeowner's insurance or your car insurance, but you have to have homeowner's insurance. You can't afford to have your house burned down. But, you know, the difference between what that insurance is worth and the price of it provides a little bit of margin for the insurer. And it's the same situation in the option world. The price of an option that you're buying is slightly more than what the mathematical value of it would be. And that's a profit margin essentially for the option seller because they have defined outcome, essentially unlimited risk. And so they have to have some sort of profit margin in there. That does not mean that people should go out and be selling options naked.
Sure.
But it does mean that, you know, maybe selling a covered call or a cash secured put is a way to take advantage of that.
Do you think that as, and to kind of, this is kind of wrap this part of it, but do you think that as we've got the huge market makers able to live off kind of, to almost use sort of a poker gambling analogy, you know, all they need is 50.1% basically, if the volume is there.
Yeah.
How has that changed the trading dynamic, if not then to try and figure out kind of where their big positions are? Has that changed, or is it just the market is now more purely priced? This is kind of how things happen?
There are people out there who try to figure out where the big market makers are positioned and squeeze them a little bit. And we know there's a tremendous amount of academic research. I talked about the fact that there's more academic rigor in the option business now.
Yeah.
We do know that that near expiration or at expiration, underlying prices get pulled to strike prices that have the big volume. That tends to happen, and it's because of the way market makers tend to hedge their positions. And so you might try and take advantage of that, but it's really kind of tough.
It is.
That's a very tough way to try and trade. Back to your original question, though,
especially for the indexes. For single stocks, I've kind of come to the view that you might have more to work with there, because that could be a fewer number of players. A big hedge fund that has an interest, or just fewer market makers involved because it's a less liquid type of instrument. Whereas, like, if you're trying to use that data as input for like the S&P, it's like, I mean, come on. You got everything else in the world that factors into it.
There you go. And let's say that there's huge volume at the 6,000 strike in the SPX options. You don't know who that is really made up of.
What their interest is.
Right. Are some of the longs speculators who are bullish? Is a bunch of the open interest? Is it people who are short covered calls effectively? You don't really know.
Yeah. You could maybe think about it as, I think, the stock specific part of it maybe can work, and then maybe as like sometimes when there's a little nitrous on the broader market, because I think a lot of it, frankly, is we've been watching, they overlap with a lot of technicals that you would just look at based purely on the price is king, supply demand, traditional technicians perspective. There's so much overlap with all those big market maker positionings that I think it might add a little on the margin. Okay, if they really start to break, some nitrous can come into it. But the levels overlap a lot with things that I think you can ID from the chart.
And I don't disagree with that, but also the nitrous. You're talking about getting a boost to a move. Again, if there's big open interest at the 6,000 strike in the S&P, then between 59.95 and 6,005, you really might get some extra volatility. But you get just 25 handles away from that on, say, an expiration day. Then much easier for people to avoid that sort of whipsaw.
Correct.
One thing that is important, though, is that, and this goes back to your original question, the retail option trader can be confident. They can actually revel in the fact that bid-ask spreads are very narrow now because so many market makers are happy to make a tenth of a penny.
That's a really great point. That's really what it boils down to, right?
Yeah.
Is that we couldn't even afford to put these trades on and get that kind of risk exposure.
Oh, no. Years ago.
Yeah.
And for example, now...
Costs you just as much to do the trade.
Right. And now margins have collapsed. That's good for retail users. And bid-ask spreads have collapsed. We look at SPY, the S&P ETF, a lot. And it is not at all uncommon for at-the-money options in SPY to be 2 cents wide. Now, that's effectively, for the retail user, that's effectively nothing.
Yeah.
On the other hand, if a market maker
can do it a billion times.
If they can do a billion of those, then they're happy to make a tenth of a penny.
So we all kind of win. And then in the moments when things go askew, right, there are opportunities that can arise to try and exploit maybe some of that. But to me, again, it helps explain maybe why price moves the way it does. But ultimately, I have to say over the years, I've kind of drifted more towards the price is king kind of in speculative markets in particular, though, where a lot of it you can get from looking at the technicals.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Now, one thing a lot of people say you can't do technicals on is the VIX or volatility. Your product, Volley, I think has, again, because we've known each other for a while, and as much as you have under your career, I've also been watching, as your new books come out and as your products develop, and to see the way the options market and real people who know their stuff, because I don't view myself that way when it comes to the vol mechanics and whatnot. The people I follow, who I respect, watch Volley very closely, VOLI. But you're now going beyond and you want to build more on top of that. So take me through what you're doing right now.
Yeah, we created a suite of 3 indexes and listed them, I don't know, a decade ago. And they grew out of, like everything we do, grew out of our proprietary option trading experience. When I used to walk back into a pit, in fact, when any trader walked back into a pit, when there were pits, the first question they would ask is, what is at the money vol? And then they would start to build the rest of the skew themselves.
Okay.
And so at the money volatility is really what matters as a starting point. And so we created
It's your pillar for calculating.
It's where
your North
start.
Star.
Yeah, exactly. Good way to put it. And so we created Voldex, and Voldex on SPY is ticker symbol is Volley, VOLI, and it's available everywhere to everybody for free. And it's a closed form measure of 30-day, constant 30-day implied volatility using SPY options. And we also have a couple more. Taildex is really interesting. Normalized price.
I like watching Taildex. That one's very interesting.
Yeah, normalized price of a 3 standard deviation out of the money put, constant 30 days. Really, it's probably the real fear index, because when
I was just about it's so funny. I was just about to say, of all your products, that's the one with the most competition. I would think, because there's a lot of people that try and have a product that measures either fear or like what people are betting on in terms of like the overall magnitude potential for swing.
And we know that those outsized moves to the downside are more frequent than the math of some sort of normal distribution would suggest. They happen more frequently than they should. And they also have outsized impact on long-term investment returns. So there's lots of reason.
Because when they happen once, their impact compounds over time?
That's right. If you, and I talk about this in my crash book, and I'm going to try and make certain I get the number right, but if you could since the Dow Jones Industrial Average was launched in 1896, if you could avoid the 5 worst days that the stock market's ever had, you would nearly double your return.
Wow. That's got to be one of the best stats beyond just the average annual return of the S&P 500, right? It's like that is as good or second best.
It's over 25,000 trading days. If you could miss 5 of them, you would double your return.
Yeah.
And so if people could, if they have a gauge as to the market perception of tail risk, that can really be insightful. So
it is. And by the way, on the surface, that sounds like, oh, well, you can't stab and miss. You've got it. You missed the 5. But the point is that if you have ways to gauge when the odds of one of those 5 days is happening, you recalibrate. And as the odds of it happening increase, you continue to calibrate further. So it's not like you expect to miss those 5 days and you double the S&P. It's that you can get somewhere in between that could be a better place in the long term.
Well, maybe the biggest danger, and again, I talk about this in my crash book, is that following a crash, people pull back from the market and they stay out of the market. We've all heard stories of people who lived through maybe your grandparents.
That's the financial advisor's job. That's where we get.
Well, there you go.
Mike Antonelli on the phone tell us that stocks, which is true, which is totally fine place to be. That like, hey, don't stay out. You better get back in and stat.
Right. If you took the beating, then enjoy the ride back up.
Yeah.
But yeah, we all.
That's a different job. Your job is trying to figure out and assess when maybe the water is getting a little bit more turbulent.
Right. And quick example, another quick example. In my last book, The Anxious Investor, I write about an investor years ago who really took a beating in the stock market to the point where he could not even be around somebody who would talk about the stock market afterwards. So, but
he wouldn't be welcome around here.
But that may do as much damage as the ride down is. Missing the ride up. Again, grandparents, great grandparents said, "Oh yeah, after 1929, I didn't want to hear from stocks. I didn't want to talk about them. I'm never going to invest in them.
Totally.
My money was always under the mattress." In this day and age, that's a tough way to fund a retirement or a kid's education.
Yeah.
We created these products to explain to us what's really going on. And as an example, you mentioned VIX. If you look at the VIX and you see that it's up 5% on the day, or it's down 5%, or whatever the number is, VIX uses essentially every strike price listed. It's impossible to know what's really moving VIX. And the problem with that is that if at-the-money options are moving VIX, that tells you one thing.
Okay.
If deep out-of-the-money puts are moving VIX, that tells you something very different and much more pessimistic.
Yep. Because we get VIX up, stocks up days, people are ripping calls.
And it
happens more and more.
And that's something, and that's very different too. That's a wildly optimistic market. That's wildly optimistic market action. But my point is, so we deconstruct skews so that you can understand what options are really moving. And we're building this suite out. We're going to launch nationsindexes.com very soon, by the end of the month. And we'll offer all of these on not only put decks, not only vol decks and tail decks, but also put decks, price of 1 standard deviation out of the money put.
Okay.
Call decks, price of 1 standard deviation out of the money calls. Risk decks, which is that percentage and is really insightful. And we're going to do it on a wide range of underlyings.
Yeah, I saw single stocks too, right?
Yep, we're going to add singles.
That's fun.
We're going to add the important single stocks. So NVIDIA, Tesla, the names that people love to trade.
Okay.
Our goal is to help people by making information their edge.
You've had obviously a lot of these products we've been talking about, volley, tail decks, et cetera. So will it be the data aggregated in a different way where we can take it in, do we want with it? What's kind of the target utility of it in my trading process? Do I pull data from it or do I check in every day to see kind of where it's at?
You'll be able to see these values, all of these values, in real time.
Okay.
On the underlyings we cover.
Okay.
We'll offer charting so people can look at them in the context of history.
Nice.
And for premium users, they'll be able to download the historical data.
Okay.
So they can manipulate it in their own way.
Fair enough. All right. Answered all my questions. Perfect. All right. So that sounds pretty cool.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your number one broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab. Schwab, a modern approach to wealth management.
The theme of this conversation was also going to be about product build out, and then what would your fifth book be about? It feels like kind of maybe we're getting to some degree of overlap here. I don't know. Maybe you go full quant again and you do like, part two of like, the options traders almanac, if you will.
That's an interesting idea, and there's plenty. There have been enough changes since I wrote the first book, and the title of the first book is Options Math for Traders.
Yep, that's the first one I read.
Yeah, the book I don't think is nearly as intimidating as the title suggests.
I was so intimidated, I swear to you, Scott. I remember picking it up off my brother's desk. Promise you, and I didn't even know I was ever going to do any of this stuff.
Right.
It was like early on Bloomberg for an internship, and that's what he did. So I said, all right, I'll try it out, and it was pretty tough, but I got through it, and it put it in a way that I was able to come back to later on. I didn't even realize that how it was built into my framework. But then when it did have to kick in, we came over here to Chicago. It was like, oh, all right.
Well,
there it is.
Oliver, I'll give you a little clue. I've been lucky to work with some great publishers. Wiley published the first two, and the guys over at William Morrow, HarperCollins published the last two. The author doesn't really get to pick the title. Your editor your editors will suggest the title. So options math was probably a little bit more intimidating than the book is intended to be, because the goal again of that one is first principles, the phenomena that really can help you become a better option trader. The volatility risk index is the fact that options cost more than they're worth. Some of the way that options erode over time, how price works. I'm glad you enjoyed it.
Yeah.
I'm also glad you were able to go back to it.
But recently also you were very creative in your writing with History of 5 Crashes, Anxious Investors, a very cool look at the psychology side and the behavioral side.
Thank you.
Where does that, which side are you kind of bending towards right now? I imagine, because that's why I say like the quantity side, I mean, you're really tapping into it with the nation's indexes stuff I hear.
That is true. And we're going to provide lots of editorial for subscribers to understand what the measures are saying, how to use them, how you might use them in concert with other metrics. That would be a really interesting approach. I'd love to write another book. The history is fascinating to me. And you also learn about the market yourself. One of the reasons I wanted to write the crash book was I noticed that there are commonalities among all the 5 modern stock market crashes. And it's not just that stocks rally a bunch and get ahead of themselves. There's always some sort of historical catalyst that often has nothing to do with option trading or stock trading. And there's always a financial contraption that...
The contraption, that's key.
Yeah, they're new, they're novel, they're not well understood. They build up a lot of leverage.
Okay.
And they come unglued at the worst possible time. Mortgage-backed securities in 2008 is the perfect example.
Do you think there's any of that risk building in options? Is there any contraption that's we're getting over our skis a bit with?
That's the question. And I don't want to be one of those guys who says all the time, a crash is right around the corner.
No, you don't.
No, because
you definitely don't.
No, because they're very rare.
Yeah.
I mean, from 29 to 89, from 29 to 87, more than 50 years from the second crash I read about to the third. So, but you have to ask yourself, what is the contraption that might become a problem? Let's bring it back to options. People wonder if zero DTE options are going to be the contraption.
Right, yeah.
I believe
there's so much sensitivity around it.
But I say that there's not, because you don't get to snowball a bunch of opaque risk in zero DTE options. The risk
it's just
disappears
liquidity
at the end of the day.
It's just liquidity, right? Isn't it just added? That's the whole point of the build out of the vol surface that we were talking about. It's just a faster way to discover price.
Yeah.
So maybe faster, is it possible? Rates of change possibly, but COVID, we went down and came back really fast, which maybe did have something to do with some of that, maybe.
One point I make in the book, the crash book, is
which is a good thing, by the way.
Yes. Well,
I mean,
hang on.
Yeah.
Okay. So first one I read about Panic of 1907. It was a year from the catalyst, which was clearly the San Francisco earthquake of the year before. A year from the catalyst of the crash.
Okay.
In 1929, it was a month from the catalyst of the crash. In 1987, people forget that the Friday before the crash in 1987, we were effectively at war with Iran. So it was essentially a weekend in 1987 from one of the catalysts, the geopolitical catalyst of the crash.
Okay.
In 2010, it was a day. For the flash crash, it was a day. Now, if China does something goofy or there's some other geopolitical thing, it might be 5 minutes of back and forth on social media from the catalyst of the crash.
Right, yeah.
So that's probably not a great thing.
Okay.
But it's what we have to deal with.
Yeah. And that makes sense, right? Because a rate of change can be a faster way to discover truth.
Yep. Because
you then will take maybe a big, long, detracted sell-off and then a big, long recovery and just go like that instead.
Yep.
But rates of change also are where if there's leverage built in, then the rate of change will expose that leverage in a way that maybe people weren't ready for.
And that's the problem with all this opaque leverage from mortgage-backed securities. I don't think anybody really understood. Even people at AIG didn't understand how much of this opaque, levered risk AIG was taking in mortgage-backed securities.
Yeah.
Nobody understood.
Yeah. So the idea here that adding liquidity into the options market and broadening out is probably not intrinsically a threat.
No, because in something like listed options, it's tough for that sort of leverage to build up.
Yeah.
You know, the exchange is not going to allow it. The OCC is not going to allow it. Your broker's not going to allow it. And again, with 0 DTE options, that leverage expires at the end of every day.
Yeah.
And you couldn't build up enough in the course of the day to really do any damage. And last Friday, as we're doing this, that was January 3rd, in SPY, just over 60% of all the SPY volume, I think it was 60.7%, was 0 DTE.
Whoo-wee.
Which indicates that even though option volume is exploding, it's exploding in a pretty benign way when it comes to risk.
Okay. That's a really a good framing of it. I also think that you're putting, you know, maybe the 0 day risk is more from like the perspective of what you do with it, kind of like anything else in a way.
Yeah.
You know, most, I think that we've learned here is most people that are in that market are doing so to hedge big positions. It's a more liquid hedge. If you think about a lot of like options overlay strategies, like a lot of these ETF guys who launched their funds a couple of years ago now, they have to either restructure it or it's going to get its lunch eaten by those who are doing the same strategies with 0 day stuff.
Yeah.
Because it's just more liquidity. It's just better, right? It should be.
And I know that you have done a lot in the series about Greeks.
Yeah.
And
the original title was Second Derivative, but we went with Gamma On instead.
I think I like Gamma On.
They're both mine.
And I know that you've done a lot of work about Greeks. And what I talk about some of the Greeks in a kind of non-mathy way in my first book. But the point is that the sensitivity of an option price changes as it gets closer to expiration.
Yeah.
And so, for example, theta is erosion is effectively infinite on the day of expiration.
Yeah, which is why these ones are fun.
And that's
comes
why,
back to the point of how you
right.
use them, right?
And a lot of people want to do that. They want to get on board. The one thing I would say is, and every professional option trader has to deal with this at some point. Don't get in the habit of selling a very cheap option because there's only 3 hours left in the day.
Yeah.
And you think, oh, it can never go there.
It's a great
I'm going to sell those puts for 3 cents because it can never go there.
It's also not worth it to make 3 cents. You know, people. It's not. It's literally picking up pennies in front of a steamroller. You miss once, you're done.
Right. That's. I
don't know about once. Depends on your bankroll management.
The guys in the pit that would sell those. Sounds goofy, not well respected.
This is where we want.
Not to be expected.
This is the Scott I want.
Not expected to be around very long. And when the market would really move down hard, you'd have some fun looking at those guys, watching those guys, watching for sweat beads to break out.
Kind of like the way people do on air sometimes if they break down. Any of those guys work here? No, I'm just kidding. Yeah, that I love that perspective.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
I wonder how your mindset about risk taking overall has absorbed the degree of kind of that gambly nature. And I'm not saying, again, everybody uses products for different ways, but this is kind of bringing in one of our own kind of shared passions, which is cards, poker, and risk taking. Obviously, sports betting is huge, especially in the Midwest. And I almost cast my first sports bet when I was in Milwaukee last week. I was like, you know what? I can't go there. But the more I keep playing basketball, the more I start wanting to gamble.
I don't do any sports betting. I like to play poker.
Mm-hmm.
If there's a danger in some of that stuff for an option trader, it ends up seeming too much like work.
Oh yeah, totally.
You know, it's not.
Yeah.
I'm born and raised in Kansas City, so I'm a big Chiefs fan. You know, if I were to put a small bet down on the Chiefs to win the Super Bowl, that's fun. That's entertainment.
Sure.
But you know, if I wanted to, bet more than, I don't know, $100 or $200, then it's like work.
Yeah.
You know, what are the odds? What's my payoff?
Right.
I mean, that's.
You do that in poker though, because you're a positive player. You know, you're a capable opponent.
But
I don't know if you're making too many of my pots, but you're in there.
But I tend to be I tend to be tight.
Well, I always kind of thought about you because we played the first tournament together.
Yep.
In Vegas at a TD Ameritrade event at a market drive. Because I feel like you have sort of a tournament mindset, even though I know you like to play cash.
Yeah, it's fun.
Your options trading is like tournament style.
That's interesting. I hadn't thought about that. I enjoy it
because you're playing odds and logic and very rational. But the variance is high in tournaments, obviously.
Try to do that. I will also say this though: it's tremendous fun.
Yeah.
To play.
Yeah.
Tremendous fun to play with you. So we've kind of gotten off on a tangent here, but I don't want to. I'm not a big gambler.
Mm-hmm.
And I don't really consider this sort of.
But you're willing to take on asymmetry.
Oh, sure.
Exactly.
Well,
that's why we're here.
Right.
Right. That's what this is.
Well, and sometimes you pay for the asymmetry, and sometimes you're paid to take the asymmetry.
And you're trying to build products for people that are going to help them understand how to see asymmetrical options.
Yep.
Or opportunities, I should say, to not overlap with words. And I think that's going to be very useful, especially on the stock-specific front, where I think a lot of this stuff makes sense. So it's cool to see you broaden that out.
And our goal is to calculate these numbers so that people can have some historical context. So, for example, and again, subscription service at Nations Indexes will go live later this month.
Sweet.
But as an example, you know, we're calculating all these numbers and have been for a long time. For example, right now as we're doing this, 10-year yield looks set to make a new 52-week high.
Yep.
Very close to the old 52-week high. And Treasury bond put options, out of the money put options, our put decks, is in only the 36th percentile of the last 52 weeks. Now, I don't want to be one of those guys who looks at an option price and says, well, subjectively, that seems cheap, reasonable, expensive. Let's know.
Compare?
Let's have a number. Let's have a number. So it's like, you step outside. oh, it's pretty cold,
Yeah.
kind of cold,
But it was
cold. Do I
8
need a
degrees
coat?
yesterday in Chicago, so suddenly 25 is feeling pretty good.
And the question becomes, do I need a coat? Do I need to wear a coat? Well, if I tell you it's 20 degrees outside, then that answers the question for you, as opposed to, well, it's kind of cold, a little cold, kind of cold, What do you do with that?
Quantifying more things is always an advantage.
Yeah.
To close the loop, I think I'm to use the Trump term, I weave the way to weave in the last part about all of this smart risk taking, your experience, and the way it's changed over time with how people trade options. But then we're also talking about risk taking in general right now. People like to use 0-day stuff for the asymmetry. To connect it back in the macro point, do you think that speculation becomes a risk on its own, as not only are people in markets more than ever, but they're in cards and sports gambling more than ever, and the debt stuff, to kind of come back to the macro? Do you worry that any of that will spill over, that there is a limit to that?
Speculation can be a real problem. And that's certainly what happened in 1929, to take it back to the crashes. Right. Supposedly everybody was speculating in the stock market then. Shoe shine boys, everybody.
Hey, we got Bitcoin at 100,000 and people are 98,000 as we recorded. People are upset about that, Scott.
Well, that's a different topic. The danger of speculation is not really that people are doing it. It's when it's opaque and is taking place outside of the listed markets. So it stays opaque, and mortgage-backed securities are the perfect example of that. In 1987, what was going on there was portfolio insurance, which sounds like a wonderful idea, but it's opaque and it injects leverage at the worst possible time. What might be the contraption right now? All this private lending is opaque. So if somebody wants to borrow $100 million,
Too, yeah. We've had some of those people on.
If a business wants to borrow $100 million and it makes sense for them, okay. It used to be they'd go to their bank, and it was everybody understood it. It hit the bank's balance sheet. We knew about it to the degree that now happens with a hedge fund and is opaque.
Right.
Then it becomes worrisome.
Okay, that's fair.
Then it could become the contraption that is opaque and levered and injects leverage at the worst possible time.
All right. Well, we had a CLO guest on yesterday, but they were mostly on higher quality stuff. I have seen more and more of that market building up, and we get more requests from people who want to talk about it.
That it exists is not the problem. Mortgage-backed securities, and I write about this again in my crash book, mortgage-backed securities made all the sense in the world, tremendous sense, much more efficient way to do lending, home lending, than the kind of old-fashioned, you go down to your savings and loan, you borrow the money, you send them a check every month, the loan never leaves their vault. Mortgage-backed securities were a much more efficient way of handling that. Probably brought down the cost of loans for homeowners.
Yeah.
So great for everybody until it gets out of hand.
One last question for you. One way that people have gotten access to options investing styles is through funds and ETFs. They're doing options overlays. How do you view is that a competitive force at all for people using your tools to build their own option strategies? What do you think about the kind of set it and forget it type of funds that use options mostly for like income?
Right. I think so. I guess
it's not asymmetric, right? It's different. They're getting income mostly.
Right. Well, they're effectively option sellers. So the goal there is to take advantage of that difference between what you sell the option for and over time the lower what the option is worth. Those people are trying to collect that, and if you do it in an intellectually rigorous way that has right sort of a risk profile, that makes tremendous sense. Some of these goofy ETFs, which are new, which are trying to generate a huge yield by selling options on the most volatile names, like Tesla or NVIDIA.
Oh, yeah.
That's rank speculation.
That's good. Nice. Scott, it's been a pleasure having this conversation and all our others. And you've been a super great help and support to the network and good friends since it came to Chicago. So it's a real pleasure to have you here and finish off our Game On series with you.
Thanks, Oliver. I think you've done a great job with the series, and I think I hope everybody watches it and rewatches the episodes that really speak to them, because
we've had some good variety of opinions.
Yeah, and people are trying to invest to pay for retirements and kids' educations. That's
financial freedom,
right? That's a noble pursuit, and I thank you for adding to the discourse.
Thank you, Scott. A good writer and speaker. Not going to do my Scott Nations impression, even though I do a bang on one. The last
I want
point
to
is,
see that. I didn't know that.
it's gone out before. The last to that point, I think this is like the nobility of asymmetry. You said noble, the pursuit, the nobility of asymmetry.
Take advantage of it.
Yeah.
Take advantage of it if you can, because again, if you're trying to pay for a retirement or kids' education, grandkids' education, take advantage of all the tools in your toolbox.
Scott Nations, appreciate it very much. Thanks, sir.
Thanks,
founder of Nations Indexes. Thank you for watching Gamma On, our limited series, all 10 episodes. Appreciate you coming along for the ride. You can rewatch, re-listen on Spotify and YouTube. Remember to subscribe for even more Schwab Network content. I'm Oliver Rennick. Thanks for tuning in.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Trading at Schwab is now powered by Ameritrade, unlocking the power of thinkorswim, the award-winning trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Good morning, traders, and welcome to the Future Show here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, but let's kick it off with U.S. stock futures are now flat in the pre-market after yesterday's broad-based rally, which was the largest that we've seen since November. The moves come after softer than expected core inflation on the CPI report and robust earnings from the banking sector. Bank stocks rallied after J.P. Morgan Chase, Citigroup, Goldman, and Wells Fargo all reported better than expected quarterly results. Also supporting equities yesterday late afternoon was the announcement of a deal to pause the war in Gaza, but Israel has delayed a cabinet vote on the ceasefire and hostage deal, blaming Hamas for reneging on part of the agreement. And investor focus today remains on those banking earnings today with Morgan Stanley and Bank of America results out, along with data including retail sales and jobless claims numbers due ahead of the opening bell. Now let's take a look at those equity futures to kick off the show here. We're starting to weaken from overnight highs. The S&P 500 up fractionally. The NASDAQ up about nearly 0.2%. Dow Jones Industrial Average down about 0.3% on the back of United Healthcare earnings, which is a high-priced stock. That's a price-weighted index, so that's taken a toll there on the Dow Industrials. And the small caps down about 0.3% on the Russell 2000. Let's take a look at some of the other asset classes that should be on your radar here. U.S. dollar firming up back above 109 after it fell pretty sharply yesterday. Gold up about 0.4%, hitting over 1 month highs in the precious metal, rebounding a little bit from weakness that we saw over the last several weeks. Crude oil down about 0.8% after an over 3% rally yesterday, hit over above $80 a barrel on WTI yesterday. So continue to watch oil, and then the volatility index rebounding a little bit after a steep decline yesterday. Now let's take a look at those overseas markets, see how they're setting up. Hang Seng up nearly 1.25%. The Nikkei up about 0.3%, and the Shanghai up also about 0.3%. Let's take a look at the European markets, see how they're setting up for the day. DAX up fractionally about 0.1%, and the FTSE 100 out of the UK up 0.6%. Now that we've had a look at how markets are setting up for the day, let's bring in our first guest, and that's going to be Kevin Green, senior markets contributor here on the network. K-Cheap, revisiting yesterday's broad-based rally, pretty sizable snapback on that maybe softer than expected core inflation data, but then you got to throw in the earnings also. Those bank earnings were pretty spectacular, right?
Yeah, I would agree. I mean, the bank earnings themselves, obviously, they exceeded the street's expectations, both on the top, bottom line. And then also you're seeing some opportunities when it comes to the investment banking side of the equation, M&A activity. And a lot of these CEOs and executives had talked about the path moving forward, and they believe that it's going to be an easier environment in order to do deals. And so I think that provided a little bit of optimism before that CPI print. And then obviously that print, when it comes to CPI, came in lower than the street's expectations in some respects, especially when you're looking at core CPI. Now, obviously, Tom, it's still hot. It's still a hot print overall if you're looking at the 3-month average and you're kind of looking at a little bit of a reacceleration. But once again, I think it was a sigh of release. We saw a little bit of a ball crush in the market, and equities did catch a bid pretty much across the board. I think the only sector that was kind of lagging yesterday, or two sectors, were healthcare and consumer staples. But today, we have to see if there's going to be some follow through. And I think retail sales is going to be a very key item on the radar here, because we are actually expected that retail sales actually come in fairly hot. And how is the market going to react? Is good news going to be good news for equities, or is good news going to be bad news when it comes to equities? I'm not sure where the market kind of resides there, but from a technical standpoint, we're hitting a key area of resistance. So we're probably either going to see a break up to the upside or a breakdown and kind of remain in this descending channel, if you will.
Yeah, and what triggered it was the PPI softer than expected on Tuesday on the core side, then CPI yesterday. KG, and you mentioned this, is the market, the market typically does this. It looks at data, it looks at numbers through rose-colored glasses. Yeah, the number wasn't worse than expected. The core came in a little bit softer than expected, but the headline was still 2.9% on that CPI data. So, this is typical for the markets, right, where they didn't see more than they expected, but at the same time, it's still elevated, nowhere near the 2% that the Fed wants to see right now. And I just don't see it coming down anytime soon.
Yeah, it's going in the wrong direction. And you're right. I mean, markets tend to overreact both to the upside or downside here. And I think that's exactly what happened when you're looking at the yield market. And so, some of that catalyst for equities yesterday was the fact that yields were moving lower. I believe yields moved around 12 basis points if you're looking at the 10-year, a very aggressive move. And that kind of gave equities a little bit of a boost. And once again, we will see. I mean, we're not out of the woods yet. We still have a lot of economic data on the radar. We still have a Fed meeting at the end of the month as well. We have options expiration going on. So there's enough catalyst out there to still create a little bit of volatility. But once again, I think it's a little bit more of a sigh of relief that analysts were incorrect yesterday. And you might be seeing some pockets of opportunity here when it comes to the services side. Now, the biggest question mark is obviously going to be goods inflation. And unfortunately, Tom, the February report, or what we're going to receive in February for January data set, it's probably going to come in fairly hot when it comes to goods. And goods already came in really hot when you're looking at gasoline prices. I believe that was up around 4.4% on a month-over-month basis. But a lot of that price increase actually is occurring right now. So that's, another high bar that we're going to probably see in a month from now that could create a little bit more volatility in the market.
Yeah, I mean, KG, to your point, and we talked about this earlier this week, is the fact that crude oil hit above $80 a barrel yesterday. We hadn't seen those since July, those levels. So I just don't see, and that kind of fits my narrative that we're not going to see inflation come down anytime soon. Substantially at all. Maybe it reignites a little bit when you see energy moving, up at this point, and job market is pretty robust at this point. People are still out there spending. So should people be prepared for January numbers that come out in February that are going to be probably hotter than expected? And it seems like the narrative for the equity market turned in 24 hours to more positive when we were pretty downbeat first couple of weeks of January.
Yeah, and technically it's still a lower high. I do find that very funny too. But obviously the aggressive nature of yesterday's session is probably giving a lot of individuals optimism. But unfortunately, it could be a bull trap. Who knows? You're right. I think this playbook that we are seeing kind of unfold in January so far, Tom, really mirrors what we saw last year at this time. Last year, we saw January, February, March, inflation started to reaccelerate because of energy prices rising to the upside, not only when you're looking at gasoline or crude, but also natural gas and utility prices itself. And so this is kind of the same type of playbook. And unfortunately, we have the weather events to kind of give us a little bit of a price advance or a boost in prices when it comes to energy. There's nothing on the demand side for petroleum products that really say that crude deserves to be at $80 and remain at $80. A lot of this is supply driven. So in the next week or 2 weeks, once these Arctic blasts or whatever you want to really call them kind of subside here, how is prices in the energy complex really going to hold up? Are we going to see a pretty decent decline there? I think that's a question to remain open for now. But yeah, unfortunately, the February print, and I know we keep kicking the can down the road, but structurally, the February CPI print and the inflationary data is probably going to be hotter than what we saw in January, unless we see something dramatically change here in the next, half of this month.
Yeah, you know what? It seems like, the market pushes aside any of these risks because the economy's still humming along pretty well with, as you mentioned, interest rates still, the 4.7% on the 10-year, even though it did pull back 12, 13 basis points yesterday, which helped lend some support, and the dollar pullback also. But let's get to some earnings here, KG. Taiwan Semi popping post results overnight that we saw. And, I mean, their profits rose 57%. I mean, this is a pretty good report across the board, but they did lend most of that, those gains to the AI trade, and that continues to work.
Yeah, it does. Look, I mean, the market share or the percentage of revenue coming from these high bandwidth memory chips and the AI trade continues to excel and grow, and that's really going to be good for them. Also, the customers that they have that they are able to kind of restructure their contracts and charge more for producing these products is really pushing that bottom line number. That's something a little bit different than what we saw from the initial trade, where Nvidia pretty much was eating up all of the margins there for them because of the contractual agreements that they had. But now you have Apple kind of getting into the mix here, Samsung, and I think that's actually another bright spot here. They actually do call out Apple's iPhone 16 model. We have heard reports that sales have been a little bit slow. I think there was a report last week that December sales dropped by like 5% on a year-over-year basis, what have you. But Taiwan Semi is saying, look, the demand is very strong, not only when you're looking at the GPU side of the equation, but also the mobile devices and the AI chips for these mobile devices. And I think that's actually a pretty decent sign, not only when you're looking at Taiwan Semi, but also translating that type of commentary to Apple is a really good thing here. So really good report. It's not a surprise when you're looking at the revenue number because we get that every month, but the expansion of margins is really something that the market's really optimistic about.
Yeah, they did say that AI and 5G applications now contributing about 53% of the revenue. A little better margins from TSM, but that stock is popping just below all-time highs in the pre-market. On the flip side, in that space, not a manufacturer of chips like TSM is AMD. They got a downgrade, another downgrade today, Kev. The stock's down nearly 50% from its all-time highs that we saw about 10 months ago. Give me your take here on this one. It just seems like everybody keeps talking about the AI trade and everything is doing well on the tech side, but you got some lagging components within AMD's structure where they just can't right the ship, even though maybe one segment's doing well, the others aren't.
Yeah, they keep kicking the stock when it's down, unfortunately, here. So we have Wolf Research downgrading AMD from an outperform to peer perform here. They do not have a price target on the shares. And it's exactly what you're kind of talking about. The outlook when it comes to data center GPUs here, they do believe that revenue actually could be shifted here a little bit when it comes to enterprise spend, and that could actually impact AMD. Obviously, they're really trying to break in and take market share from NVIDIA, but they believe that there might be a little bit of adjustment where a lot of these enterprises stop, I don't want to say stop, but slow down the purchases of the GPUs and really start focusing on some other infrastructure to get these data centers up, and that could be a headwind for them, as well as maybe some of the competition within this space. So they do actually believe that their enterprise segment as a whole could actually grow, right, when you're looking at networking and embedded systems. But overall, they do believe that the GPU side of the equation is going to be a little bit light for AMD. So that's why we are seeing the downgrade. And it's been a tough stock. I mean, we've seen key areas of support getting violated and broken to the downside. And at some point, Tom, the valuation probably will right size and you'll start seeing some buyers stepping in. But it just seems like right now investors just believe that there's probably a little bit more to the downside before that really occurs. And maybe the earnings announcement could also turn that around too, if we get some optimism about new products or if they see a bump in new orders that could change this. But right now, unfortunately, you're starting to see more and more analysts pretty much every single day getting more and more negative on the stock.
Lisa Su might need to come out and make some comments soon because that stock has been getting just hammered over the last 10 months. KG, bank earnings, let's explore those a little bit. Bank of America. It seems like everything's going well for the banks. It's kind of reflective of the economy doing pretty well. But you're seeing M&A activity picking up, maybe IPOs, the new administration coming in. But investment banking fees and a lot of the other fees at these banks, especially like Bank of America, up a little bit today, popped yesterday with the rest of them, but pretty solid results. You can't really, knock any of these banking companies for the results that they're putting out right now.
No, not at all. And actually, when you're looking at the net charge-off rates, a lot of the banks are showing an increase, but it's a marginal increase compared to what you're seeing for profitability. So I think the market's kind of discounting that. So Bank of America had revenue coming in at $25.5 billion, beating the street's expectations of around $25.1 billion, and the adjusted earnings per share came in at 82 cents. Street was looking for 77 cents. Now, what I will say is the year-over-year comps for Bank of America is going to be a little bit different from a lot of these other financial institutions because they had a fair amount of one-time charge-offs last year around this time, right? FDIC assessments that were happening, and certain other write-offs within their business. But if you're looking at their investment banking fees, that surged around 44% on a year-over-year basis. Fixed income trading, equity trading continues to be a tailwind for a lot of these financial institutions. Fixed income revenue grew about 13%. Wealth management grew about 20% on a year-over-year basis. So this company, as like we've seen with some of these other major banks here, are doing pretty well, and they're optimistic when it comes to the market overall, when it comes to the consumer, as well as when it comes to the interest rate market, right? The differential in rates is really what's going to drive their growth when it comes to net interest income. So not like a inverse yield curve. Now we have like more of a flattening out yield curve. They want to see that kind of steepen, and that's going to incrementally improve their marginability over the long term. So once again, a really good report when it comes to Bank of America, and we are seeing a little bit of a pop in pre-market trading here.
Yeah, same with Morgan Stanley there. Investment banking fees up 25% year over year. That's seen a little bit of a pop, maybe already built in with that pop yesterday in the back of Goldman Sachs results there. KG, I wanted to get your take here really quick on Bitcoin. Really nice pop back above 100K yesterday, a little bit weaker here today. This has been a choppy trade. You got to have your big boy trading pants on for this one, right?
Oh, yeah, definitely. And actually, we had a nice little pop, as you talked about, over that 100,000 level. But this chart kind of looks like the S&P 500 chart for the most part, right? Maybe a little bit less aggressiveness when it comes to the pullback on a nominal basis. But if you can continue to hold that 92.5 level over the next couple of weeks, get a nice little bounce there, you form a little bit of a cup and handle and maybe a breakout to the upside here. But this is a symbol of risk on, risk off tolerance within the market here, and we are seeing it pull back. So gyrating around that 100,000, not a surprise. A big milestone here. You just need enough enthusiasm to try to break it higher. And I think over the next couple of weeks, especially with the inauguration that's going to be on Monday, once we start seeing these policies roll out from the Trump administration, and maybe some of them actually touch crypto, that could probably give it enough boost to try to move prices higher there.
Yep. Continue to watch that volatility in the cryptocurrency market. All right, great stuff. Great breakdown for us. That's Kevin Green, Senior Markets Contributor here on the network. Coming up after the break, Dory Wiley from Commerce Street Capital going to join us to take a look at the financial stocks and earnings in the sector. Future shows coming right back after this short break.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Whether you're a bull or bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to the Future Show here on the Schwab Network. Before we bring in our next guest, we got my chart of the day, XLF, the financial ETF, highly followed. We got a 1-year, 1-day chart with the simple moving average, which it popped above yesterday. It had been below that, off about 4% from all-time highs that we saw just about a month and a half ago here. But this is kind of reflective, that move that we've seen over the last couple sessions of those financial earnings that have come out. So we're starting to see a resurgence and a push back into financials. We had big over 6% gains in Citigroup and Wells Fargo, Goldman Sachs yesterday. JP Morgan Chase was up nearly 2%, so lending some support. Got some slight moves higher in Bank of America and Morgan Stanley today. We're going to talk about those more with our guests. But this ETF up about 32.5% from year-ago levels, so it's had a nice run. Peaked back above that 50-day moving average. Will that hold? Will that become a new area of support? We'll continue to watch this one. I think this is a really important one to watch because people are expecting the financials to continue to do well as the economy does well. All right, there's my chart of the day. Now it's time to bring in my next guest. It's going to be Dory Wiley, CEO of Commerce Street Capital. Welcome to the show, Dory.
Nice to see you, Tom.
All right. So as far as bank earnings goes, no surprises. I mean, they're beaten across the board pretty substantially. You're seeing investment bank revenue outperform at this point. But what's your whole take so far in the earnings that have come out already?
Yeah, I agree with you, Tom. Most of it's pretty expected. I think if there is a surprise, at least for the market, and maybe me a little bit, is how much the investment banking and the trading did in the fourth quarter. You know, that's a lot of that is optimism, confidence, renewed vigor in the market, and that really kind of came with the election. And so Trump hadn't even taken office yet, and that kicked up a lot more than I expected it to. But that's good news for banks. Now, as far as margin stabilization, outperformance, all those things, that was all expected on my part. Uh-oh, I lost you. I can't hear you.
Yeah, that's okay. Sorry about that.
There we go.
I had my mic off. I had to cough a little bit. Sorry about that, Dory. You look at the bank moves that we've had over the last 12 months, JP Morgan, Citigroup, Goldman, they're all up over 50% over the last 12 months. Do you expect that to continue? Is this an area where investors can look at and comfortably say, hey, I'm going to get at least 10, 15% gains in 2020 or 2025, just on the back that the economy is doing well and these banks are doing well with interest rates where they are?
Yeah, this is an exciting thing, Tom, because it tells us so much more. As far as the banks go, on investment banking and trading, et cetera, I expect that to continue and to improve going forward. And that's going to be really good for the big banks because they need that. They run at smaller margins than the smaller bank, and so they rely on that diversity of income. That's going to be really good for them. Now, as far as the economy as a whole, banking is the plumbing and wiring for the economy. And when we're looking at these high multiples in the marketplace, we wonder how long that can be sustained, right? Well, a lot of it is depending on what's going on in IPOs and M&A and how hot is that? That contributes to the bubble, right? Well, it hasn't been hot at all. So there's room to run in the market, and there's room for that to expand with the big banks, and I expect that to continue through into this year.
Dory, when you look at, the new administration coming in, the effect that we're going to see there, is this going to be positive for the banks? Because I think a lot of people are thinking deregulation, maybe more M&A activity, and that's going to help this sector.
Absolutely, it will. First of all, in the Financial Services Committee, you have French Hill taking over there. He's a community banker, and he gets it. He's very good, and that'll be good for America. And this will be really good, not only for the big banks, for the community banks. The big banks, have this diversity of income that they get from investment banking, et cetera. The smaller banks rely more on their net interest margin, which is fine, but they also rely on M&A. And you get a lot of pop in these stocks from growth and M&A. And M&A has been shut down by Elizabeth Warren. And so as soon as they get her out of there and they get some stability in the regulators and a little bit better permissiveness, if you will, that's going to be a boost to not only the big banks, as the smaller banks as well.
So we've had some earnings from some of those regional names. PNC down a little bit here, U.S. Bank Corp. And people have been talking about this rally in the financials where the big money center banks and Goldman's and Morgan's and JP Morgan's, they're doing really well and they continue to expand their businesses. Their growth rates are great, but there's still some headwinds for some of these smaller to mid-sized banks. So you do think that's an area where we're going to see some reacceleration, maybe some M&A activity that might help some of them, even with interest rates, above 4.5% for the 10-year, that might squash some lending and maybe some economic activity.
I think there's quite a bit of room left to go in the smaller banks, community banks, and the regionals. First of all, they can grow and acquire, and they have better net interest margins than the bigger banks, right? Some of these bigger banks are running close to 2%. JP Morgan does the best, at 2.63, or I think USB runs 2.73. But a lot of these smaller banks run over 3%. So I like Huntington Bank in here. I like EFSC out of St. Louis, a community bank that continually grows its tangible book value like crazy. Third Coast Bank here in Texas is growing its tangible book value in the small cap space. So there's a lot of opportunity here for these banks, and these smaller banks trade at lower multiples than the big banks. But even as a sector, you're talking about stuff that trades somewhere between 10.5 times earnings, and the bigger banks, I'm talking about forward P's, and the bigger banks still at 13 to 14. So there's room for multiple expansion here in these banks, and I expected that. Now, what will keep a cap on it is concern about credit, which you were kind of alluding to. And I do think there's some signs there, consumer, if you dig through the earnings of B of A and some of these others, consumer write-offs, consumer charge-offs, that's delinquencies, that's all still coming up. And I still think you have a softening housing market as well, particularly with the rising interest rates in the 30-year.
Yeah, that impact, the 30-year mortgage rate back above 7%, affordability issues coming into play here. But when you look at the interest rate environment here, where, maybe people are getting stretched, consumer credit continues to rise, credit card debt's at record levels. Charge-offs, while going up a little bit, they're not, at red flag areas at this point. Can the economy continue to do well and these financials continue to do well if we get stabilization in rates right now? Because inflation right now, Dory, while some of the core numbers were a little bit softer than expected, it's actually accelerating, not going down.
Yeah, I'm with you on that, and I've been listening to you, and it's amazing how many of us are out there going, hey, inflation's still there. What is everyone talking about rate cuts for? We're just fine where we are. As far as the banks go, they need to make money no matter where rates go. They tend to struggle a little bit when you have extreme rate shocks, such as 500 basis point rate hike. That's pretty tough, and amazing that they got through that like they did. So I suspect they'll do just fine going forward. I think the key thing here when we're talking about credit is not just the underwriting, but it's do you have the balance sheet to deal with it? And in 2008, banks were running at much smaller capital levels. Right now, they're much better and much higher, particularly among the community banks. They have higher capital levels than the major banks. And I think that's an area where you may see pressure on regulators to soften their stance on capital levels, but I'm against that. They're doing just fine. Keep the capital levels. We don't need a banking crisis. We got enough problems in other areas.
Yeah, that's a great point. Maybe not pull them back a little bit, keep them at levels that they're at right now. We don't want another crisis like we had in the mid-2000s at all. All right, great discussion, Dory. Have a great day.
Thank you, Tom.
All right, that's Dory Wiley, CEO of Commerce Street Capital, joining us, breaking down the financial sector. But coming up after the break, Jenny Horn, she's going to join us to cover the retail sales data and a couple of movers. And Alan Nuckman from BullseyeOption.com, he'll give us his take on stocks and commodities. Stick around, the future show is coming right back.
Empower your portfolio show with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Every morning, our analysis is your blueprint for the day. Bonds, stocks, across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network. Welcome back to the Future Show here on the Schwab Network. We're less than an hour from the cash open for stocks on Wall Street. Let's bring in our next guest. We got some breaking news here. That's going to be Jenny Horn, markets correspondent here on the network. Jenny, we got a couple of numbers that are pretty important. Futures kind of holding steady here. What are you seeing here on retail sales? We'll kick it off with that one.
Yeah, so core retail sales rose around 0.4% versus what had been expected, which was around 0.5%. And previously, that number had come in around 0.2% higher. So actually slightly missing the mark as far as like expectations were concerned. But you look at then some of the other reports that were released right now this morning, like initial jobless claims also came in around 217,000. That was also slightly above the 210,000 forecasted, but did mark an improvement previously, which was around 203,000 jobless claims. So I will say these numbers feel relatively small and frankly not as nearly as important as some of the other major economic data points we've talked about this week. But I do think that retail sales and the consumer, I mean, especially here in the U.S., has been such a point of strength. To see a slight miss of the estimate is not exactly, I mean, the best news you want, but also it does at least, I would say, mark an improvement, although now prior revised did come in around 0.8%. So that does paint the picture a little bit differently again. So take this for what you will. I do think the jobless claims, though, is actually kind of interesting because that number has been so consistently strong that these are a bit more shaky than what we're used to.
They said retail sales are supposed to come in about up 0.5, up 0.6. I think a lot of people were expecting a hot number there, Jenny, due to the holiday shopping season. But then the continuing claims actually fell a little bit as far as jobless claims goes. But this kind of goes into that narrative of what we saw on the non-farm payrolls last Friday. Hey, the job market's still robust right now. People are still out there spending, even though this retail sales data came in a little bit light, right?
Yeah, and I mean, you can find, I think, like within the retail sales report, you can find some of these figures that maybe better illustrate like the strength of the consumer. Like the control group sales did rise around 0.7%, whereas prior we had seen around a 0.4% rise. So that was actually stronger than expected. Whereas like excluding autos and gas, that figure rose around 0.3% for the month. Previously, that figure had risen around 0.2%. So yeah, you can find the bullish case here still within retail sales, because if there's one economic data point that we seem to be certain of, it's that the U.S. is going to, the consumer is going to continue to spend, and it doesn't seem to be slowing anytime soon. Today's figure doesn't necessarily change that.
Yeah, Jenny, and going into that narrative here, as far as retail sales goes, Target had an update. Now, the stock initially popped. I think it was trading about $140 a share. when this news came out. They gave a mid-quarter update here. Traded up to $142. Now we're actually down a little bit. Help us break this down, because it seemed like euphoria was in for this stock, but then now it's starting to get hit.
I know, and Target, gosh, I mean, it's been so disappointing relative to some of its closest competition. I wouldn't necessarily call them peers, because I think they serve an entirely different market. But like Walmart, for example, has been one of our strongest charts of the last year or so. Target looking so different, trying to recover, but not really holding, as we're still off of yearly highs by about now 26%, but off lows by 12%. So at least trying to find this new range here around like 134, which is right where we closed yesterday. But regarding the street news today and some of the conviction on this name, they did report their holiday sales period were up about 2.8%. That was an update to their holiday sales performance for combined November and December, along with a number of changes in their leadership team were also announced. They did say that over the course of the last year, they've seen now comparable sales increase around 2%. They also posted record high sales as far as both the Black Friday and Cyber Monday promotional periods. And they highlighted this was really driven by a 3% increase in their traffic in their stores, representing gains both for not only their physical stores, but also online. And they did highlight that they now see more than 30% growth in their same-day delivery option. That's right now Target Circle 360. And they said that they saw also about 50% growth in their Target Plus, which is their third-party marketplace, and that more than 97% of their orders were fulfilled by their own stores. That's actually maybe the most amazing, because the fulfillment center capabilities of Target is something I think that's just maybe overlooked, frankly. But I do think that really regarding this update and some of the leadership shakeup, they did say that they will see now a new executive vice president, a new chief stores officer that will be, for the man in the current role, will be retiring after 25 years with the company. And so some of the leadership shakeup, I think, is just maybe the season where it's now starting the new year. I also think that this company has become more and more difficult to run. I mean, we've seen that in the last year or so. They've had shrink, they've mentioned. They cannot really control the theft they're still seeing at stores. They're closing locations as a result. We're still in an inflationary environment. I know that there's the thinking we'll see less inflation to come in 2025, but we've seen Target mismanage its inventory, deal with different costs, and also some of their high margin businesses, or like sales, basically just aren't there like they used to be. So there's a lot to like about Target, but frankly, there's still a lot to be skeptical about now, I think, into 2025, Tom.
Yeah, I've equated the moves in Target. It's been a pretty choppy stock the last couple of years after a pretty spectacular run at the start of the pandemic, along with Walmart. But now we've seen that, that dispersion between the two stocks. And is it misexecution at this point? Because, as you mentioned, inflation's not going down anytime soon. And that's what they rely on, some of those, products that they have, as opposed to Walmart, which is getting more into grocery. They got the lower cost entry point also. So this mix up, Jenny, when you look at it on the surface, it sounds great. But at the same time, if inflationary pressures are still going to be there and, the consumer's going to be strapped a little bit, it's going to be a while till they can do the turnaround here for Target, right?
Yeah, I think this was complete misexecution. I'm not saying I could have handled the retail environment in the last year any better, but they talked about the ways that they invested too heavily in some of their private labels, which are expensive. So now they're trying to go back to more of a third-party type business model. But also, I think the most astounding fact is that Walmart on its last earnings call said 70% of its new growth in the quarter was from these higher income consumers. That to me says that you're no longer just, the low-cost Walmart. You're now stealing some of those customers from Target. And I know that Target has a very, very loyal consumer, and I'm not saying that they're necessarily all moving over, but unfortunately for Target now, price is everything. The U.S. consumer might be strong, yes, but they're definitely deal hunting, which is what we've learned over the last year. I mean, like the outperformance of TJ Maxx, I think, has been speaking to that. So if you can't offer good deals, and Walmart's maybe becoming more and more seen as a great option for those that are somewhat between the two, I think that's a concern. You never want to be losing market share to the behemoth that is Walmart, of course.
Yeah, those holiday period sales up 2.8%. That's a pretty good number. But then Q4 adjusted EPS view They're at $185 to $245 now. That's down from the consensus of over $2.60. So that's maybe why we're seeing the turnaround in the shares, because all the other stuff, the change in leadership, holiday sales numbers sounds pretty good, but then you start diving into the guidance. Maybe that's why we're seeing some weakness. Jenny, another stock story today, and we've seen a lot of analyst commentary over the last couple of weeks here in Netflix. Most of it positive. We saw some more positive numbers today out of Seaport Research, but another upgrade ahead of earnings next week.
Yeah, a pretty high price target, $9.55 on Netflix ahead of those fourth quarter results, which are expected January 21st. I think that every single day I've seen analyst notes that all seemingly are bullish on Netflix into this report, but Seaport is boosting their net member addition estimate to around 9 million, up from 5.7 million. Also citing the operational tailwinds that should support their position with industry-leading original content accolades, which they said includes gross additions, attraction of more of their top content projects, advertising growth, live sports rights wins that should come with its reputation. And those are just a few of the reasons. They also do believe that Netflix should be a core holding for investors given its revenue growth, its operational margin expansion, and its now free cash flow conversion. This has been, I mean, amazingly so, one of the best performers in tech really over the last year. And you look at the way that the Mag 7 has pulled back. I mean, this name has been even more resilient than some of the largest names in tech. I know it's at this point smaller, but gosh, I mean, we peaked at around $941.75 a share, and we've pulled back now about 10% from those levels, off of lows by about 78.5%. I mean, Netflix has been amazing and incomparable to anything else in this world. Also difficult, I think, to compare like an Apple TV and Amazon Prime Video to Netflix because they're not obviously a pure play into streaming. But everything I've heard this week is that we are full speed ahead for Netflix in 2025. It's been received well. Squid Game 2 came out. People have, I think, very much still that cult following to that game. I know like everyone has watched that show, so that's huge. Also, their NFL games over Christmas. I was worried about their ability to stream and deal with such a mass viewership. They did a wonderful job, I think, in part due to the NFL. I think probably had some hand in that. But I did also watch the first Raw of the WWE on Monday night, and it was also amazing. And I'm not really even well versed in that world, but more and more of this live content that impresses and is done so well, and especially from a production standpoint, I think only bodes well and only positions them to be even further ahead in what seemingly is now this one-horse race in streaming.
Yeah, Cydia also came out late yesterday after the close, and they raised estimates for net additions also. But I think the key here, Jenny, moving into this is live sports, where they can get that ad dollars. Now, half of the signups now for Netflix, their subscriber ads are in that ad tier level, and they charge more for ad space. But Jenny, repeat that for every viewer out there. You watched WWE on Monday night. Is that true?
Yes, I've watched it actually twice. I kind of like it.
Oh, boy.
See, if that gives anyone a good reason to watch it, then that should be it. Because I wouldn't say I would have watched it, but production-wise, it was so good that I keep coming back to it on Monday.
Yeah, and the NFL games on Christmas Day were actually pretty spectacular. Some of the camera angles and everything. So ad dollars screaming in. I think they just need more live content as far as sports goes, and that'll really ramp them up. But we'll get some more clarity on that with earnings next week. All right, great stuff. Thanks to Jenny Horn, markets correspondent here, breaking down a couple of stock stories and retail sales. But coming up after the break, Mike Zaremski, he's going to do a deeper dive into some of that data. And then Rick Ducat, he's going to join us to chart Bitcoin and the moves that we've seen in the cryptocurrency, just under 100K now. Stick around.
Every morning, our analysis is your blueprint for the day. Bonds, stocks across all asset classes on Morning Trade Live on the Schwab Network. Weekdays at 9 a.m. Eastern.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Welcome back to the Future Show here on the Schwab Network. It's time to bring in our next guest. It's going to be Mike Zaremski, Director of Futures at Charles Schwab. Mike, what was your takeaway from that retail sales data? Because it seems like it came in a little bit light, but it's still kind of reflective that the consumer's out there spending, right?
Absolutely right. It was still positive there, Tom, as well, too, for the fourth consecutive month, though. But like I said, it was the lowest, rating up 0.4%. Market was looking for 0.6%, though. But if you look at X autos there, also came in at 0.4%, which is in line with expectations there. For the year, retail sales were up 3.9%. So not too bad, but, could be a little bit better, though. But I think that also says that the consumer there is still overall spending there. If you kind of do the breakdown for the last month as well, too, only 3 segments that really showed declines in December there, and that was led by building materials and garden centers there as well, too, down over 2% there as well, too. And I think a lot of that maybe was weather related there as well, too. So overall, like I said, not an overly hot number there, but like I said, 4 consecutive months of gains there going into the end of the year says that, once again, consumer is still spending there. I mean, it looks like a lot of the retailers are saying we had a pretty decent holiday season so far there this year.
Yeah, I'm curious to see what the Atlanta Fed GDP now numbers start to come in at with the data that starting to come out on holiday sales. We had the Target numbers also for their holiday sales up 2.8%. But on the flip side here, Mike, jobs. And that's what I think people miss a lot about what's going on in the overall economy is the fact that if people have jobs, wages are going up, inflation's still too hot at this point, but people are still spending out there, Mike, and it's due to the fact that the job market's still doing well and, jobless claims numbers, while they were up a little bit, still at relatively low levels historically.
Absolutely right there as well, too. Last week, though, was that anomaly there. We got to the lowest levels since last January there as well, too. So a little bit of uptick was expected there. It's a little bit hotter, 217. But continuing claims fell more than expected, down to 1.859 million there. So those people that have been jobless for a while there maybe found a little bit of employment there last week there as well, too, kind of offsetting that a little bit of a jump, though. But I think the number here that came out that I think maybe overlooked by a lot of traders was that Philadelphia Manufacturing Index there jumped sharply in January there. I mean, every category was higher there, but I think especially new orders there, which was negative in December there, was over 44 here in January. So, and we heard about the manufacturing sector really kind of struggling throughout the last couple years as well, too. So to see that numbers there being, so sharply higher compared to expectations there, maybe we're starting to see maybe even that sector there maybe starting to improve a little bit as we start the new year.
Yeah, you bring up a good point, Mike. As far as inflationary pressures, service side's been doing well for the last couple of years. The manufacturing side has not. You look at the Empire State Manufacturing, that came in down 12 or so. But if we see that acceleration, or at least that bottoming cycle where we see the trend start moving higher in manufacturing with the new administration coming in, that could also lend some headwinds to getting any inflationary pressures down, right?
Absolutely right there as well, too. The economy's doing well, though. That'll definitely actually help, kind of offset some of that increase their inflation. Even the inflation numbers, though, I mean, yes, it is stickier than we expected there. The Fed wants to see it continue to go down, though. But if you look at the core rates, though, those were a little bit better than expected there. And a lot of the gains was last month there was in energy prices there. We know crude oil prices gone up, gasoline prices kind of up, and we think that's going to be transitory as well, too. In fact, the EIA in their short-term energy outlook yesterday said said that, they expect that oil prices will come down here in 2025. They expect Brent to be about $74 a barrel there. So, yeah, and they think that U.S. production is going to remain high, at least for the first half of the year as well, too. We'll see if that continues there. But, if we start to see energy prices come down as well, too, they'll take some of that inflationary pressures that we've seen the last couple months there with the spike up in oil prices there. And that maybe will get the Fed maybe in a little bit better mood there. Then maybe this is just kind of a little spike and up in inflation like we've seen in early 2024. The same thing as well. We saw that spike up in the first couple months as well, too. Then it started to move down there as we went throughout the rest of the year.
Yeah, I talked about that with Kevin Green earlier in the show. Watch those crude oil prices. We hit $80 a barrel yesterday. A lot of the gains that we've seen in crude have been over the last couple of weeks. They weren't in that inflation data and CPI and PPI. So will the January numbers that come out in about 3.5 weeks be a little bit hotter than expected? Most likely. We saw increases in energy, 4.4% in that report this week. I think they're going to be higher. Great discussion. Appreciate it, Mike. That's Mike Zaremski, Director of Futures at Charles Schwab, breaking down some of the numbers and data for us. But now it's time to bring in our lead market technician. That's going to be Rick Ducat. We're going to take a look at Bitcoin, which has been choppy, volatile. I mean, down to 90K, up to all-time highs. You got a short-term chart here, Rick. Break it down for us.
Yeah, choppy is definitely the word I would use to Choppy is definitely the word I would use to describe it here, because we can see that we've been trending downward a bit here. A lot of volume activity, not really a lot of really clear, great nodes to use here. But the point of control comes in near 97 to 91. You can see that we had a sharp rally off these lows. Now we're forming a bit of an uptrend here, stalling out near this other volume node, near 100K or so. So that's kind of the level to watch. And then we would see if we were to break beyond that here, another node, a smaller one, near 103K that matches up with this set of old highs here. You can see that was also a low and about a high there. So one of these sticky price levels, Tom.
Yep, and coming off that 108. A lot of people expecting, I hear these outsized estimates for where Bitcoin's going to be at the end of 2025. I'm hearing 200K. I'm hearing 250,000. But I think, I always talk about Bitcoin is you better know exactly what your downside is in here because of the volatile nature of the product. But you got a longer term chart here to take a look at, Rick.
It's a lot more fun to imagine how high it could go than how low it could go.
That's
if you're
right.
And that's for anything. That's for any product here. But, we need to be realistic. We need to have a plan for if things do start to go the way we don't intend. And, recently here we can see this area, this horizontal line marked a significant ceiling here. Back here. Sorry, that was a downward trend line. The horizontal line right here, 73K. That's where we had our big push to the upside. Very sharp rally. Now a triangular bit of consolidation. What does that spell? Bull pennant type pattern here. And I'm not saying this is exactly a bull pennant here, but it's the same principle. Sharp rally, consolidation period. Traders would be looking for a break beyond the highs as we hold this kind of consistent floor here near 91,615. So when we look at RSI and volume, and moving averages, we can see we're above all our moving averages. We're on the verge of breaking out through this white trend line. We're also on the verge of breaking out to the upside on RSI. We have our downward sloping trend line here, fluctuating around that 50 midline, poised for a breakout is how it looks to me, Tom. And I'm not saying that's a directional recommendation. That's just kind of the way the setup is looking right now, matching trend lines that could be breached very shortly here. It wouldn't take too much. And we can also see now volume profile. We're in the thick of this volume node here. We're pushing above it though. +1 standard deviation, very close, 102,756. +2 standard deviation, 118. Could be another area to watch. But if we do move lower, 91,615 is a series of lows here that we've mostly held. Then our linear regression line, 87,483 could be another area to watch. And then here, this gap, 80,670 is about where we opened up after, or hit the low after that gap up.
So about 91K, going to be a good base here at this point. Got the new administration coming in, Rick. They're
exactly.
going to be really crypto friendly, and I think that's a lot built into a lot of the optimism here. But, we talked about this. We charted this a couple weeks ago, 3-4 weeks ago, before we hit all-time highs in that tractor beam. Now we're starting to see these levels, and you highlighted that next one, 118,000. Is that's a one standard deviation move above the midpoint, right?
Two standard, yes. So,
okay.
So our blue is our linear regression line based on our year line of best fit, then two standard deviations. Remember, this is a moving target too. This is kind of a snapshot of this specific point in time. And it'll kind of change as price moves, but that's a general guideline to keep in mind here. And when we look at our 5-year chart, we can see the volume is really concentrated here around 65,500 or so, matching up with that ceiling that we hit here. So this kind of reveals a key downside area. Volume. There are takers here at these higher levels, though. We are establishing some volume for sure. The +2 weekly standard deviation, quite close here, 105, 300, and then our +3 weekly standard deviation will be 127, 300 or so. So some areas to keep in mind. RSI lower though.
Yeah, and I think this is we keep on looking at levels that are to the upside because a lot of investors aren't in crypto yet. So the total addressable market for potential moves into crypto can be quite large, and I think that's why we keep on looking at numbers to the upside. There's only a finite number of Bitcoin out there also. So good way to look at the Bitcoin chart. Does it get back above 100K today, hit new all-time highs? We'll wait and see on it. All right, that's going to wrap it up for the Future Show today here on the Schwab Network. Stick around, though. Morning Trade Live is coming up next.
So what can you watch at the Schwab Network? Let's break that down for you. Every day from our studios here in Chicago and on the floor of the NYSE, we deliver more than 8 hours of live programming. We kick off every day bright and early at 8 a.m. Eastern with our Futures Show, breaking down commodity markets, futures, and technical trends. At 9 a.m., I'm in studio hosting our 2-hour opening bell show, Morning Trade Live. It sets the blueprint for traders for the day. We invite top analysts and investors to determine what's driving the early action, how to interpret the news, what's on the agenda for the session. Hey, Nicole, tell them about our shows at the NYSE.
Thanks, Oliver. Welcome, everyone, to our beautiful NYSE studio. We are here on the New York Stock Exchange floor, broadcasting live each day. I host a watch list, which provides investors a fun midday update on the major news stories and themes. Best part of being down here is we are right in the center of the action. The energy is palpable. The sights are unmistakable. It's back to Chicago now. Jenny Horn.
Thanks, Nicole. Hi, everyone. I'm Jenny Horn, the host of Next Gen Investing. We all know how many new investors are beginning their trading journey and are eager to participate in the markets. And that's what I cover alongside Alex Coffey from 1 to 2 p.m. every day. We watch the hottest names, trending sectors, and under-the-radar stocks. Oliver, back to you.
For our active traders at launch, Fast Market steps up the engagement to a deep dive into volatility, options dynamics, and trading trends with former floor pros Tom White and Kevin Hinks. At 3 p.m., I'm here to guide you through the closing bell. We construct the best narrative explaining the day's action, which trends held or broke, and prepare for tomorrow's earnings and other market-moving events. Spend some time with the Schwab Network. I promise you haven't seen anything like it. Join me, Oliver Rennick, alongside Schwab Network's options experts as we explore the second derivative. Gamma On is a brand new limited series to take your trading skills to the next level. Subscribe to Schwab Network's YouTube channel now.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
All right, we got stock futures mixed this morning after yesterday's big rally. Somewhat of a slower start and a little negativity in the Dow and the Russell, but S&Ps are up right now in futures. NASDAQ futures also higher. We got some good news from Taiwan Semi numbers leading to a bounce there early morning. We got bonds firming up too after this morning's economic data. We're a tiny bit light in terms of reality versus expectations. Jobless claims a little higher, retail sales a tiny bit lower. Dollar still up and yield still just a tiny bit higher after some overnight give back of yesterday's action. But overall, it looks like we are gravitating back towards a little bit of that coolish response to yesterday's CPI and now this morning's retail sales and jobless claims. So looking at the macro, nothing too concerning here. It could have been a big reversal of yesterday's moves, but there's not. And in fact, they tried to sell bonds overnight, and treasuries were pretty weak earlier, but now are firming up. So we got that going for us. Yesterday's CPI print adding some relief to the market. The question is if we bounced back or if we are beginning a new trend to the upside. So we've got 2 full days here to try and extend the run. And with earnings looking pretty solid so far, you got a decent backdrop after yesterday's big move in the banks too. We saw some major winners there, a few breakouts on the charts and continuation of a lot of strength and names like Goldman and JP Morgan. So now we see how the tech trade fares with Taiwan Semi's numbers. Will the pop from overnight hold in that very important chip maker? Or will we see a fade? If it holds, then you've got good reason for hope across the AI trade, given TSM's role in fabricating a lot of those big chips from NVIDIA and others. So should be a pretty decent start here. Liz Ann Saunders is going to be with us for an early conversation to set the stage for the rest of the week, talk some about yesterday's response to the data. We got a lot of good stock stories to get into, too. There's plenty here on the list this morning, along with the economic numbers from earlier. There's plenty here to discuss. And TSM, though, I think probably the most important one. Bounce overnight, largely holding. Tried to fade a little bit, but bulls stepped in, kept it pinned. This is already after the stock had just put in recent highs following numbers from Foxconn and implications about demand for big AI themes, both in terms of hardware and some consumer devices too. So this is a pretty good indication, given you just had strength in the stock, that we're able to hold that strength and extend it this morning, pushing back up to records for TSMC is very good. This is obviously one of the direct connections to NVIDIA and the AI demand. It's been a top 5 semiconductor now. It's been one of the most reliable ones. Continues to show that the effects of the new technology are very real and the demand is very real. So we'll see what NVIDIA does
NVIDIA has still been chopping around a little bit below that 140 after yesterday's session. So if NVIDIA can get back above 140, I think that'll be a strong sign for today's rally. I'm also watching Tesla very closely too. As far as the Mag 7 go, that stock has been an absolutely key top player, and yesterday's strength was impressive. Tesla had a nice bounce back. So let's watch TSM, let's watch NVIDIA, and then let's watch Tesla today very closely too, which is trying to turn up again, making higher highs and higher lows on the near-term chart. So those are my two main tech trades to watch. As far as the macro goes, bonds and the dollar, how much they give back today will be an important question too. If we just go straight back to selling bonds and buying the dollar, then maybe some of yesterday's euphoria will dissipate, but it doesn't quite look like we're doing that. And it stands to reason that there could be a decent little intermediate reversal, some mean reversion in the dollar and the 10-year, given how far they moved since the Fed started cutting. The logic generally has been economy better than expected, Fed adding a little bit on top by cutting rates, adding a little pseudo stimulus, if you will. So if that now is done, if the Fed can't cut anymore, then there's some logic that maybe the impetus for the rise in yields, for the rise in the dollar might fade. Now, that's not the only possible explanation, of course. You've also got other things factoring into the dollar, like potential tariffs and just the economic situation in which we are still vastly superior to the rest of the world. Jobless claims still in the low 200s. That's a really good number. Retail sales were positive and increasing around the holiday season. That's good too. So we'll see how far the dollar can slip. Right now it's a little bit bid, but not much. If we see another slide there, if the dollar goes back to yesterday's move, then that would be a big deal. But here's the catch. Note yesterday's intraday swing for the dollar here in the white. It couldn't stay down yesterday. You really can't keep the dollar down for long right now. So that kind of tells me that the potential for this to be a major reversal in bonds and the dollar is probably limited. But I've also made the case that the dollar seems a little bit more well supported than yields. The argument for the higher dollar has a lot of different things going for it, whereas yields might have a decent amount of room for some pushback. We didn't really get much selling yesterday in bonds, really. It was a big buy, and it held all day. So watching those carefully. And then for the S&P 500, technically, we want to see if we can get back into the 6 handle, obviously. Pretty straightforward here as far as the chart goes. Can we get out of this channel? I can basically do it with my arm there. There's the lower highs on the S&P. Can we get back above the recent one from January? That's going to be our test. George Tillis joins me this morning, senior markets correspondent. GT, good morning, sir. Let's talk some economic data. Is this going to help some of the Treasury bulls, the fact that a few of these prints came in a little lighter this morning?
It might just a little bit, OJ. I think, looking at the context of the markets, and we talked about this earlier this week, the long rates or long-term bond yields look like they were ready for a potential reversal of the downside, maybe getting closer to 4.5%. So we've been stuck in this range for a while between 4.25 and now, I think on the high end, we ended up hitting 4.8%. So I think overall, we're probably going to see some softness in long rates. And so that might buoy this market to the upside. And you brought up the technicals as well, which we did bring up yesterday, around 59.80 on the S&P. So we need a good close above that because there's that descending channel that we have to deal with that goes back to the December 18th Fed meeting. Looking at the economic data, again, a little bit light on the retail sales numbers. Actuals came in 0.4% higher versus 0.5 estimates. Revisions for prior month went higher to 0.8 from 0.7, so that's positive. But nonetheless, we still have growth in the retail space, so that's still, again, accretive to economic conditions. And then jobless claims, again, came out just a little bit above estimates, 217,000 for the initial claims, consensus 212, slightly higher prior revised to 203 from 201, but nonetheless still trending slightly higher than that 4-week average, which is around 213,000. So a little bit high, but nothing, outlandish or essentially an outlier number that speaks to, some prolonged weakness in the labor markets. But I think the labor markets right now obviously are going to be, front and center in terms of expectations going forward, especially with long-term rates rising. If we start to see some softness in the labor market, that might translate into obviously some softness in long-term rates. Bonds might move to the upside, but at the same time, we may end up seeing sort of a continuation in the extended decliners, which included the Dow and the Russell, which we talked about earlier this week, which had a nice snapback rally yesterday.
George, even though jobless claims rising for the first time in the last over a month-long period, it's still pretty impressive stuff. I mean, it seems like the jobs market is somewhat unbreakable, not to jinx it, but pretty impressive stuff that, you know, the highlight here is low 200s, even when it does increase. It's a pretty non-dramatic thing.
Precisely. So there's nothing really, you know, that you could pinpoint in that number that speaks to, you know, weakness in the overall labor markets. We're talking about numbers that are in line with historical averages. I think one of the things to look at, if you look at the full year last year relative to 2023, the number of full-time jobs that were created were down by about 350,000. So for what it's worth, again, people seem to be still working. They may not be employed at full-time jobs, but there's a lot of part-time jobs that people are taking to make ends meet. So there is, again, some conditions of weakness in the overall labor market, particularly full-time employment, but nonetheless, there's still obviously still the demand for job growth. And obviously, we're still seeing the economic conditions based on retail sales, which were still positive, despite this slight miss that came in at 0.4%.
Okay. So thinking about yesterday and then the follow through today, what was interesting is even though bonds stayed bid, yields were down all day, dollar did firm up and was only down like 15 bips. This morning, greenback higher too. Seems like it's just impossible to keep that down right now. And it doesn't have to be like a wrecking ball, but to me it does still just to kind of make us aware of potential pressure for a little bit of financial tightening in the market. What do you think?
I think so. I think, you know, I think what's going on, to be honest with you, is the rest of the world, OJ, is slowing down. So they're pushing, you know, growth to the United States. You know, I think right now also the pendulum might swing to the other side. What I mean by that is, you know, everyone was really concerned, particularly if you look at last week, people started getting really concerned about the long-term yields rising. I think the pendulum may swing the other way, where the concern will shift to, you know, rates moving down. And that creates sort of this ominous feeling of, well, if people are piling into long-term bonds, does that mean we're moving into a slowing condition in the economy? So right now, things are still really choppy. I mean, if you just look at the last 2 weeks of trading, it's really been a mess. It's been difficult trading. You know, so for what it's worth, I think, you know, technical conditions certainly matter. 5980 break, a clean break of that might push us closer to the all-time highs as we move into the end of the month. Policy clarity, I think that'll start to manifest in the next few weeks or so, particularly, of course, the inauguration next week. We'll see if the Trump administration comes out with a sledgehammer and starts, you know, putting money where their mouth is, so to speak, based on their expectations of tariffs and so forth. But I think the pendulum might swing. I think we'll see maybe a reversal in the euro back to the upside, some softness in the dollar and yields, which may end up trending down at the very least to 4.5%.
Okay. Well, it seems like bonds right now are pretty quick to catch a bid after the numbers this morning, so maybe there is finally some bullish pushback there in treasuries. Fed commentary, bond auctions, anything else potentially factoring in there, George, or the notion that inflation didn't push back all the cuts because we still got one lingering this year. Does that kind of end the conversation for the moment on treasuries?
No, I don't think so. I think when it comes down to rate cuts, I mean, like I said, you know, earlier this week, if you just look at where we're at in terms of inflation, let's just, you know, put out a hard number at 3%. The Fed is still restrictive. They're about, you know, 1.375% above inflation at the core level. So they're still restrictive. So I don't think the Fed is in the business right now of cutting rates or raising rates. So I think they're in the right position, just looking at 2-year yields right now. So I think obviously right now there will be growth concerns, and growth concerns will manifest in the long end of the curve. And so if we start to see treasuries move down in terms of yields moving down, especially on the long end of the curve, that might create sort of an ominous condition for stock investors because of growth concerns. So like I said, I think the pendulum may shift, the narrative may shift from inflation concerns to growth concerns. And again, it could be wrong, but that's what I expect in the next month or two.
Okay. Thanks for the thoughts, George. Appreciate the analysis of the data here this morning. Good stuff, GT. Jobs market looking pretty strong, even though we did see an increase in the jobless claims. What's looking even better this morning for the stock market, those Taiwan Semi and the whole AI trade. Jenny Horn here with me, looking at the numbers. This is as big of an AI story as there is in this company.
I know, and I think that if you were worried about the AI trade and like the expectations for 2025, this should make you feel about 1,000 times better because I mean, and we're seeing a surge in their profit. Also, right now, revenue rose 37% on a U.S. dollar basis, and also is gaining now 5% this morning. So, I mean, this has been one of the most important aspects, I think, of AI because of the fact they really supply some of the major names like Apple's iPhones, Qualcomm's chipsets, and some of the more advanced processors from AMD as well as NVIDIA. So this is basically like feeding into then the supply chain of all of these major companies. Also encouraging is I was looking at like the components of revenue, and I think what can be really attributed to like strong management decisions is the fact that they have reshaped some of their revenue offerings. Like right now, their fastest growing area of their business is high performing computing. That does include their AI chips, of course. That did rise 58% from a year ago, but also now it accounts for over 53% of their revenue, whereas a year ago it was like 40%. So shifting more into like what's growing and what's not. For example, smartphones are now far less of their revenue mix. So that's now like 35%. A year ago, it was closer to 45%. And I also think
that's good.
I know, right? Because I feel like focusing on like the high growth areas of your business is huge versus like still having such a draw to some of the components that aren't, frankly, the growth engines.
Right. The smartphone's very cyclical. It's very, kind of old school way to think about a chip maker. This is very much now next gen, if you will. To borrow a phrase.
Very much next gen, if you will. And I also think encouraging they gave guidance that would only signal more strength ahead. I mean, first quarter revenue expected to be between 25 and 25.8 billion compared to like 18.9 billion a year ago. I mean, huge growth.
Really good.
One thing is maybe the fact that they're raising their capex. I mean, they're expecting now to spend 38 to 42 billion dollars this year.
Yeah.
Which
Well, they're
seems
expanding,
astronomical.
building plants. When you got this type of growth, market seems okay with it. CapEx numbers have been interpreted as now like a bullish thing, which oftentimes was not the case historically, but the last year definitely has been.
I know it was like 3 earnings cycles ago where all these companies got punished for spending like billions and billions a year. Now I think you have to be doing that to remain competitive, or else you're obviously not growing quick enough or spending on the right things. I also think it's encouraging so far they haven't really been hit by a lot of these export concerns because they've been excluded from some of these lists regarding the Biden administration. How a new leadership will affect them, I think is only favorable. But this name is so ill-named also. It's 75% North America. So
That's what I was about to say, even though it's Taiwan Semi, they're very active here in the U.S. and continue to expand their footprint.
Yeah, their next largest market is China, which accounts for 9% of their revenue. So their revenue breakdown is fascinating to me because, again, I think the fact that they're continuing to shift their mix to be what is growing the fastest, high performance computing is doing extremely well. This name also gave really strong numbers already for like December. I mean, like all things Taiwan Semiconductor would tell you, the demand is still there, and we're not really seeing any dips, despite the fact that we have, of course, dipped from highs here, although making a decent recovery.
Yeah. All right. So 219 right now, pretty close to the overnight highs. Pretty good rally, great report. Now we see what the market does with it. It doesn't seem like the analysis goes much more complicated than that.
I was going to say, if we're not able to hold on to at least this gain we're seeing now, then I'm confused what we're looking for here.
Sure.
I guess that's like the detachment of basically like the market and then the actual like story.
Then that's when we just go, valuations. It must have been too expensive. So we'll see. Should be able to hold, but we'll watch it as a major indicator today. Thanks. Appreciate the look at the numbers. Jenny Horn, host of Next Gen Investing. Coming up, let's talk with Lizanne Saunders about the market's rally yesterday and how that sets us up for the second half of the week. Numbers this morning seeming to play along with what Treasury bulls want, so we'll see if we can run with it.
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Nasdaq futures trying to lead us this morning with Taiwan semi rallying, and now bonds trying to make their way back to unchanged following an overnight fade from yesterday's rally. After numbers this morning for jobless claims and retail sales came in a little bit light. Here to dissect the numbers in yesterday's moves, Lizanne Saunders, the Chief Investment Strategist at Charles Schwab. Lizanne, great to have you this morning.
Good morning, Oliver. Thanks for having me.
So let's take it back to yesterday first. Big move, big response to CPI. Tell me what you made of the rally.
Yeah, I think it was a relief rally. The market was a bit oversold technically, so you had that set up. But it wasn't a screamer on CPI. It didn't really move the needle much in terms of near-term expectations for Fed policy. It was interesting that a number of economists did adjust their sort of guidance as to when the Fed, if they're going to cut this year, would give its initial 2025 cut from July to June or from September to June. Frankly, I'm not sure I agree with an attempt at that exercise, given the data dependency of the Fed and a heck of a lot of time and data between now and, say, the June meeting. But that's just the nature of the beast right now. Every one of these data points, be it on inflation or the employment front, is going to move the needle in terms of Fed policy expectations.
Okay, so when we look at the overall inflation kind of perspective, it doesn't seem like it changes too much in terms of the trajectory, but enough of that trajectory still, I guess, is sticky to keep the Fed at bay for at least, what, like 6 months?
Yeah, who knows? Again, it's a function of the data. I think that the Fed is in pause mode, certainly for the January meeting. I think a lot would have to change for them to move off of the pause button for the subsequent meeting. But, beyond that, it's going to be a function of the data. We don't anticipate any kind of serious move back up in inflation. The only, I guess, blemish this week was within the PPI data, actually, which on the surface was benign, was lower than expected, but the airfares component did pop up, and that is one of the feeders from PPI into PCE, which of course is the Fed's preferred measure. There's other feeders that are more benign, but that's something worth watching. That could represent a subtle surprise within PCE or a subtle shift up in PCE.
Okay, so it seems like one of the messages that's important that you want to communicate is that the market generally just has a habit of getting way too far ahead of itself in predicting Fed moves. Is that a fair point?
Yeah, we certainly saw that about a year ago when the market was pricing in expectations of 6 to 7 rate cuts and a start in March of last year. And, we talked about it many times on the program. That was clearly the market getting way over its skis. And ultimately, Powell himself had to come back out and sort of push back on those expectations. I don't know that the expectations now are overly egregious. You only have about 1 rate cut priced into expectations. But, moving the needle in terms of when will they from, say, July to June, I just think with 6 months of data ahead of us, it's premature to go through that exercise. Every single data point is going to move the needle on expectations around the start point, how many cuts we're going to get this year, all those probabilities. That's where there's going to be volatility.
Okay, so if this doesn't necessarily send off like alarm bells, if the numbers don't send off big red flags about inflation like resurging, does it at least, though, the quality and the strength of our data, especially on jobs and more, Lizanne, suggests that the downside is limited for the economy in the visible future?
Yeah, I think downside is somewhat limited. We've got the strength in employment, even in the retail sales data today, which were weaker than expected. But that was because of positive revisions the prior 2 months. That's just the month-over-month math and how it works. But the control group portion of retail sales, which feeds directly into GDP, was the big positive surprise in that number. So you've got consumption doing well, you've got the labor market doing well. So I'm not all that worried about GDP. The one thing to be mindful of, and it's not just a short-term phenomenon with inflation, is the aftermath of the California fires. We've seen periods in the past where you have significant natural disaster, and one of the first places where you see acceleration in inflation or prices is in things like used cars. And all we have to do is look at the news reports of how many burned out cars there are. You can make an assumption that that is one of the first places you're going to see demand really start to spike. And then down the road, you can bring that into the construction areas and building materials too. So that is one inflation wrinkle that's going to make it difficult to try to gauge those metrics in light of the very sad events in California.
Okay. And when do you think, Lizanne, we might have clarity on that?
Well, I think in terms of the used cars, because they're more accessible with immediacy than in the new car market, we'll start to see that in the next set of inflation readings. So I think that's very near term. It'll be a little bit longer in terms of things like building materials, construction costs, because we're just not at that point in the aftermath of, particularly given the fact that we're still dealing with the problem in California.
Understood. All right, as far as yesterday's move in markets go, there was the kind of broader inflation response. There was also earnings mixed in, too, with the banks shining and a few major moves on those charts. What does that tell us at this juncture? Is that another kind of verification of economic health?
Well, not probably surprising to us to see strong results out of the financials. It's one of the reasons why we have an outperform rating on financials, and it's only two sectors right now in which we have outperform ratings: financials and communication services. So we did have an expectation we were going to see strong earnings numbers, and you've got that trajectory working in favor. It's also interesting, a lot of positive commentary on the wealth management side of many of these companies, and that's a real secular growth area. But it's enough, even though it's a relatively small percentage of the S&P that is reported, it's enough that at the start of earnings season, before we had the first report, the consensus expectation was for about 9%. And just based on the numbers that have come in, and I haven't looked at it through yesterday's close, but midday yesterday, you were up to about 10.5%. In what they call the blended growth rate, which is the companies that have already reported plus the consensus estimates for those yet to report. So far, so good in terms of the bar having been set a bit low, and at least for now, starting to inch back up for Q4 in total.
Okay, so that's pretty encouraging. Is it enough to help us ignore valuations and expensive stock prices, or is that focused in a different group away from the banks that's kind of dragging that valuation higher in the market?
Well, a stronger denominator, obviously, all else equal, helps what is clearly a valuation problem. But the one thing we always say about valuation, same thing we actually say about sentiment conditions, even at extremes. They're terrible market timing tools. In fact, valuation to some degree is an indicator of sentiment. And so to look at any level of valuation, however rich, expensive, whatever term you want to use, like is the case now. If you were to look just using your standard forward PE and then do a scattergram of start point of forward PE and then subsequent 1 year return for the S&P 500, there's basically no correlation. And if you go out 10 years, then you do start to see that connectivity. Lower start point valuations lead to better long-term returns, but there is no correlation to short-term returns. So we can talk about it as sort of a backdrop issue and something to be mindful of, but it doesn't represent some moment in time trigger to get out of stocks in the case of an expensive market or vice versa.
Okay. So don't try and make moves around valuations, but at least to kind of appreciate when maybe some of the bigger tides might be coming in or going out. And obviously earnings growth is a pretty good way to normalize some of those concerns. Lizanne, thanks a lot. Great stuff. Appreciate it very much. All right, there's our opening bell. Lizanne Saunders, Chief Investment Strategist, Charles Schwab. Some positive tone there from Lizanne on the earnings potential for this season as banks kicked it off with a bit of a bang yesterday. Financials starting off the session, little changed right now, about the same as the market, which is trying to figure out what direction to go. Pretty much half and half. Got 11 sectors, so it can never be that way, but you do have utilities and banks a little changed. Tech's up 0.75%, healthcare's down 40 bips. Obviously, that's a pretty good skew in favor of the market when tech's up, and the only group that's really showing any notable movement this morning, with XLK up 70 bips and Taiwan Semi trying to invigorate these semiconductors more wholly. TSM is up 5% right now, just shy of its recent highs, about $6 away. TSM trading 216 and the high of 222 that was put in earlier this month, earlier this year, right at the beginning of 2025. Remember, Taiwan Semi broke out. So semiconductors higher this morning by about 2%. SMH getting pretty close to the high end of its range. Could be a big deal if it breaks out. If NVIDIA goes wild today, that would be a pretty good sign for risk appetite. $138 right now. NVIDIA below the line that I've had on the chart for some time at 140. Can't seem to hold that. Keeps bouncing around it. So if you see NVIDIA get above there, I think that would be very encouraging today. I'm also watching Tesla, which is starting off a little bit lower by $7, but yesterday was somewhat of a screamer for Tesla and continuing multi-day rally, trying to get above its own monthly highs right now. So watching Tesla very closely right at 420. Sometimes the Tesla fans like to keep it there, though. Kevin Green joins us this morning for a look at some of the technical setups, flows, and things on the calendar that could go bump. KG, what do you think about the day two here? It seems like we're moving slow, trying to catch our bearings after yesterday's rip.
Yep, and we're opening up at a resistance point here. If you're looking at that 50-day moving average, sitting at around 59.62. So we opened up at 59.63, saw a little bit of a rejection. You'd like to have us kind of coming back down to that 59.50 area, maybe some buyers kind of stepping in and then trying to proceed higher. Also touching that upper end of, once again, that resistance zone. We have a little bit more room to go here, Oliver, if you're looking at that upper channel line, sitting at around 6,000 even, actually. So kind of some confluence with that positioning that we've kind of talked about there at the 6,000 level. And then also moving up that negative gamma area just due to the update for the open interest for yesterday. And then the volume for this morning, 5,900 looks like that's going to be your area where you want to be able to defend. And then also kind of notice that also aligns with that gap area. So the technicals are once again aligning with the options flows for the most part. We got the MACD hinting higher, and it looks like it wants to cross to the upside here today if we are able to get some green on the screen, or if we do not, maybe it's going to be a little bit of a fake out. So the technical setup is still looking fairly good for the most part. On an intraday basis, 59.70 is going to be your first area of resistance. We got within 7 points of that to open up the market, seeing a little bit of a failure there. 5,900, you want to be able to defend, bounce off, kind of push higher. And then looking at that 6,000 level, there is some flows at 60.20. So we break above 6,000. 60.20 is kind of the area that I'm looking at for the day if we can continue a bullish trend. But right now, once again, we have the technicals still remain intact here. Positioning looks okay. Nothing looks aggressive to the upside and or downside. We just need a follow through day.
The advanced decline that we talked about yesterday, improving breadth, while the market bounces back, seemed to be pretty encouraging. This morning, it's a little bit mixed, but not a lot of not a lot of obvious reason for downside. I mean, earnings seem to be pretty smooth to the start. We had, obviously TSM looked pretty good, so that's going to help the tech stuff. And yesterday's rally in banks, maybe not getting immediate follow through, but Bank of America up 70 bips, so at least it's not down. It just kind of seems like the market, if it's going to have a problem, I'm not sure. I don't see it. It's not visible right now, at least in terms of like news flow. I mean, maybe to Lizanne's point, the retail sales were in line, so maybe bonds fade, but it's pretty quiet in that market too right now.
Yeah, so to start off the session, we were sitting at around 50-50 when you're looking at the S&P 500 advance to decline there, and that actually just kind of moved up to around 62-63% just in the time that we've talked right now. So breadth is actually expanding if you're looking at the equal weight S&P, up about 0.15% here today. So what does this kind of show as far as that small little pullback that we saw to start the session? Obviously, there's a lot going on. It's mega cap names. Now, if mega cap names like NVIDIA kind of get a little bit more structure and kind of push higher, that gives you the thesis that the bull run can continue here, and we will challenge some areas of resistance. But that advanced decline has been in the right trend, and you want to continue to see breadth expanding here rather than consolidating. Now, if you're kind of looking at the E-mini S&P futures, what we kind of talked about yesterday, and that key indication of open interest changing, was it going to be negative? Was it going to be positive? And we actually did see a positive change when it came to open interest for the E-mini S&P futures, sitting at around 12,400 contracts. That's exactly what you want to be able to see if you're a bull in this market. On the other side of that volume candle, we just did not get that follow through for the volume candle yesterday. It was actually the lower bar that we have seen over the last 3 trading sessions. That's not really great, especially in the location that we are at right now, where we're testing the upper end of that channel for the E-mini S&P futures. What you do not want to see is this kind of like shooting star pattern taking place today, meaning that we break up, we try to test new areas of resistance, try to push higher, we see a fade, and then we close lower on the session or even flat on the session. That would not be a really good sign. That would be a reversal candle. So that's what we really want to avoid today. We want a nice green bodied candle to the upside to really kind of give us more confidence that this momentum can continue and we are able to break through some levels. And for that E-mini S&P 500, your ultimate win for a bull over the next 3 to 4 trading sessions is getting above 60, 70 and holding above that for the next 3 consecutive days. That's going to give you, once again, a little bit more room to run and try to shake out some of the bears in the market. So open interest, positive, volume for the most part negative. Like for a day like we had yesterday, you would actually expect volume to be a lot higher. And we're going to continue to try to see if we can break out of this consolidation or this flag pattern that we've had over the last 2 weeks.
All right. In terms of events on the calendar, KG, I know you watch funds and their timing for rebalances and options, exposure, et cetera. QYLD is one you've told us about before that you think can cause ripples in markets and options flows. What's the deal with that right now?
Yeah, so with QYLD, I think it is actually a pretty good, it wakes up the option market. Sometimes it does cause a little bit of intraday volatility, especially when you're looking at the NASDAQ, and sometimes it does not. It kind of also depends on the position that they're actually going to be taking off. So QYLD is basically selling a call against an underlying portfolio, okay? And so they actually have that short call sitting at the $21,275 strike for the NDX. What's interesting about this one this time, Oliver, is that it's actually close to at the money. Over the last couple of expirations, those calls have been very deep in the money and really haven't had any type of impact. This one actually will. There's actually around $8.65 billion of notational value when you're kind of looking at the position size itself. 4,077 contracts, which they are short, which they will buy back today and then put on a new position for tomorrow. That buying back of those contracts, Oliver, could actually create market makers to actually buy back their short futures contracts. So that actually could give us some positive momentum here. You're looking at around 3.87 billion delta exposure when you're looking at the dollar amount there. So this one actually is going to probably cause a little bit more flows for today rather than what we've seen over the past where the index is 8% or 5% higher than what the actual strike is. This one will actually be interesting, and they usually start doing this, removing this position at around 1 p.m., 2 p.m. Eastern time, and that's when you'll start seeing those flows hit the tape, and they'll layer in 80 contracts here, 100 contracts here, and it usually takes them about an hour and a half, 2 hours in order to complete the trade.
Okay, so when will we know if we're in the clear from that?
When you start seeing that volume, so You'll know when you're in the clear. Right now, the open interest is sitting around 4,415 contracts, give or take. That's off of memory. They're 92% of the open interest. So once you start seeing that volume kind of inching near 4,077 contracts, 4,100 contracts, that's probably when you know that they're going to be done. And then once again, they'll layer in. So you can actually follow along on your TOS platform too. You can look at your options chain, look at that strike, 21,275. Once you start seeing that volume starting to uptick pretty aggressively, that's when you know that that trade's being layered on, and you'll just match that volume with whatever the open interest is. And that's a pretty decent indication as to where they're at in the process. And it takes them about an hour, 2 hours, depending on how aggressive they want it to be to remove the trade. Sometimes they'll get aggressive, sometimes they won't. Kind of just depends on how the market reaction is.
Okay, understood. All right, thanks, KG. Good look at the market here as we firm up across the board. Technicals intact. Showing up here is bulls creep their way in. Up about 20 bips across the board now. Dow positive alongside the Russell. Diane King Hall is looking at those earnings for us. Bank of America a little changed. And Morgan Stanley up 3%. So let's maybe go for the winner here first. Diane, Morgan sharing a little bit more with some of the investment banks maybe than Bank of America, but also obviously they're all looking pretty good.
Yeah, indeed. And I think you saw a big part of the move yesterday, so some of that may have been baked in when it comes to Bank of America. But let's drive into Morgan Stanley first. So shares are moving higher off the back of their latest quarterly numbers. They beat expectations on both the top and bottom line. A lot of that had to do with a trading revenue for Morgan Stanley. EPS was $2.22 a share. The expectation was around $1.70 for them. Revenue, $16.22 billion. Street was looking for around $15 billion for revenue, or just under $15 billion for revenue. So again, both of those numbers were better than expected. Profit essentially more than doubled from a year ago. Now, revenue jumped close to 26%, so 25.8% there. It was really, again, its trading business, and in particular its equities business, that was its strong suit. They saw a more than 50% increase in activity there. So that lined up with some of the commentary that we heard from the sectors within some of the banks that we heard from yesterday with regard to trading activity increasing. Some of them saw more of an increase from fixed income, but for Morgan Stanley, it was its equities trading business. Of course, its wealth management business, asset management, has been a big piece of its pie, and that you saw some increase there. Investment banking activity increased more than 25%. We're expecting to see more of that this year. A lot of the banks are set up. I know you were talking to Lizanne earlier about what the financials look like for this year, and so Morgan Stanley kind of feeds into that expectation of continuing to see strength from the financials, and the setup looks good for this year for them.
Yeah, I mean, really nice to see this on earnings when a lot of times in the last couple of years the banks just sort of fizzle. They debut on earnings to kick the season off, and they're just kind of they just kind of show up and nothing really happens. This is like big ramp. I mean, all these Morgan Stanley, we're getting ready to break out, only a couple bucks away. Bank of America, which shares the most business model with the regional type of like heavy lending operations, also looking good. The regionals themselves, maybe a little bit more mixed, though. Bank of America's response versus the other regionals. Take me through that, Diane.
Yeah, so first up, Bank of America did do better than expected on both the top and bottom line. EPS 82 cents a share. Again, that was better than expected. Revenue top $25.3 billion, so that was better than what the street was looking for. But more of that had to do with net interest income for Bank of America versus trading, because trading activity was essentially in line with expectations, whether you're talking about the fixed income side or the equity side. Both were just what the street was looking for. So they nailed those numbers. But net interest income for Bank of America was an increase of 3%. That was $14.5 billion, so that was better than expected. But if we get into the regionals, you start to see some of a mixed picture there. If we look at U.S. Bancorp, they had some mixed results. EPS was $1.07 a share. That did beat expectations and is up from a year ago, but revenue came in below $7 billion. So that missed the street's expectation, excuse me. Their guidance for fiscal year 2025 for revenue growth is between 3 to 5%. So you're seeing the stock come under a little bit of pressure in the early action, or under some pressure in the early action. You're looking at, well, actually, it's increasing. It's downtrend, down about 4.25% right now for U.S. Bancorp. And then you've got PNC out with their results. PNC, $3.77 a share. That was better than the expectations, $3.30 a share. Revenue, $5.57 billion. That was also better than expected. Net interest income increased to a little more than $3.5 billion. Now, the problem, though, is the street doesn't seem to like its guidance. They're projecting a range of between 1 to 2% of a decline in revenue growth. So that's one of the challenges when we see with PNC. And then M&T with its results as well. M&T posted EPS $3.92 a share versus street expectations $3.70. Revenue $2.39 billion. Street looking for $2.33. They had net loan charge-offs of $160 million. Net interest income came in line with estimates for M&T, but again, in line is really not going to nail it. So you're seeing shares of M&T under some pressure as well. Again, with the regionals, they just don't look as strong as the big bulge bracket banks.
All right. Definite notable weakness across those. Good report there. Thanks, Diane, for hitting all those. USB down, PNC down. Not a coincidence that that's happening. And I will say that the last couple of days, we've got a little bit of yield curve compression, which the regionals don't love. And we're getting some more of that today. So it's a little bit of a, it's not a terrible thing, but it's a little bit of kind of a buzzkill to some extent for the last 24 hours of trading, because these are getting hit in a pretty real way. So there's a definite, like, big gap between the regionals and the money center banks and those that are looking for big investment banking fees coming up this year. So good report. Thanks, Diane. Very important distinction between those groups. Thanks a lot. Market's also fading a tiny little bit there. I'm watching Bitcoin down about 2%. Not a big deal. We're chopping, but frustrating somewhat to see NVIDIA slipping back below $137 despite the big Taiwan semi run. So we're alert to potential volatility today. But when we come back, we'll focus on the biggest story so far that's working for bulls, which is still Taiwan semi, up 5%. But where's NVIDIA? Come on, NVIDIA. 137, come on.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. All so you can trade brilliantly.
little bit of a teensy-weensy fade there as Taiwan Semi's not quite invigorating the tech trade just yet. NVIDIA only up 0.5%. Tom's with me here in studio looking at options on Taiwan Semi, NVIDIA, AMD, and the lot. James Demmert joins us, founder and chief investment officer at Main Street Research at the site at the New York Stock Exchange. James, Taiwan Semi about as important as any chip maker out there right now. How come we're not ripping on this report?
Well, good morning, Oliver. I think that the thing here is it's a bit of a microcosm for what we're going to see this year. Maybe spectacular enthusiasm, but more tempered than what we saw in 23 and 24. I think across the semi business in general. So I think that's a bit of what you're seeing with the flow over from the TSM, which were excellent numbers, top and bottom beats. Really fabulous numbers for it. Maybe I would consider one of the most important companies in the semi business.
Yeah, kind of a real clean, pretty report, right?
Yeah, it was clean, and you know what I thought was really interesting is not just the beat on the top and the bottom, but the guidance was very significant. And let's keep in mind, you know, they are the backbone of making anything AI in the semiconductor business. So obviously selling to NVIDIA and everyone else. And you know, as the business changes and it matures, again, we're still in the early phases of the AI transformation. Different players are going to be buying the fabrication services of TSM. So it won't be just NVIDIA, which is why we think TSM is one of the most important companies to own in the space. But keep in mind, you know, all of these semis did extremely well in the last 18 months, fueled by a tremendous amount of cash that was out there on the sidelines, most of which is gone, and also the Fed policy, which was really lowering rates, and we think that's over with. So these companies are going to have to now trade on earnings, and that's going to make it very important that we're very specific about our stock selection.
Okay. So tell me about that specific stock selection. Do you think that it behooves one to avoid the broader semiconductor basket or ETF and stay with a few specific names, or can I just buy SMH and let it ride?
Yeah, I think buying SMH and letting it ride was a 23-24 story. 25 is going to be a different type of year. It's going to be much more specific. And there's where you really want to go with the leadership positions, where valuations make sense. And you got to expect that they're going to trade on their earnings growth, not those other influences. So TSM is a core holding there. NVIDIA with the new Blackwell chip. You know, that chip is 30 times faster than the first generation of their AI technology. So there's going to be appetite for that as well. So those are two core positions. I think when you start to look at the rest of the semi business, you see a lot of companies that kind of lost the arms race to NVIDIA or TSM as a fabricator.
To your point, the whole group of semis has been kind of stuck. The other thing, too, I wonder is that with TSM being the fabricator, obviously you fabricate after you come up with the idea, NVIDIA being the genesis of all these ideas. Does it represent to any extent a kind of aging maturation of this cycle?
You know, I'm not sure about that, but you know, I think there is risk in TSM with it when it comes to tariffs, and you know, they had some recent sales that were found out to go to Hawaii, which were very concerning. So there's going to be some regulatory pressure on TSM. Trump is walking tall, carrying a big stick about the tariffs. I think they'll stay away from TSM since they're also operating plants here in the United States over the next few years. But you know, the semi business and the initial big flush up from AI, that's maturing. And that's why we want to have investors, yes, own these core semi companies that I mentioned, but look for the second derivative companies, those companies like Now or any of the others like Palantir who bought those AI chips. And now you're seeing accelerating revenue as that second generation starts to kick in.
Hey, James, what do you think about other potential plays? I'm looking at your notes, and it seems